Good morning. It's 9 a.m. on Monday, January 24th. This is Yahoo Finance Live. I'm Julie Hyman. That is Brian Sazzi. Let's take a look at futures here this morning. It has been a rocky road for stocks as of late, and it continues to be here this morning. Futures selling off. Nasdaq futures down by 1.9%. So the momentum continues to the downside, probably some geopolitical jitters as well, not helping matters as we are seeing sharp selling in Europe as well. And from upsets on the field over the weekend to battles in the boardroom as we kick off our Monday, investors are shifting attention from football drama to activist drama. We've got a trio of companies being targeted this morning, notably Peloton, where a new investor is calling for CEO John Foley to step down. Can stocks rally overall without big tech? With the Nasdaq down 12% already in 2022, it's an important question. Julian Emanuel of Evercore ISI is going to join us to help answer it in just a bit. And with crypto seemingly in free fall, we try to figure out if it's part of the usual Bitcoin boom and bust routine, or if there is something more fundamental and long-standing going on. That's a bit later in the program. First up, though, we have to talk about the setup for this week here. As we see this acute selling, we have to note, of course, it is a busy week. We've got big tech earnings. Speaking of big tech, we've got a Fed meeting. Emily McCormick and Brian Chung are both here to help us break it down. Emily, we start with you.
Well, Julie, as you mentioned, this is going to be a packed week in markets as fourth quarter earnings season ramps up and new economic data flows in after what's already been a volatile January in markets. But the economic data out this week will run the gamut from consumer confidence data out from the Conference Board tomorrow to new home sales out on Wednesday and personal income and spending on Friday. But one of the biggest reports to watch will be on Thursday, when the first estimate of fourth quarter GDP is released. Now, this will cover U.S. economic activity in the final 3 months of 2021. And although this is backwards looking, it is the most comprehensive report we'll be getting about how much momentum the economy had heading into 2022. Now, consensus economists do expect to see GDP pick up to a 5.3% annualized rate in the fourth quarter, which would be more than double the 2.3% rate we saw in the third quarter. Now, we'll also be getting the latest on the inflation front with the PCE, or personal consumption expenditures deflator, out on Friday. 5.8% jump in inflation for December over last year, and that would accelerate from November's 5.7% rate, which had already been the fastest since 1982. We're going to see more affirmation of the multi-decade high rates of inflation we've seen in other reports, including the Consumer Price Index and Producer Price Index out from PCE as well. Now, meanwhile, earnings season is really going to be ramping up in the coming days. So far, only about 13% of S&P 500 companies have posted their results, but that is set to change in the coming days. Companies from GE, 3M, and Microsoft are reporting tomorrow. Boeing, Tesla, and Intel will be out on Wednesday, and McDonald's, Apple, and Robinhood will be out Thursday to list just a very small sampling of the many names on the calendar for this week. But I do want to home in briefly on Microsoft and Apple, since those stocks are heavily weighed in the major stock indexes, and last week's earnings results from Netflix and slowing subscriber growth had represented an inauspicious start to tech earnings if we think about what the stock had done post results on that front. But we will perhaps see stronger results from these other tech names. We will have to wait and see. Microsoft is, of course, reporting results on the heel of last week's announcements of its largest ever purchase of Activision Blizzard for $69 billion in cash. But the focus for this report will definitely be on Microsoft's Azure growth, where sales had been up by 50% last quarter. So we will have to see if Microsoft can maintain that. And then finally, Apple is set to report results after multiple reports last year of supply chain challenges impacting iPhone 13 production. But nevertheless, analysts are still expecting the company to post record quarterly revenue of more than $119 billion, really driven on the demand side by that iPhone upgrade cycle. So overall, guys, a ton to be focusing on in terms of the earnings and economic data fronts this week. And not to mention that we also do have a key Federal Reserve monetary policy setting meeting as well. And for more on what to expect from that event, I do want to turn it over to Brian Chung with more. Brian.
We do have a busy week, and there's something for everyone. I guess it's no surprise that I'm circling that FOMC meeting happening this week that's going to begin tomorrow. Of course, we'll get the decision at 2 p.m. on Wednesday. This will be the first policy setting meeting of 2022 and what a meeting it will be when you consider that a lot of eyes are fixated on what the Federal Reserve policy tightening is going to look like over the course of 2022. Of course, the big lingering question being how many rate hikes will we get this year? Now, when you look at the dot plot projections, which we had gotten from the Federal Reserve in the last meeting in December, you saw the median member of that 18-member committee projecting 3 interest rate hikes through the course of 2022. But even since that mid-December meeting, the commentary that we've gotten from the Fed speak from the 12 regional bank presidents has suggested maybe they could get even more hawkish than those projections, which is a big reason why a lot of Wall Street firms are projecting now 4 interest rate hikes over the course of 2022. But take a look at this note from Goldman that we had gotten over this weekend where Jan Hatzius noted that it's possible that the Federal Reserve could set up conversation for, quote, a risk that the FOMC will want to take some tightening action at every meeting until the picture changes on inflation. Keep in mind there are 8 policy setting meetings over the course of 2022. But before we start talking about 25 or 50 basis point hikes, we need to take a little bit of a pause and remember that this meeting, it is not expected that the Federal Reserve will raise interest rates, at least on Wednesday. The big reason for that is because of the Fed balance sheet. The Fed is still expanding its balance sheet and continuing that crisis era policy of buying assets in the open market to message to markets its commitment to keeping interest rates low. The Federal Reserve set a course in December for that process to end in mid-March. The Fed has said very clearly they want to finish that process before they start raising interest rates. So it seems like it's not until March that we'll start to see interest rate hikes on the table. But of course, we're going to get commentary from Fed Chairman Jay Powell in a conference on 2:30 on that Wednesday, which of course we'll have the full coverage of right here on Yahoo Finance. Brian, Julie.
We will. Thanks so much, Brian, and thanks, Emily, as well. Got to get back to the markets here as we have that set up for the week. Obviously, investors are feeling jittery, to say the least. Let's take a look inside the Yahoo Finance Interactive because there's a lot of things to highlight this morning. And first, I want to start on the global map. And something to keep in mind here, the U.S. prices you see here are for Friday's close. All the other stuff is from this morning. And it ain't good, folks, particularly if you look at what's going on in European trading. Frankfurt down 2.6%, Paris CAC 30 down 2.7%, London down 1.6%. What is going on here? Well, a lot of it has to do with the rising tensions between Russia and Ukraine and the possibility that Russia is going to invade. We've got U.S. Secretary of State Antony Blinken set to speak with EU foreign ministers. He spoke with the Russians over the weekend. Also, Washington has ordered family members of its embassy staff in Kiev to leave. So all of this ratcheting up the possibility of military action and raising concerns here. So that's something to definitely keep an eye on. Also, of course, we are watching the feed through to the U.S. and futures, and we're watching the VIX. The VIX 32 is where we stand at this point in time. But we'll talk more about volatility in just a moment with Julian Emanuel, but wanted to highlight that the live VIX, the current VIX, is now priced higher than VIX going further out. So could this represent some sort of breaking point for the recent volatility that we've seen, the selling that we've seen? We will discuss in a moment. Elsewhere this morning, as we take a look at large cap technology, we've been talking a lot about it. Here you are seeing heavy selling in the pre-market. Apple down 2% in pre-market, Tesla down 6% in pre-market trading, Google down 3%. So a lot of selling going on here this morning, continuing in large cap technology. And then, of course, there is what we have been seeing in the cryptocurrencies as well, which has been heavy selling. So that's something to keep in mind, not just the cryptocurrencies themselves, but also all of the crypto related stocks. Brian Sozzi, really risk off continuing. It seems to be a combination of the Russia-Ukraine concerns and perhaps people continuing to try to brace themselves for the Fed.
Yeah, Julian, and talking to folks on the street this morning, I just don't hear in their voices any conviction to step up here and buy on weakness, which suggests, at least in the near term, we can continue to get some selling, at least into that Federal Reserve decision on Wednesday. But a couple of things to highlight. One is that Netflix report on Friday. The stock got absolutely slaughtered, 24%, seeing weakness follow through weakness here in the pre-market on Netflix. If you are inclined to trade earnings season, you don't want to be left holding the bag on a Netflix type earnings report. And that is a new fear that has emerged on the street of tech companies showing slowing growth, over the next 2 weeks with their earnings and potentially not coming out with anything inspiring in terms of guidance for the first quarter. Of course, now with the Russia-Ukraine tensions, you also have worries about $100 a barrel oil. Oil prices up close to, I believe, 14% in January alone. The last thing this market wants to see is more inflationary oil prices hitting the profit margins of very large companies.
Yeah, that is a great point. We're seeing crude oil futures, WTI trade, are just over $83 a barrel at this point in time this morning. It is trending lower, but nonetheless, obviously that is a point of concern for many investors. So a lot of things to choose from when you're blaming the selling this morning. We're going to take a quick break. When we come back, we're going to speak with Julian Emanuel, as alluded to, about what's been going on in these markets. We'll be right back.
Anywhere you look right now, it appears to be risk-off sentiment. The Nasdaq is down 12% year to date. The S&P 500 could fall below the 200-day moving average today, and the sell-off in Netflix persists after a 24% plunge on Friday. Let's dive into the market action with Evercore ISI Chief Equity, Derivatives, and Quantitative Strategist Julian Emanuel. Julian, always good to see you here. What is going on out there in the pre-market? What are you hearing?
Well, look, I think the first thing we have to do, Brian, is sort of step back and think about how rare 2021 was. In a typical year, you get at least one, perhaps as much as multiple 10% corrections. And if you look at the S&P, year to date, you're down a little over 7%. Obviously, that looks to build at the opening. But when you think about what we have on our plate, whether it's the Fed that's clearly talking hawkishly, geopolitical tension that has ratcheted up seemingly quite significantly in the last 72 hours, and frankly, reactions to earnings announcements that for the most part have been okay, but the market just not giving any due respect to companies that beat. You put that all together, and it's not a surprise that we're flat-footed and defensive, into this meeting on Wednesday, the FOMC, that really is a volatility event in and of itself.
And speaking of volatility events, Julian, as I mentioned earlier, we are seeing VIX futures come down even while current VIX is quite elevated. And so what does that tell us? What would be a sign to you of sort of selling exhaustion or selling peak, or do you think we're not going to get it until after the meeting?
Uh, when the market is trading like this, Julie, to try and pinpoint exactly when it's going to come is really a very difficult undertaking, particularly when you look at the last few days. You go back to Thursday, you essentially had almost a 2% rally in the index to be followed by a 2% collapse and then a further 2% collapse the next day. So it's very difficult to gauge this. Our inclination would be that if you get any further fear, we're looking at the cash VIX at 35. That's the time where, as a patient buyer of dips, which is what investors should be, is where you want to start adding to your positions.
Julian, is it really that bad out there? To see Netflix down 24% in a session, Roku down 33% year to date, is the next 6 to 8 months that bad for big tech that warrants these really large downdrafts in some household name tech stocks?
We don't necessarily think that it is, but you have to remember is that the valuations of some of these companies became very, very extended, both relative to the last year and relative to the longer term history of these types of names. And now all of a sudden, we're in an environment where the Fed's going to be hiking at the short end. In all likelihood, the fact that inflation has been as persistent as it has been is going to keep the long end of yields moving higher. And all of that works against high multiple stocks. Now, do all of these stocks tend to be grouped together? They do at the moment. But what we learned last week was that if you miss on growth expectations in an economy where we think you could get GDP growth north of 4%, there will be absolutely no mercy whatsoever for your stock. And I think that's what we saw when the FANGs started reporting at the end of last week.
Are we watching a bubble burst in big cap tech?
I don't think so. This is not the same as 2000, simply because the valuations were not quite as extended in any shape or form, particularly in the leaders. What we've seen actually in a lot of ways, though, is the market rationally discounting profitless tech. Those stocks have been in a bear market for almost an entire year now. The question is that going to stabilize at some point? And rightly so, given where the Fed is in terms of monetary policy. What we've seen in the last few weeks is the spillover into names that we know are going to have good earnings when they report this week. It's just that the price reactions have been, lacking, to say the least.
Yeah, I think that's definitely an understatement. So, Julian, you mentioned people should be coming in. I think the phrase you used is they should be cautiously buying on the dips. Where should they be buying? Should they buy the market overall? Should they be buying tech? Where should people be nibbling right now?
So we think that the environment has changed, and part of the change in the environment has caused this dislocation, the undue pressure on tech. If you think of the combination of an above trend economic growth, higher interest rates, and persistently high inflation, which again is obviously feeding into where the Fed stance is moving, all of those militate for having a value bias. Financials, industrials. We also like healthcare. Energy has obviously been a good sector. You have to be prepared for volatility in a sector that volatile. But the value type stocks that really have not worked for almost a decade, to be frank, those are where we think the opportunities are going to lie in the year ahead.
Well, Julian, there's another thing that I don't think anybody considers to be value, perhaps, but it's fallen more than almost anything else. I'm talking about crypto, of course. And so I wonder what your thinking is on that asset class right now because of the heavy selling that we've seen. And I think amongst the things that are different in this crypto cycle is the sort of institutional interest in it. And so I don't know how that changes the dynamics on the way down and then maybe eventually on the way up.
So for us, if you go back, we have been fans of crypto. You have to own it, and particularly when you've had this kind of a pullback, you have to believe in the use case. You have to believe in the asset diversification case. I think the use case with the proliferation of NFTs and more transactiveness in general is starting to prove itself. These things take time. We also have to realize that it's very, very typical for crypto to have 50% pullbacks prior to the next major leg of the rally. And if you look at it basically going back to almost a year at this point, is that you've ranged between, call it 28,000 in the low and on Bitcoin to upwards of 65,000 on the high. Our view is that as the capital markets digest more hostile Fed, and as the winners and the losers in crypto begin to sort themselves out, as they should in a rational market, as we've seen happen to profitless tech over the last number of months, you're going to have a period of sideways indigestion between those two ranges, low to high, and then ultimately at some point later in the year, or perhaps 2023, we think you start the next leg higher based on the use case for crypto and the blockchain, of course.
Always appreciate your level-headed analysis. Julian Emanuel, Evercore ISI Chief Equity Derivatives and Quantitative Strategist. Good to see you. Have a good week. All right, shaping up to be the year of the activist investor. More on some new headline-grabbing activist campaigns coming up.
We are just a few minutes until the opening bell here in the United States, and it looks like it's going to be an ugly one, folks. So buckle up. We've got selling that is acute in Europe. We've got selling that is acute here in the U.S., as evidenced by these futures that are heading lower. The Nasdaq already down 12% this year. It looks like it is going to add to those declines this morning on continued heavy selling in technology. As we've been discussing, some trepidation about the Fed's next moves and simmering tensions on the Russia-Ukraine border. So people not feeling great this morning. We also have activists rearing their heads this morning as well. We've got a trio of companies that are being targeted by activists. Let's start with Peloton. Peloton down another 3.5% this morning, and a company called Blackwell's Capital, which reportedly has a stake of less than 5% in Peloton, is calling for the CEO and co-founder John Foley to step down. He wants Peloton to maybe put itself up for sale. Brian Sozzi, you've been paying very close attention to this story and looking through the statement from this new investor.
Yeah, anytime I cover an activist situation, Julie, I think you always get these letters from the activists, and I would, grade this one by Jason Antabi over at Blackwell's as level one. Level one being has a personal sound to it. It's very aggressive. It's really targeting the CEO and founder John Foley. I mean, Antabi even goes down, lists a host of concerns, I should say, regarding the company, saying that Peloton has misled investors, that the company didn't need additional capital just weeks before raising $1 billion in equity, questioning the company's approach to handling the safety issue regarding the Peloton treadmill several months ago. Antabi even calling out the fact, and this has been well known, that John Foley's wife, Jill, is an executive inside the company too. So Antabi really calling out the company for, really, the stock price is down 83% over the past year, calling for the company to fire immediately John Foley, and then secondarily consider selling the company. Antabi suggests that Disney, a Nike, and even Apple would be potential suitors here for Peloton. But this is an ugly situation. Now, Peloton spokeswoman declined to comment to me on this activist campaign, but I should note a source is telling me that this activist has amassed a little bit less than 5% stake in Peloton here.
Yeah, and as you pointed out in our morning meeting, it's interesting that an activist campaign here because the voting structure of Peloton is such that it might be difficult, to get some of these changes done. Although obviously one of the levers that an activist will pull is putting out a public letter, as you say, and one that is rather pointed.
Very pointed and really attacking the board here, suggesting that the board is not doing its fiduciary duty here and holding Foley to account, suggesting that the board is just trying to help save Foley's legacy. But this is going to come to an head. As we've learned with a lot of activist situations, the company being targeted could try to skirt the situation. They can not put out a press release, but rest assured, something is likely to happen here at Peloton, potentially very soon before the company reports earnings.
And by the way, I was perusing the board of directors of the company this morning. In addition to Foley himself on the board, the president of the company, William Lynch, is on the board of directors. And there's a number of venture capitalists on the board as well. So for what it's worth, these are folks who, are sort of inside that ecosystem. So we'll see if they are receptive to some of this criticism as well. Another activist target this morning is Kohl's. And this is a little complicated because we're talking about a number of different activists and a number of different potential suitors for the company. So we've got various activists, including a company called Engine Capital. We have reportedly a bid for Kohl's from a company backed by Starboard Value, but not directly from Starboard Value, a company called Acacia, right? If I've got that right. And then Bloomberg is reporting that Sycamore is interested in bidding for Kohl's too. So there's a lot of different players in this one.
A lot going on here, Julie, you are correct, and really coming after that strong activist letter from Jonathan Duskin over at McKellum. Now, we talked to him last week on this transaction. He really blasted Kohl's again for just not doing anything since they originally targeted the company last year, not overhauling the company, not spinning off real estate assets that he values at close to $8 billion, not selling off the online business or even exploring that. Now, what Starboard has put forward, reportedly, here. And, a source tells me that this is a credible, legitimate offer that Starboard has put forward for Kohl's, $9 billion. And the pre-market price here on Kohl's suggests that something may get done, about $8.8 billion market cap for Kohl's, given the pre-market move, trading somewhat in line with that Starboard reported offer.
Yeah, and sort of where that's trading versus a Peloton shows you where we are in the process for that versus being at the very beginning of some kind of a process at Peloton. Well, those folks on the podium are smiling this morning, but you may not be if you're watching your portfolio and have been for this year to date. But as we were just hearing from Julian Emanuel, I mean, he's not pessimistic necessarily about the direction for stocks over the course of the year. And we've talked to a lot of other folks who feel similarly, right? That maybe we could see a lift in stocks by year end. It's just, it's feeling a little rocky here for the moment for investors who are long, particularly those who are long tech. Just wanted to talk about our last of the trio of activist targets this morning, and then we'll get into a little bit of a deeper market discussion with Jared. But Unilever is the third of these. Here are the U.S. shares of Unilever, which of course is based in Europe. The share's up 6.5%. Nelson Peltz and his Trian building a stake in the company and is pushing for change. Now, Unilever has had some issues, right? The company bid for GlaxoSmithKline's consumer unit, then ended up abandoning that bid because it said it didn't want to raise the price more. But the stock has really been battered by that whole process and that eventual abandonment of that. So it's not clear exactly what Peltz is going to be pushing for, but saw some interesting commentary, Saz, from a Jefferies analyst this morning that said the fox would now appear to be inside the hen house, and said that Trian will likely argue for splitting the food business from the household and personal care business. So we'll see how this plays out.
Yeah, if there are two activists you don't want knocking on your door at any time, if you are an executive management team that has shown a track record of underperformance like a Unilever has, that is Carl Icahn, and then secondarily Nelson Peltz over Trian. Now, the stock price of Unilever, and I go into this more at length in the morning brief newsletter on the Yahoo Finance site now, the stock's up 32% over the past 5 years versus a 93% return for the S&P 500. Procter & Gamble, another target over that by Peltz a couple years ago, P&G shares up 86%. Now, Peltz came in, I covered that situation. Peltz came in and really helped drive a lot of change and a new way of thinking for P&G. P&G restructured how it does business, and they have gone on to show really consistently strong profits ever since Peltz arrived at the company, as they just started better innovating inside the company, cut out a lot of layers of managerial fat, and are just doing better business. So I think the Peltz might be looking to repeat his P&G playbook here at Unilever.
Yeah, and to put sort of emphasize the point you were making, it may not be good news for the executives, but it could be good news for shareholders because of Peltz's track record here. All right, let's broaden it out and talk about what's going on in the markets today with this selling continuing. Our Jared Blickery is watching the tape and wincing perhaps a little bit this morning. I don't know, Jared, tell us what's going on.
I tell you what, Julie, it's another ugly start to a week. This is week number 4 in the new year, and it looks like the Dow on the Wi-Fi Interactive already off 400 points. And I was just checking out a slightly longer term chart of the Dow. This is a 2-month chart, and look at these series of negative red candles here. That is just something you don't see that often, especially not in a market that has gone basically straight up over the last year. But even the indices, the majors, are suffering quite a bit. Here's the Nasdaq Composite. Haven't seen a price this low since June of last year. So basically at a 6-month low in the Nasdaq, and the S&P 500, not looking that much better. And then you take a look at what's going on in the VIX. This is a reliable gauge of market volatility here. You see the VIX up to 33. Haven't seen these levels in some time, and it's just kind of par for the course here. What are we thinking about in terms of the major catalysts? Of course, we've been talking about the Fed. We have some earnings. We got Apple on Thursday. I have to think it's going to be all about the Fed at this point. And the big question is, have we reached peak Fed hawkishness? I think we have. I think Powell is going to deliver a little bit of a dovish surprise on Wednesday, but if he doesn't, these markets could definitely take another leg lower. The dips this year have not been bought. You take a look at what's been happening in the 10-year, all this bond market volatility, see the 10-year down about 2 basis points, that has been spilling over into the general markets. And then you take a look at what the Nasdaq 100 has done since the start of the year. That is ugly. We're looking at Amazon down over 15%, Tesla almost there with it, Facebook, Alphabet, Microsoft, Apple, each down more than 10%, Nvidia down 23%. And you take a look at the worst performers this year, it's not Peloton, it's Moderna. That's off nearly 40%. Then Netflix, then Datadog, then Align Tech. You got to go down the line here, all the way to the left to get to Peloton, which is still down a hefty 24%. So really ugly price action. And we are still looking ahead to earnings. I mentioned Apple this Thursday. We get Amazon, Alphabet, and some of the others next week. But here's the sector action. Here, energy up over 10%, had been up more than 5%, but that's the only sector in the green for the year. Here we see staples as the only sector in the green for today, guys.
And you were talking about energy just a second ago. This has been an area that's been popular with investors, right, who are looking at the value trade. And speaking of earnings, we got Halliburton this morning, which is raising its dividend. That's not something we've been hearing about too often from big oil.
Exactly. And that's because they can. They're in a decent financial position to be able to do this. And all of this is predicated on higher oil prices. But let's dig into some of the numbers here. I do have some analyst commentary about that dividend raise. Here's Piper Sandler. They recommend the stock with an overweight price target of $34.25, saying the results beat expectations across the board, and the dividend increase underscores Halliburton's capacity to accelerate deleveraging and shareholder returns. And I also have a comment from Cowen. They rate the stock in outperform with a price target of 33, saying completion and production operating income missed Cowen's estimate and margins declined from the third quarter. We'll be looking for CMP guidance and what kind of margin uplift comes from price increases implemented during the first quarter. So even Halliburton faces some margin pressures, as is just about every other company on earth right now. And you can see here's what the stock has done over the last year, but take a look at the max chart. You're going to see a lot of volatility in here, well off of its highs from about a decade ago, guys.
Very interesting. Well, it looks like that dividend boost could get some new investors in there this morning. Thanks so much, Jared. Appreciate it. Another area where we have seen heavy selling, of course, is in the crypto complex. And we're going to come back and talk about what's been driving it and how far perhaps it still has to fall. We'll be right back.
Bitcoin bulls are licking their wounds for another day after a brutal weekend for the benchmark crypto. At current levels, Bitcoin prices have lost an astounding 52% from their November record highs. Yahoo Finance cryptocurrency reporter David Hollerith joins us now. David, so we talked to you on Friday. We asked you what your sources were telling you on the sell-off. You said, guys, my sources are not seeing buyers step up here. So what are you hearing this morning?
Well, I'm hearing a little bit of short-term good news and long-term bad news, Brian. Do you want to hear the bad news or the good news first?
Bad news. It's the kind of mood I'm in. Fire away.
So I think bad news, if you're looking at cryptocurrency, not as a risk-on asset, but as an inflation hedge, there's an argument to be made for the cryptocurrency. If you look at its past 4-year cycles, which there have only been 2 of them, so we don't have a lot of data there yet. There could be drawdowns in Bitcoin that are significantly worse than this, like coming later in the year. Now, again, a lot has changed. We don't know if this time really is different or not, but that is something that can be calculated according to its 4-year halving cycle. Now, we are thinking of Bitcoin as something that institutions have adopted in a broader sense, meaning it's trading more like a risk-on tech sort of stock, and so is the rest of cryptocurrency more so. I think after a drawdown like this that we saw starting on Thursday night and then going through the weekend, I think we can expect maybe a little bit of a bounce or a rebound depending on what happens at the Federal Reserve's upcoming meeting on Wednesday.
Hey, David, I wanted to ask you about the sort of relationship between the cryptocurrencies, the sort of big ones, and everything else. In other words, we've had this big decline there, but at the same time, we've had a seeming explosion in the NFT space, for example, and also in interest in central bank coins, for example. So the people you talk to, what's the coexistence of crypto with, say, the NFT market? And how long can crypto remain down when there still seemingly is demand for some of these other types of products?
Yeah, Julie, that's a good question. And I don't think it's been quite as explored. The underlying understanding with NFTs is that you still have to pay transaction fees to obviously transact NFTs and then also create them. So transaction fees presumably decrease when the price of their underlying token, in most cases, Ether on the Ethereum blockchain, also decreases. So we could see sort of a boom of more NFTs coming. Now, as far as what that means for the value of NFTs more broadly, it's sort of still unclear about how they're related. However, over the past 2 months, we have seen a break in correlation between NFTs and underlying base assets like Bitcoin, Ethereum, Solana. So I think another thing that's worth noting is that Solana, one of these higher trading crypto tokens that powers the contracts that sort of allow NFTs to exist, has also been having some transaction problems recently since this drawdown on Thursday. So that's something to underline. If we see more technical problems with the underlying blockchain, NFTs probably won't have as much success. But again, that's sort of a short-term thing that we're still looking at right now. I mean, I think the ultimate case for NFTs and cryptocurrencies is not going to be determined this year.
All right, David Hollerith on the pulse of all things crypto for us. Thanks so much, David. All right, small cap stocks are trading at a more than 25% discount to large cap stocks on a price to earnings ratio basis, says Bank of America researchers. And of course, this is our Yahoo Finance stat of the day. This is below the COVID-19 lows and their most attractive levels since 2000. And it's likely that discount gets even wider, just given today's market action. All right, while tech stocks have been hammered in January, pros say the fundamentals are still in place for many of the biggest names in the space. We'll have more on this straight ahead.
We've been talking a lot this morning about the selling that's been occurring in the technology sector. Now let's talk about what that's going to mean for deal making and financing in 2022. Ted Smith is with us now, Union Square Advisors co-founder and president. Ted, thanks for being here. So obviously, there has been a lot of volatility within the technology sector thus far this year. Do you think that is going to force some decisions, perhaps, on the part of tech companies in terms of consolidation, for example, this year?
Well, first, Julie, thanks for having me. And we certainly do think it's going to be an interesting year in tech, as last year was. As everyone knows, last year was a record for technology M&A with more than $1 trillion worth of activity, up well more than 50% from the prior year. And we see that continuing in 2022. Corporate balance sheets are full. There's a lot of money in private equity and venture capital funds. And despite the volatility in the market, perhaps, we continue to think that deal activity is going to be incredibly active during the coming year.
Ted, how hard is it to determine fair value for a lot of these tech names ahead of what will be perhaps a longer term interest rate hiking cycle?
It's a good question, Brian. What we're seeing is obviously in the public markets with all the volatility that creates day-to-day challenges. Although we think that's going to settle out here as we get through sort of the next wave of Fed decisions. And this round of earnings, which are obviously starting this week with a number of names, including Microsoft and IBM. In the private markets, it's a little more difficult because obviously the private market valuations in some ways are pegged to those same public market valuations that we've seen so much volatility for. But again, as we see public markets settle out, at least our belief as we move later into the first quarter, we're going to see some better ability to fix valuations in the private markets.
You know, Ted, this is, I guess, more of a touchy-feely question, so to speak, but you talk to a lot of executives. How are they feeling right now as we're seeing this challenging macro environment? I mean, the investors in the market who we speak to certainly don't seem panicked. They might seem concerned about growth areas, but they don't seem panicked. What about executives?
I think that's a similar view at the executive level. Certainly, everybody keeps one eye on the market, and we've all seen this volatility over the last few weeks and depressing valuations, which, as everyone I think knows, also have been on the rise for a number of years, and so not so unnatural to see some compression here as we move into a slightly different cycle. However, most tech executives with whom we speak feel very bullish on the prospects of their companies. Feel very good about how they came out of the challenges of the pandemic and the resilience that those companies showed over the course of the last year and a half, 2 years. And so most of them are feeling quite good about the medium and long-term prospects for their individual companies, but acknowledge that the near-term, at least stock market challenges, to the extent that those have an impact on their companies, may make for a bit of a bumpy ride.
And speaking of bumpy ride as well, something that has sort of receded into the background, but it promises to rear its head again this year, is regulation. And whether that's regulation of large cap tech in terms of social media and how we view these types of companies, or maybe a bit more critical eye that regulators are taking towards mergers. What's the feeling around Washington right now?
I think generally speaking, the feeling is that it's still pretty much business as usual. Certainly the largest players are going to be under increased scrutiny and will continue to be so. So the Metas, the Microsofts, the Googles will certainly have that increased scrutiny as we go forward. That doesn't mean they can't get transactions done. It just means they may take longer, or that the larger ones that they might desire to do are going to be more difficult. But for the vast majority of the tech landscape who seek to pursue M&A, we believe that this current administration and the focus that they have will still allow for quite a bit of merger activity. And it's really only the very, very largest of players who may be affected by the stance that the administration is taking.
Where do you see deals happening, Ted? Just given where valuations have fallen really across the spectrum of tech, is it more towards the software side or the content side?
I think we certainly see it across the entirety of the tech spectrum, but a tremendous amount of deal activity in software is our expectation. It's continues to grow faster than any of the other sectors of technology. It's nearly $500 billion in global annual spend across all of enterprise software. So a tremendous amount of transaction activity in software we think is going to be the norm again for this year.
Ted, thanks for being here. Really interesting stuff on what's going on within technology. As we see this selling, good to take a step back here. Ted Smith is Union Square Advisors co-founder and president. Appreciate your time this morning. Well, we're just getting into earnings season here. This week is going to be another busy one. Brian Sozzi is going to talk to us about how companies have been reacting to the numbers thus far. It's not great. Little hint there. We'll be right back. Well, the selling that we've seen in the markets has coincided with the beginning of earnings season. Coincidence or not? Brian Sozzi, I suspect not.
No, this earnings season, Julie, shaping up PU, just really stinky across the board. 64 S&P 500 companies have reported thus far. And Goldman Sachs chief U.S. equity strategist David Costa noting only 6 companies in the S&P 500 have even stepped up to provide formal guidance for the first quarter. Really goes a long way to showing how just terrified executives are in this environment of the pandemic, inflation, worker shortages, you name it. Costa also noting 5 of the 6 companies have guided below consensus earnings estimates for the first quarter, including 3 companies that actually came out and beat on their fourth quarter estimates. The only beat and raise story, and what does that mean? That means when a company beats on earnings and raises guidance for this current quarter, the only S&P 500 company that has done that so far is chip giant Micron. And of course, we're still, the market's still trying to figure out what to make of that Netflix quarter last week, Julie. Stock down 24% on Friday, seeing the weakness continue in today. A high multiple tech stock, not a good environment to be in when the market is worried about these types of stocks, but also look, Netflix showed a disappointing quarter in terms of quarter-over-quarter growth. And of course, their first quarter outlook disappointed many. And look, we're showing right now Netflix shares under pressure yet again, down 6.5% so far in today's session.
So the question is now, with stocks having fallen so much, particularly tech stocks, is the setup now a teensy bit better going into earnings for some of the large cap tech because expectations are just down in the dumps? Although, on the flip side, Netflix was falling into its earnings report too. So, it's all an expectations game, of course. Our expectations.
Well, as you know, Julie, I don't make predictions on stocks. You know that. Predictions on other things. But I will say this. Don't fight, don't try to catch a falling knife. That's something I learned early on in my career as an analyst. If you want to try to step in here when you're seeing entire market sentiment shift really negative and try to pick bottoms on tech earnings. And in this week, ahead of earnings from Tesla and Apple, which might show in many respects the same things that Netflix showed last week. Good luck with that. You don't want to, in this market or in this type of market tape, I wouldn't be fighting that.
But as I always say, it depends upon your time horizon. If you're trying to buy now to get a quick pop on earnings, maybe not. If you're buying now,
I can't figure you out, Julie. You
for
told
the
me no
next
predictions. I can't figure you out.
It's not a prediction. It's just a counterpoint. That's all. That's what we do. Point, counterpoint. All right. Here's a point and an important one today. We are seeing this sell-off deepen. The S&P 500 is set to enter a correction that is 10% down from its recent high. Of course, the Nasdaq already got there. But the S&P now down almost 2%. The Dow is off 568 points right now. We continue to watch this selling, and we'll be right back.
Welcome back to Yahoo Finance Live on this very busy Monday morning. I'm Brian Sozzi alongside, as always, Julie Hyman. We are seeing whipsaw action in the markets to kick off what will be a heavy week of earnings reports, headlined by Tesla and Apple and a key Fed decision on Wednesday. All three major indices are deeply in the red 30 minutes or so into the trading session. We also continue to carefully watch Bitcoin prices. After a brutal weekend for the crypto, Bitcoin prices are now down more than 50% from their November record highs. Now, here are a few other things we're watching for you at this moment. Beware of the activists. Unilever and Peloton are in focus this morning as activist investors push for big changes at the companies. In a scathing new letter, Peloton's new activist Blackwell's Capital is demanding the immediate firing of CEO John Foley after the stock's 83% one-year crash. And Unilever finds itself under attack from Trion's Nelson Peltz after 5 years of poor stock performance in a bungled acquisition. And on sale, Kohl shares are surging and is the top trending ticker on the Yahoo Finance platform after activist investor Starboard reportedly offered $9 billion for the company. Kohl's is also reportedly seeing interest from noted retail investor Sycamore Partners. And inside the Rust Belt, we'll chat with the CEO of Ohio-based Huntington Bank shares after the company's latest earnings and on news of Intel building a new large chip plant in the state. But first, let's get over to Yahoo Finance's Inez Ferre, who is manning the Wi-Fi Interactive for us this morning. Inez, this is a real ugly session so far.
Very ugly, Brian. Let's take a look right now at the Dow. It's down more than 600 points. The S&P 500 down 2%. In fact, the S&P 500 falling 10% from its January 3rd peak, and the Nasdaq down more than 2%. I want to also point out the Russell 2000 down more than 1.5%. It's about 19% at or near 19% from its November highs. So definitely in a bear territory there. Also, every day last week, the Russell, the small caps, had been down at least 1.5%. I want to take a look at the Nasdaq 100 because we are seeing continued pressure on tech. I want to mention Amazon down more than 1%. Amazon now at 52-week lows. Also, Tesla down 7%. Tesla had been a bit of a holdout here among the big eight on the S&P 500, now trading at around $876 a share. Also want to mention in the EV space, we're watching Ford down more than 5%. Ford announcing that it's pausing its orders for the Maverick pickup that's priced at $20,000 because the automaker says it just maxed out on what it can build, and those orders will resume in the summer. And then looking at the retail space, I know you mentioned Kohl's. In fact, one of the very few names here that is in the green, down, up more than 31%. That's its most daily gains on record. Also want to mention what we're seeing with Macy's and Nordstrom off of that Kohl's headline that there are a couple of suitors looking to buy Kohl's. So some of these retail names today seeing some green. Brian?
All right, thanks so much, Inez. All right, we'll stay on these volatile markets here. Mark Lopresti is managing director at the Strategic Funds and joins us now. Mark, nice to see you here. Look, you're going to get a lot of people out there on the street and even the retail investor wondering if now is a time to buy these beat up tech names and increasingly some names on the S&P 500. What say you?
Well, it's certainly a plethora of pain for investors here this morning with markets deeply in the red. I would be, to address your question, I would be very reticent to look at getting in or adding to positions in just about anything, Brian, before we hear from an increasingly hawkish Fed on Wednesday. Look, this is really what has investors jittery. Was plan A from Chairman Powell too little, too late? And can we maintain confidence in the Fed's ability to effectively govern monetary policy in this challenging environment?
Hey, it's Julie here, but with this happening in the market, how is the Fed going to be more hawkish than it's already been? I mean, I just don't understand. Like, what really is the market afraid of? What is the Fed going to say that could cause more selling here? Come on.
But additional, as you heard from Goldman this morning, the possibility of going from 4 to maybe 4 or more rate increases, possibly going from 25 BIP to 50 BIP. And it's not even so much about the numbers, Julie. It's about whether or not there's a plan. The market reacted positively when Chairman Powell came out earlier and said, in the beginning of the year, and said, look, we're going to increase the rate of the taper. This is what we're going to do in terms of hikes. We think this is going to be an effective inflation mitigant. And guess what? Omicron slowing the reemergence from this wonderful COVID pandemic we've been dealing with for 2 years. Geopolitical concerns now coming onto the scene. Russia and Ukraine, missiles over Abu Dhabi reported this morning. There's just too much going on.
Well, but that's kind of what I'm saying here. Given all of that, how could I mean, look at this Fed. Look at the history of this Fed and its reactiveness to prevailing conditions, including prevailing market conditions. Do you really see Jay Powell coming out here and being more hawkish in the face of a Nasdaq and S&P 500 correction?
I certainly hope not, but I think that's where the concerns lie, right? Is that the Fed may become even more reactionary. And the hope is there will be consideration of what the market is doing. Certainly, the market is telling the Fed right now, we don't like what's going on. So it's very hard to predict, but that's where the concerns lie, in my humble opinion, right now. It's all around Wednesday.
Well, Mark, let's say the Fed comes out here in March and drops the hammer with a 50 basis point rate hike. Where do stocks go then? In fact, where do stocks go in the near term if that turns out to be the prevailing view from March, just given what we're seeing with inflation?
Yeah, I mean, listen, unfortunately, and I hate being a bear. I was saying this to some friends last night. I'm at heart a bull. But between that and what is clearly a disappointing earnings season with all the names that already reported, most companies even resisting providing guidance, I think we're going to remain in bearish territory for a while here, unfortunately.
Hey, Mark, you were telling us during the break you're at a hedge fund conference in Miami right now. Hope I'm not giving anything away there.
No,
this is supposed to be your time, right? I mean, when the markets are down, this is what hedge funds are for. So I'm just curious what you're hearing from your colleagues down there. Are people looking for opportunities here at a time when everybody else is running for the exits?
Well, listen, this is one of those times where the proof lies in the pudding, and whether paying for that 2 and 20 that investors pay to be in hedge funds really delivers on that protection or even that ability to find alpha in challenging environments. And it comes down to the strategy, right? I think macro managers are better positioned. They can pivot more quickly to actually provide some protection and to deliver some returns. Hedge fund performance, of course, last year relative to the market, rather lackluster, average, around 11-12% by most estimates. So I think the mood here is definitely a little bit nervous as there's going to be a challenging environment, certainly for the first couple of quarters. And tech hedge funds, my God, if you look at Cathie Wood and ARK by way of example, just taking a pounding on this value rotation from tech and risk assets into companies that produce things and have profits and dividends and return to shareholders.
Yeah, Mark, good point there on the tech funds. A lot of hedge funds have really strong allocations. They continue to these FANG stocks, other tech stocks, software names, you name it. I mean, are we looking at potential tech fund blowups here, just given all the pressure we're seeing on the Nasdaq?
Yeah, I mean, I don't think you can rule that out, Brian. It depends on how much leverage these guys deploy. But at the end of the day, it's difficult to pivot. If you're a tech-focused fund, hedge fund or otherwise, it's pretty hard to pivot into a value rotation or into energy and completely change your mandate, right? So I think you're going to see, as the funds report, December returns, January returns, I expect to be fairly abysmal for the tech-focused funds. And as I said before, I think that the macro guys, the managers who have the ability to pivot and to take advantage of the rotation into value and even into energy, I think energy is going to continue to have a great time here, certainly in the next couple of quarters of 2022. You're starting to see that play out even in the direction of stocks like ExxonMobil even here this morning.
All right, well, enjoy your conference and hang in there. It could be an interesting week. Marco Presti, Managing Director at the Strategic Funds. Good to see you. All right, we have to get another look at these markets here, guys. We're seeing the Dow now down over 800 points. The S&P 500, Nasdaq deeply in the red. Julie Hyman just flagging to me in our Slack channel. The S&P 500 is now in correction territory as defined as a 10% drop from a recent high, seeing significant pressure here across the markets here, in large part as investors fret about inflation concerns and what the Fed will do or say with regards to interest rates when it has its next meeting on Wednesday. All right, coming up, Wynn Resorts may be eyeing an exit from online sports betting. More on this coming up.
Selling is accelerating here on the major averages. The Nasdaq is now off by 2 3/4%. The S&P off 2.4%. The Dow is off by 2%. Some of this selling perhaps accelerating as we got PMI numbers that missed estimates. That's a purchasing managers index from market. On the manufacturing side, coming in at 55 versus a 56.7 estimate. Services, even worse, 50.9 versus the 55.4 estimate. Remember, 50 is the line between expansion and contraction. So services getting close to that level. So the composite number going to 50.8. I also have to flag the Russell 2000. Liz Ann Saunders, I saw on Twitter flagging this, and so hat tip to her for that. The Russell 2000 is now off by 20% from its high on November 8th. That means technically if it closes at this level in a bear market, that's as the S&P 500 is set to close in a correction. So a lot of various levels being breached today as we watch this selling occur. Let's get some other business stories that we're watching this hour as well. Casino giant Wynn Resorts reportedly trying to sell its online sports betting business at a large discount. That's according to the New York Post. The company is looking to unload its Wynn Interactive unit for a slash price of $500 million. That's less than a year after floating a $3 billion valuation for it. And this coming also after Wynn scrapped its November plans to bring Wynn Interactive public via a merger with a SPAC. Peloton is suffering yet another PR blow on the season 6 premiere of TV series Billions. One of the lead characters, Mike Wagner, spoiler alert folks, Wags as he's also known, he suffers from a heart attack while riding the bike. Fortunately, he does not suffer the same fate as Mr. Big on And Just Like That reboot of Sex and the City. Peloton took to Twitter to say the company did not agree for its brand or IP to be used on Billions. And Ford just launched a Raptor version of its Bronco SUV that'll go on sale later this year for a starting price of about $70,000. The new car looks similar to current models, but has a variety of new performance and off-road parts designed for desert racing. The company said the majority of its first new models will be offered to existing reservation holders as it looks to complete an order bank of thousands of reservation holders for current models. Well, Brian Sazi, over to you.
Hey, that's me. The U.S. State Department said Sunday it was ordering family members of diplomats to leave the Ukraine as tensions with Russia escalate. Yahoo Finance senior columnist Rick Newman has more on this. Rick, good to see you here. We're seeing the stock market really slide. I would argue because of Fed interest rate concerns, but there's a potential market risk here with this Russia situation in that maybe oil prices break through $100 a barrel.
Yeah, so a lot of times when we see these types of geopolitical tensions, markets get a little wobbly, and then everybody looks around and says, wait, is this likely to affect financial markets in any way? And the answer is no. Not quite the case here, because if Russia does make some sort of move on Ukraine, there probably will be US and European sanctions. Those could relate to the financial system and not so much oil markets. But look, Russia is a huge oil producer and also a very large natural gas producer, most of that exported natural gas going to Europe. So if there are some kind of sanctions, or if Russia were to try to weaponize energy in this case by, for example, withholding natural gas shipments to Europe, that could directly affect energy markets. So traders and investors definitely need to be thinking about this.
Well, and let's talk about, there is the direct sort of linear effect of some kind of conflict. There's also, of course, the psychological effect here, because there was a report in the New York Times this morning that President Biden is considering sending troops to that area of the world, to Eastern Europe. And, markets do not have a consistent reaction to military conflict around the globe. But it seems like in this current environment, just one more thing like this is not being happily received.
Well, in the big picture, Julie, we're talking about the potential for a land war in Europe. I mean, that's what could happen here. My best guess is that this was just a trial balloon from the White House or from somebody in the State Department, just to see what the reaction might be to the thought of U.S. troops either in Ukraine or near Ukraine. My best guess is that is not going to happen. Let's remember, President Biden pulled the United States out of Afghanistan. Something he was in favor of doing for a long time. And it doesn't seem likely that he would wind down a deployment such as that and then put U.S. troops into some kind of confrontation with Europe with a very uncertain end state. So I don't think that's going to happen. But this is a very dangerous situation. Nobody knows if Putin is bluffing with all these troops, 100,000 troops or so massed around Ukraine, or if an invasion might actually be coming. So this is not something to be taken lightly. This is serious what's going on.
And it appears the market is taking it very seriously. To your point, Rick Newman, thanks so much.
Hi, guys.
All right, we're seeing the markets really under a lot of pressure this morning, and that even extends to what had been one of the hottest parts of the market. That is the financial space. You're seeing there on the screen, JP Morgan, Goldman Sachs, Bank of America, Citigroup, and even Wells Fargo, all under pressure here in this broader market sell-off. And still to come, we're live with the CEO of one of those bank stocks here, Huntington Bank shares, after the company's latest earnings. We'll also look at how a new Intel plant in Ohio may help the regional bank. Stick around. All right, welcome back to Yahoo Finance Live on this Monday morning. You're seeing a tough start to the week of trading on what will be a busy week for corporate earnings, headlined by the likes of Apple and Tesla. And of course, we have that Fed decision coming on Wednesday. The market is just really scared about all these things. You're seeing the Dow now down close more than 700 points. At one point was down more than 800 points. The S&P 500 and Nasdaq under severe pressure as well. All right, shares of Huntington Bank shares are trying to rally back after the stock got hit by 9% on Friday on the company's earnings results and broader market pressure. Let's dive into the company's outlook with Chairman, President, and CEO Stephen Steinauer. Stephen, nice to see you. Thanks for joining us on this very busy Monday morning. Look, we always look through the prism of the stock market here at Yahoo Finance, and we're seeing this pressure on so many areas of the market. What does it look like from you from an economic standpoint in this country? Does it warrant this concern that we're seeing in stocks?
Well, I think there's a significant overhang in Europe that's no doubt impacting this to some extent. And once things sort out on the Ukraine, hopefully in a very peaceful way, that's a major overhang that I think gets eliminated. The fundamentals look very good. As we said on the earnings forecast, we had a very strong finish to the fourth quarter, a big quarter for us, and a lot of pipeline, a lot of backlog coming into the new year. So we're quite bullish around loan demand, which is a reflection of the growth of the underlying economy.
And so, Steve, it's Julie here. If I could get you to expand on that just a little bit, in particular because you guys are based in Ohio, so you have a different frame of reference, obviously, than us coastal folk. And so I'm curious what you're seeing from your small business clients, from your consumer clients, in terms of their financial health, particularly given the fact that they are now not getting the federal aid that they were a year earlier.
Well, we're headquartered here in Columbus, but our commercial organization is headquartered in Detroit. And so we're really a broad-based Midwest bank. And as we look at our customers throughout the states, they're doing fairly well. There are some exceptions, but they're doing well. This 21 will prove to be a good year. And they're optimistic about 22 and moving forward. There's a lot of investment going in across the board. Our fourth quarter results were broad-based across all our geographies and commercial lending units. So that's really strong and encouraging in terms of the future.
When you talk to folks in the region, Stephen, what are their biggest concerns? Is it getting labor into those manufacturing plants, given everything we are seeing with the variant? Is it inflation? Is it a combination of those things?
Brian, the number one issue is labor. This is a constrained recovery. It's been this way for a year and a half, and 22 looks like that will continue. It takes some time to adjust the labor factor by innovation and by capital expenditure. And you're going to see that in the manufacturing environments in particular. But we are in a good recovery. It's a 3.5–4+% GDP expectation for 22, 2 times normal. And yet it's a labor constrained recovery. It would be much stronger if we had the labor.
Steve, I got to ask you about interest rates. Of course, we've got a Fed meeting this week. The net interest margin in your last report seemed to be the one area that some investors were focusing on as disappointing relative to their expectations. Right. How many times do you think the Fed is going to raise rates this year? And what is that going to mean for your business?
Well, rising interest rates are very good for our business. As we said on the earnings call Friday, we have 3 in the model. The current expectation is 4. There is some talk of not doing 25 basis points, but maybe a 50 at some point during the year. So the interest rate outlook, which is in part fueled by inflation, will continue to be an opportunity for us and other regional banks. Very bullish on what this means over time. And we're asset sensitive and increasingly so, which means as rates tick up, particularly in the short end, that will translate to additional revenue.
Stephen, 4 rate hikes potentially this year. You even have a lot of folks on the street suggesting maybe we get 5. What do you think that does to the economy?
Well, I think it has some marginal impact, but remember, we're starting off a historical low. It's a 0 to 25 basis points. Now, much of my career, I've been in very different interest rate environments than we've seen in the last decade, and the economy has done well. There'll be a period of adjustment, and then we'll move forward. I'm quite bullish about there's been so much investment in the U.S. There's been so much federal stimulus, in the U.S. The onshoring of jobs, the chip plant announcement last week is a reflection of that that's occurring here in Columbus or Central Ohio. So this bodes very well. I think we have an extended runway of really positive economic growth and opportunity for regional banks like Huntington.
Well, speaking of that investment, Stephen, that Intel plan, $20 billion initial investment could go up to $100 billion by Pat Gelsinger's team over at Intel. What does that mean for jobs in the Ohio economy?
No, this is transformational. This is massive. So it's not just those, if they do the 5 plants, which is the $100 billion, that is enormous. Think about this, $100 billion in a 2,000-acre site. But they'll also bring the other suppliers that are critical to them. There's another 40, 50 companies that will come in. And there's a co-location potential for other chip manufacturers because of the infrastructure build that's associated with this. It is a game changer. Pat Gelsinger has made a massive commitment, and I don't think we know how big this could be. If we look at Chandler, Arizona, a couple of thousand people that today's hundreds of thousands of people, that's the potential of what we're talking about here. So enormously important decision and an incredibly robust set of opportunities for us throughout Central Ohio for the next couple of decades. It's a game changer. And this is our headquarters. This is incredible, and we have lead share. This is incredibly helpful to us.
Well, real good to see these types of large investments being made in this country. Huntington Bank shares, Chairman, President, CEO Stephen Steinauer, good to see you. We'll check back with you soon. All right, before we head to break, let's look at some of these NASDAQ losers here. NASDAQ just continues to be under major pressure. Now we're showing on the screen Airbnb down close to 10%. Netflix down 8% after a 24% plunge on Friday after that company's disappointing quarter and outlook. And even the pressure continues on the software names like CrowdStrike and Moderna, a key player in the NASDAQ, also under major pressure. All right, coming up, we'll talk to Needham's Bernie McTernan on why he's lowering his price target on DraftKings. Stick around.
Well, we've been watching the sell-off occur this morning. It is off the lows a little bit for the major averages. The S&P is now down about 2%. The Nasdaq off 2.2%. It was down almost 3% just a little while ago, but bouncing around here in a pretty narrow range and still plenty of selling going on. One of the stocks that is down today, one of the many, many stocks that is down today, is DraftKings. Among other things, we saw an analyst cut his price target this morning on the stock to $46, but still, obviously, that's well above where it is right now. He still has a buy rating. That analyst is Bernie McTiernan of Needham & Company. He is joining us now. Bernie, it's great to see you. Good morning. So you're still bullish on DraftKings long term, but cut the price target. There's some interesting movement in the sports betting business. What led you to do this price cut?
Yeah, it was really us, recalibrating how we're looking at our stocks, frankly. Our methodology prior, which we still incorporate to some extent, was looking out at a out year adjusted EBITDA number, putting a multiple on it and discounting it back. Clearly, the way the market's trading right now and the amount that unprofitable tech is selling off, the market's not willing to look at stocks like that. It's much more focused on near term. So what we did is that we focused on what the near term growth and adjusted margins are, over the next 2 years, and weighted that higher in the way that we, in our price target multiple for the stock. And that's really what drove the target change, because everything that we're seeing from the estimate side seems really strong. I know we want to talk about the New York launch, but New Jersey numbers are still really strong. December data came out last week. That market opportunity still implies, on a per capita basis, implies a $27 billion US market opportunity for online sports betting, given if there's 100% legalization. That's above our $22 billion expectation. So, again, we're still really bullish on the space, but clearly the market is changing in terms of what they're, valuing growth versus profitability, and we want to update our price target accordingly.
Bernie, you think the market is just too concerned about higher interest rates and their impact on growth stocks like DraftKings? Just listening to you, it sure sounds like there are some positive catalysts to companies like this.
Yeah, well, one of the big questions is, will these guys ever make money? And that goes across the space in general. We don't have DraftKings achieving profitability until 2024. And it's really because all these new state launches it's a new market. So they're going to go in like New York, invest a lot of money, acquire customers, and they hope that they've given us data last year at their investor day showing that relationship they establish is sticky. But there's just an investment cycle that has to go on as all these new states launch. If the company never launched in another state, we would see that profitability tick up a whole lot quicker, except the TAM would be a lot smaller too. So we see a real reason for the lower or negative profitability now, or lack of profitability now, and a reason why it can change in the future. The company has already said that they're profitable in New Jersey, and then BetMGM had an investor update last week and said they're already profitable in New Jersey and profitable in Michigan as well, given their success in iGaming. But again, this isn't a market that wants to look at, sum of the parts or out year profitability, or really, jump through any hoops to get through what the price targets are. It's, what are you earning right now? And because of how new the online sports betting and iGaming markets are, these companies aren't generating profits.
Bernie, I'm like many. I was up late last night watching a lot of football games. It was a tremendous weekend for the NFL, but look, no Tom Brady on the Super Bowl, no Josh Allen in the Super Bowl. Do you think that will have an effect on Super Bowl betting, and then by extension on the likes of DraftKings?
There's still Patrick Mahomes, who's probably the biggest superstar in the space. I think they're 6.5 point favorites to go to the Super Bowl. So no, I don't know. If the ratings are down a little bit or not, this is a big long-term trend that's happening. And that's one of the most exciting trends in this industry, really, is the convergence between sports betting and sports media. It's continuing to happen. You're seeing it in the broadcasts more. I mean, ESPN has really changed the way that they're viewing sports betting within the organization, which I think is, emblematic of how this industry is changing in that relationship. So, long term, we think, we're not concerned in terms of one Super Bowl or not. It's just one day for these companies, but it really highlights the long-term convergence between the two is going to be a big driver of that TAM. And I think one of the reasons too why you're seeing, the Arizona launch was the fastest launch earlier this year. Then New York's faster. I think that the reason why these states are launching so quickly is because more people are being introduced to sports betting because they're seeing it on their TV screen or on their phones.
Hey, Bernie, you were just talking before about investment that these companies are making, and I know a lot of that is in the form of promos, right, to get customers in the door. I'm also curious about M&A. There was a report in the New York Post that Wynn Resorts is trying to sell its Wynn Interactive unit at a big discount to where it was valued just about a year ago. Could DraftKings be one of the takers for a property like that?
Well, the historical precedent for DraftKings is that they look at everything, right? And so there was the rumor that they were going to buy, or not the rumor, that they were holding talks with Entain. That was kind of the original sell-off in DraftKings shares. They bought Golden Nugget Casino. There was I think the information or the New York Post report that they were looking at The Athletic too, that was bought by the New York Times. So DraftKings, I think their motto is to look at everything. What I think that the asset is at WynnBET is really, could it be their customer database? And that was so interesting for DraftKings with the Golden Nugget acquisition, is to get their hands on these customers who spend money gambling at the Golden Nugget resorts. And then DraftKings is a tech company that uses a lot of big data and analytics to go out, like they do with their daily fantasy customer base, to go convert those into online sports betting customers. So they bought Golden Nugget to convert the brick and mortar customers into iGaming. So if there could potentially be that same opportunity for WynnBET, I haven't seen, I don't know how much they have in terms of a database, but I think, databases are really, they're a huge asset in this space. So I think that would be a reason why they could potentially be an M&A target of a company out there.
Finally, Bernie, I do want to switch gears for a second and talk about betting of another sort, and that is whether traders, investors want to gamble on Peloton right now and come in and buy the
nice
stock.
Segue, yeah.
I tried, a little tortured, but I tried. The stock is up a little more than 1.25% this morning on this report that there is this activist that is pushing for changes at the top of Peloton. How likely do you think it is the Blackwells will get their way in that? And is that a catalyst for the stock? Would that be something that could push Peloton higher?
Yeah, it's certainly a great question and getting a lot of focus right now. John Foley, founder, CEO of the company. I don't know if what his intentions are or not. I think we'll learn a whole lot more in a couple of weeks here when they report earnings. And I think the challenge for the management team is that they need to really pivot from being a hyper growth company to now where they're not in that part of the S curve anymore. Or at least it seems like that way. And certainly near term, they're not going to be that way. So what does that mean for cost cutting? This is a company where you've really had the cost structure balloon over the last few years in terms of R&D and G&A. And so now the company currently is adjusted EBITDA negative. We think they're going to get to profitability in the second half of this fiscal year and into 23. But there's, the company's trading at about, 20 times our fiscal 24 adjusted EBITDA estimate. That drops down to 15 times if we just hold our R&D and G&A budgets flat. So moving from valuing this company on a sales multiple to an EBITDA multiple, I think is something that they need to work through. And that's, that transition from being a growth stock to a value one is never an easy one. We kept our buy rating on shares just because we thought the risk reward for valuation was just way too encouraging. We think the absolute floor should be about 1 times revenue. That would put the stock at $15. But that 1 times revenue is where hardware comps are trading, like where Fitbit got taken taken out by Google or where GoPro is currently trading. Really, the upside for the stock is that they have $1 billion of trailing 12-month subscription revenue. Those subscribers are like, it's like postpaid wireless with the churn. It's sub 1%. So if you look at software comps, even though those comps have come in quite a bit, our peer group that we value it against are trading at 15 times. That would be a $15 billion company if it had that. If it was trading at those ranges, which would still represent substantial upside from here.
Yeah. Well, we'll keep watching it to see where the re-rating stops. It's paused for today, at the very least. Bernie McTernan, thank you so much. Good to see you. Needham & Company Managing Director, Bernie McTernan. We're going to take a quick break. We want to take a look at some of the biggest Dow losers before we go there. We've got Disney trading off by more than 4%, almost 4%, I should say, leading the pack downward. The Dow bouncing a little bit off the lows of the session. Also want to check on cryptocurrencies as we go to break, because we have been seeing the selling not really alleviate too much on that front. It's backed off a little bit here, but still we are seeing a tumble across the crypto space. Coming up, we're going to talk about the future of NFTs on a crypto-related front and live events with Yellow Heart founder and CEO Josh Katz.
All right, welcome back to Yahoo Finance Live on this Monday morning. Seeing stocks continue to be under pressure, though off the worst of the session, seeing the Dow down more than 500 points. At one point in the session was down more than 800 points. The S&P 500 and Nasdaq also deeply remain in the red. All right, the surging NFT market could change how you order tickets for sporting events and concerts. Let's talk with a key player in the space. Yellow Heart founder and CEO Josh Katz is here. Josh, nice to see you. I'm generally fascinated in how the ticketing industry will be changed because of NFTs, but we have to start first on sentiment here. Have you seen any or sensed any change in enthusiasm over the potential for NFTs, just given what we've seen in Bitcoin really selling off here?
No, not really. You know, the people that are deep on NFTs and in the space believe in it long run to really bring up what's called Web3 forward, and having a sudden pullback in crypto doesn't affect the long-term plans around NFTs and their utility use.
So, Josh, explain to me what NFTs does for the space. I know you're focusing mostly on the music side of the equation, and for a long time, musicians have sort of wanted more control over how things work. You saw that several years ago, maybe it was even a decade ago now, when Radiohead did a sort of pay what you want for their album. Is this then the latest iteration of that, and what does this do for artists?
Well, what this does for artists is so much, because NFTs and the blockchain that they live on create what's called provable scarcity and provable ownership for the first time. So what this does is it really empowers artists with transparency around sales, eliminates the need for middlemen, because if you think about most artists, they really get to their fan base through social media. Once fans learn about music or tickets or something else, they now need to go to a third party to make the purchase. What NFTs does is it allows the artist and the fan to have a direct symbiotic relationship without middlemen.
And what does it do on the ticketing front? Like, how exactly does an NFT work to buy a ticket to a live event?
So right now, a ticket is a barcode. If it's a proof of entry, it's a receipt. What an NFT does is it really brings a ticket to life. It actually creates a long-term engagement between the fan and the artist, and it has provable scarcity that there's only so many tickets to see, say, Coldplay, and I was at that event, I could prove it, and then it gives the long tail engagement for the fan and the artist to continue engaging, and the artist to continue giving the fan utility, access, membership, all types of things. So when the person walks out of the venue, the artist does not lose connection with them. It actually just begins.
So Josh, is it like if I go to a concert or a series of concerts, is it almost like I'm investing in myself? Because I imagine at some point, perhaps I can go to an NFT marketplace and sell my ticket stubs for my past 15 concerts.
Exactly. So think about ticket stubs. Think about a Woodstock ticket stub, a 69 Men's ticket stub. These are very valuable. For the first time, we'll have provable ownership, provable authenticity on these on what's called an immutable blockchain. So the new version of tickets, though, aren't just the receipts or proof of entry. They have media embedded in them. They have access to future events, access to fan clubs, access to merchandise, access really to anything the artist could think of. And it just opens up basically a connection between the fan and the artist to really give the artist more commerce opportunities with the fan, and the fan the ability to be direct with the artist, really without anyone standing between them anymore.
As you sort of alluded to, there is a big market for music memorabilia, and I believe you guys just had a drop today in partnership with Julian Lennon. What is it? What is the stuff that is being sold, and what kind of demand do you expect?
So yeah, we just announced this morning a drop called the Lennon Connection, which is Julian taking possessions that he was given by his father, including the original lyrics for Hey Jude that was written about Julian. It was originally called Hey Jules. And we made one-of-one digital pairings, what's called physical digital pairings, where there's now provable that there's a one-of-one digital representation of these goods that are going up for sale in partnership with Julian's auction house. So we partner with them on that and with Julian, and it's a very exciting auction. And this will be how memorabilia is sold down the road, where you have provable ownership through a certificate of authenticity, that this is a real and tangible good, showing that it's actually authentic. Whereas in memorabilia and many other spaces, you've had rampant fraud, and this really eliminates that.
Interesting stuff. All right, Yellow Heart founder and CEO Josh Katz, good to see you. Have a great rest of the week. All right, and before we go to break, let's take a look at some of the trending tickers right now on Yahoo Finance. And it's a who's who of big names. Seeing Tesla shares get hammered here ahead of the company's earnings later this week. Kohl's up big time as it looks to be multiple bidders involved for Kohl's. Chief among them, Starboard, Neo, another high multiple stock here getting slammed as well. Halliburton under pressure, and Palantir, again, another high multiple tech stock that continues to sell off in this risk-off environment. And we'll be back with a few final thoughts on the markets. Stick around.
Selling continuing here for the major averages, although we are off the lows of the session. Nonetheless, it is an alarming tumble for some investors, coming as it is on the top of what already has been selling in the markets. If you take a look inside the Yahoo Finance Interactive, our Jared Blickery just flagging what's going on in the volatility index. Now, the VIX, of course, is a reflection of what's going on more broadly in the market and the volatility that's out there. So it sort of holds up a mirror to the volatility that we're seeing. And as he pointed out to us earlier today, the levels where we're seeing the VIX today is at the highest it's been since about November of 2020. So that perhaps alarming to some investors, again, as a reflection of what has been going on. Something else we've been watching has been the Russell 2000. Here's the 3-month chart of the Russell. If you go back to November 8th and map the downdraft that we've had since that time, it's a 20% drop. And that means that the Russell, if it closes at those levels, is technically in a bear market. So the selling has been especially acute. You know, we talk about big tech all the time, but the selling has been more acute within the Russell 2000 here than it has been within large cap tech. Now, speaking of large cap tech, let's take a quick look at what is going on that front. We've got Tesla down the most of the largest companies here, but everything, as you can see, is in the red. There are a few green spots here and there, particularly it looks like in telecom and cable within the Nasdaq 100, but they're few and far between. We've got Bitcoin selling off not as heavily as it was earlier, but nonetheless still off by nearly 3% and just above 34,000. So, Saz, people have their places to pick from today in terms of risk aversion and how that's being expressed in this market.
Yeah, and real quickly, Julie, you mentioned the word alarming, and I'll tell you what I find alarming is this action in Netflix down 24% on Friday after that company's disappointing quarter, and outlook down another 8% in the pre-market. No buyers stepping up to buy Netflix shares after a 24% plunge on Friday. I think it says a lot about market sentiment right now into this Fed meeting.
Yeah, that stock is now down 39% year to date. That does it for Brian and us. We need to go take a nap, clearly, after that 2 hours that we just witnessed. Kiko and Brad going to take you through the next 2 hours of trading. Brace yourselves, folks.
Welcome to Yahoo Finance Live on this Monday. I'm Akiko Fujita along with Brad Smith. We've got an ugly start to the week here as the Dow falls more than 600 points. The Nasdaq seeing the steepest losses so far in this session, down about 2.5%, and we've got the S&P 500 off about 2% here following its worst week since March of 2020. Investors watching a key policy decision from the Federal Reserve as the FOMC kicks off its two-day meeting tomorrow. We've also got a crypto sell-off here. Bitcoin falling to its lowest level since July of last year, now down 50% from that record high set in November. And activists dialing up the pressure. Shares of Peloton moving higher as one activist investor group calls on the CEO to step aside, while Unilever gets a bump on reports Tran Partners is building up its stake in the company. We are beginning this hour, though, with the market moves, a sell-off on Wall Street with stocks extending their losses from last week. The Fed firmly in focus. We're going to get to Brian Chung on that FOMC meeting in just a bit, but let's kick things off with Jared Blickery on the moves we're seeing so far in the session today. Jared.
That's right, Akiko. What another start to another week, the fourth one this year. And let's take a look at the Wi-Fi Interactive. I've been charting the price action on a year-to-date basis. Here's the Dow, and you can see just really falling off of a cliff here. The losses really accelerating to the downside over the last few days. There are some technical reasons for this, but sometimes selling just begets more selling, and any attempt to buy the dip has just been met with a lot of force in the other direction. Now, also want to show the small caps. This is the Russell 2000. I'm going to put a one-year chart on, and we are on bear market watch for the Russell 2000. We already reached the magic level earlier today. I think it's 1951 and change, but it would take a close at that level or below to officially generate those headlines. And then let's take a look at the VIX, because we're seeing some of the highest levels that we've seen in months here. Now, we took out that November, December spike here, and we are back to the levels seen not seen until last March. So really picking up on the fear index as well. Then you take a look at what's happening in the bond market. We have the 10-year, the 5-year T-note yield cooling off a little bit. This is a 2-month chart. It is down 3 basis points today, continuing the down move from last week. And then the 10-year T-note, that is down 2 basis points as well. And finally, we got to take a look at the US dollar before we get to our heat maps. That is crawling back into the territory that we saw back in early January and also in December. Let me put a 3-month chart here. I think this is important. Dollar had been basing sideways, then it broke down, and it looks like this was a false breakdown because we are right back up. So pretty interesting to chart that here. Now, as promised, here's the Nasdaq 100, and it is an ugly picture. We got Tesla down 6%, Microsoft and Alphabet each down more than 3%, Nvidia getting hit 6.5% down. And you take a look at the sector action, nothing in the green today yet again. Tech taking it on the chin, actually just switching places with materials as the worst off sectors, and that is as the US dollar is rising, putting pressure on commodities. Also seeing healthcare down over 2%, so is consumer discretionary, financials, energy, and the list goes on. Want to take a look at the travel sector here. A lot of red on this screen as well. Carnival Cruise Lines off more than 5%. Hilton down 3.5%. Airbnb down 10%. And we got to take a look inside the ARK Innovation Fund components. A lot of red, a dark red on your screen here. And want to kick it off to Brian so we can get his thoughts on what's going on here, guys.
Well, we could get some more choppiness ahead of the headlines for the big event happening from the Federal Reserve this Wednesday when we will get a new policy announcement from Fed Chairman Jay Powell with regards to the stance of monetary policy from the world's most important central bank. Now, of course, that meeting is going to start tomorrow. We won't get the decision until 2 p.m. on Wednesday, but keep in mind, it's really all about the messaging on how fast the Fed wants to tighten in the face of 7% year-over-year growth in inflation. And when you take a look at that dot plot projection, again, where the policymakers on the 18-member FOMC see policy rates going over the next few years, they were telegraphing in mid-December that we should expect to see possibly 3 interest rate hikes by the end of 2022. But just in the weeks since that meeting, we've already gotten more hawkish commentary from even more dovish members of the FOMC, suggesting that maybe they would want to boost up the amount of tightening that they have projected in that last meeting. Now, of course, we're not going to get a new set of dot plot projections in this meeting this week, But it is notable that in that press conference, it's possible that Jay Powell could suggest the Fed might want to move more aggressively on the way that they want to tighten the spigot on that pandemic era money printing policy, which led the likes of Goldman Sachs to write over the weekend, quote, "We see a risk that the FOMC will want to take some tightening action at every meeting until the picture changes on inflation." Now, of course, right now, policy rates are at near zero. If they did make a move in every single meeting, that could be 8 possible policy moves because there are 8 policy setting meetings this year. Again, this being the first meeting of 2022 could set the tone for that. But remember, Fed balance sheet very much going to be in focus. The Fed needs to wrap up its pandemic era policies of openly buying assets in the market before they start to raise interest rates. That process won't be done until mid-March, which means it's likely off the table for an interest rate hike this week. But of course, watch for the messaging on Wednesday from that press conference at 2:30 from the Fed chairman. A lot of people responding to the red that we've seen so far today saying, Jay Powell, do something. We'll have to see later this week if he does anything. Guys.
Yeah, it's gonna be a busy week for you, Brian. I appreciate that. Let's turn our attention to our first guest for the hour. We've got Phil Blancato, Ladenburg Thalmann Asset Management CEO and CIO. Phil, you picked a good date, I guess, to come on the show. I mean, you have said that investors are feeling a lot of pain right now, but this is a sell-off that is necessary to bring valuations in line with where they should be. What are you seeing?
Oh, finally, we're seeing some rationality come back to the market. Look, this is what happens, folks. This is a normal course. The Fed raises interest rates. Stocks that are sensitive to interest rates, like growth names, stocks with high valuations, get hurt. You do get broad market sell-offs. You see the triggers come in, and whether it's the ETF market or just broad-based triggers that hit individual stock names, we see these down moments. But let's not forget, underneath this current pressure, and this is where your emotions get the best of you, take your emotions out of it. Use this as an opportunity to find good names, to pivot in your portfolio. In names we've had excessive growth, take a little appreciation. Remember, we've had 3 years of incredible stock market returns, so you're probably still up. This is when you pivot in your portfolio, you buy the name that you wanted to buy cheaper, and you enjoy the fact that volatility can be beneficial to a portfolio and not just detrimental.
So, Phil, it sounds like you believe that some of those tech companies as well that had far outpaced their own valuation and come under scrutiny, that they actually may be in play for where investors may be able to pick up some of those companies at these discounted prices.
Without a doubt. I mean, listen, some of the names are already mentioned on your show. We'll just talk Netflix for a second here. This is a name that I think is probably worth around $3.25 a share. Over the next 5 years, it's a dominant player in the marketplace. When you see an opportunity for some of these names to go a full 40% down from their peak, there's an opportunity there. Twilio, another name that's down over 50% from its peak. These are names that are driving the future of tech. So I want you to think in your portfolio, how can I play the consumer and the future of our economy? So those big tech names that are cheap, go buy them. But then we know this is a year about the U.S. consumer coming out of Omicron, coming out of Delta, leaving COVID behind us, at least so it seems. And if that's the case, what are consumer-sensitive sectors? Where are you going to spend your money on a restaurant, on an airline, on a hotel, on a vacation spot, where that's going to do really well in the second half of the year? So you barbell here. Maybe mid-cap growth stocks and large-cap tech make for a nice pair trade in your portfolio, so you'll mitigate some volatility, but take advantage of a market sell-off.
Specifically on those big cap tech names, though, Phil, I mean, the thinking here has been over the last few years that every time there's a pullback, you get in because it's going to go back higher. I mean, it sounds like you're saying that the pullback we're seeing is kind of where it should be and where it will be, at least in the short term.
For sure. And I actually think we have a little bit more to go here. It wouldn't surprise me if we see the bloom come off the rose here and be down 20-25% across the board on the Nasdaq, because valuations were at 50% premiums going into this. You were looking at PE ratios that were just ridiculous. Look, I know everyone loves Tesla, but the numbers just didn't add up anymore. Well, watch your local TV commercial. Every car company in the world is coming out with an electrified vehicle. Eventually, that impacts sales. Eventually, that has an impact across the board for all tech names. So you want to buy tech expensive, but not out of the question. So when you see valuations get down to 25 PE, maybe 30 PEs, there's your entry point. Look for good companies that are generating revenue, not companies that are just kind of a shot in the dark and not generating any revenue at all. Balance sheet management, critical now. What tech companies are making money and will be the drivers of tomorrow's technology? That's where you make your bet in a market sell-off like this. Not a speculative name that's not making any money, and we don't really know if it's going to succeed or not.
You know, Phil, one of the conversations we're going to have continuously here, because we need to, is the impact in the future of variants that we haven't even come across of COVID-19. And even as we're monitoring Omicron and trying to put that behind us, it still is this question of, as the WHO was bringing up in their address in the 150th executive board meeting, that there are going to be future variants in a matter of deploying what we have right now in order to best have precautionary measures that allow us to go above what those next potential variants are. And so on the business front, how do you imagine that companies may be restructuring or reimagining what their vision looks like and how they engage with consumers, regardless of what variant may be at play?
In fact, that's the beauty of the COVID variant. I mean, there's not much positive we can take from it, except look at the way we've been able to succeed in this environment economically in spite of the variant. So my opinion is that success, to your point, will continue. We'll find new ways of engaging with the consumer. The consumer will benefit from safer precautions that have been put in place if there is a new variant. You know, every virus in history has always been endemic. Eventually, the virus dies. And whether that's from natural immunity or something beyond that, the medical industry deserves all the credit for all these different types of therapeutics, vaccines that are available today. So assuming it comes endemic at some point, in spite of what's to come, we now have procedures to survive in an environment like this. And that, I think, what's critical. When I say I think it's ending, it's that the business community and us socially are able to succeed in spite of it. And there lies a critical difference. As it winds down, maybe there's another one to come. We'll be better prepared for it.
Certainly helpful to get your insight on a choppy day like today. Phil Blancato, Ladenburg Thalmann Asset Management CEO and CIO. Appreciate your time. Well, for all of the sell-off talk, Brad, there's a few names that are bucking the trend today, and for good reason. There's quite activists dialing up the pressure, and then, of course, potential talk of a takeover. We've got three names we're looking in on, but let's start with Peloton. Obviously, you know, we're talking about a bounce back in relation to the big sell-off we saw last week on those reports that they were halting some of their production. Today, shares moving higher on news that one activist investor is really pressuring the company, specifically the CEO, John Foley, to step down.
Yeah, that's right. And it's interesting looking through the quotes that Blackwell's had put out there saying that we believe that no board exercising reasonable judgment could leave Mr. Foley in charge of Peloton. The company has gotten too big, too complex, too damaged for Mr. Foley to lead it. And then they go on to say even more, saying he should have enough self-awareness and enough self-interest to resign as director. This was very direct to John Foley. And we've, you know, over the past year, acceleratingly so, seen a lot of this focus around a founder CEO and trying to best position the company for success. And whether that is the resignation for that founder CEO themselves, as we saw in Twitter's case with Jack Dorsey, spending more time with Square, or whether that's the case of being forced out of the position. This is all coming into focus as Peloton is not the same company that it was when it went public. However, it's just a stone's throw from the share price when they went public. And so with all of that in mind, at a larger base of users, the question is, how can they continue to grow out that demand? And that demand generation is going to come squarely into focus, even as we were talking about that last week as well. And what that production may look like in the future, still an up in the air item, but Peloton moving higher on the day for the very reasoning that an executive shakeup is exactly what this activist investor is calling for right now. And we'll see if that shakeup comes, quite frankly.
Yeah, I mean, not just a shakeup, but a potential sale, which is something we talked about last week. Obviously, a lot of that is speculative, but people looking to, you know, some of the bigger names, maybe the tech names who could find Peloton an attractive target. Let's talk about another company that is also seeing some gains in the session, and this is a big one. Kohl's up more than 30% here on those reports that Sycamore is considering an acquisition at $65 a share. So a slight premium there, Brad, on where the share is trading when shares are trading today.
Yeah, and, you know, just looking through some of the historical elements for Kohl's and how they have performed. Of course, for Kohl's, what they had come out and said in their most recent earnings, they had seen record Q3 earnings. They raised their full year outlook. They also had an all-time high EPS for the company. Q3 sales increased 16% compared to the previous year. And so all of these things considered with the strategy that they've got, some of those partnerships with Sephora, bringing 200 of them into stores, it's at a time where they're revving up both in the categories categories that they bring customers into stores for, but also the types of partnerships that are going to position them for continuing to have foot traffic. The question for me is, when you do have this type of activist measure, is it looking at the square footage of these locations? Because we do know that it is a high square footage environment that they do operate. And the larger question for many retailers is, how can they mitigate the amount of square footage that they have to operate and the type of overhead that is going out the door to reduce some of those expenses? And perhaps even at a time of transformation that is paying off for Kohl's right now, as noted in their most recent earnings report. I think that's what some of these activist investors may also be looking at going forward. How do you kind of trim some of the operational expenses that a company like Kohl's has to really account for too?
Yeah, certainly a pretty big brick and mortar presence there as well. I'd be curious to, we're talking about 3 companies today, but how much of this acquisition talk is going to accelerate as we see this kind of pullback here? Another name that we're watching today is Unilever, and this is on those reports. Nelson Peltz and his firm looking to take a stake in Unilever. And a lot of this, Brad, stems back to that failed bid for GlaxoSmithKline's consumer health unit, $68 million bid or billion-dollar bid that did not go through. Some frustration building there as well.
Yeah, and seemingly not enough for Nelson Peltz to be involved over at P&G. Of course, we do know how that played out back in 2017 when he was trying to win the proxy vote for a board seat, and then the recount that they had to go through that eventually secured a position. I think now for Nelson Peltz, looking at P&G and Unilever and what they bring to the market, if he has a say in both of them, then this is one person that has a ton of control within how these companies make decisions. But at the end of the day, too, you look at Unilever and what they've had to continue to do to position themselves correctly in all of the retail partnerships, getting their products into the right spaces. You mentioned the failed acquisition of that GSK consumer products division. And it really showed that Unilever wasn't going to budge. They were digging their heels in quite a bit on the number that they had put out there. And so now the question mark remains of where might there be other acquisition targets that they have their eyes on to continue to try and have some type of continued presence in growing out. And that growth is so key for a company like them, even post-pandemic or in the waning elements of the pandemic, trying to grow in different categories within the household for those consumer products and where the acquisitions actually make sense for them to acquire to grow in this case, and what an activist investor can do along those lines too.
It's worth noting that Wall Street Journal report on this particular story doesn't say how significant the stake is for Nelson Peltz, but certainly you can expect that pressure for growth with Unilever to accelerate with that stake there now.
Yeah, absolutely correct. Well, guys, coming up on the other side of this short break, we've got much more on the markets. You are taking a look at the biggest NASDAQ laggards as of right now: Netflix, Airbnb, Moderna, Xilinx, and CrowdStrike, all of them down on the day, and Airbnb by about 10% right now. Netflix about the same there, and Moderna down by about 9.7%. We'll continue to watch all of that. We've also got to look at some of the major averages, as you're seeing in that bottom corner of your screen. All of those continuing to move lower here on the day. The Dow, the Nasdaq, and the S&P 500 all down by more than 2%. The Nasdaq by about 3% as of right now. Well, coming up, everyone, the WHO held the 150th session of the executive board today as the COVID-19 pandemic approaches another year. We discuss the mitigation efforts against future variants coming up next.
COVID-19 pandemic is now entering its third year, and we are at a critical juncture. We must work together to bring the acute phase of this pandemic to an end. We cannot let it continue to drag on, lurching between panic and neglect. We have all of the tools to end the acute phase of this pandemic, but we have to use them equitably and wisely.
That was the WHO Director General, Dr. Tedros, at a press briefing earlier describing what he called a critical juncture as the COVID-19 pandemic enters its third year. Joining us now is Dr. Calvin Sun, who is the Monsoon Diaries founder and CEO, clinical assistant professor over and attending physician in emergency medicine in New York City. Dr. Sun, thanks so much for joining us here on the day. First and foremost, as we were just listening to the WHO Director General, the world attempts to put the Omicron variant in the past. It's clear new variants pose a future risk, perhaps. And so what preparedness do you believe that we can continue to activate to navigate future variants and abate societal disruption?
Hasn't every month been a critical juncture? The answer is simple. We have the tools. Use the tools. Vaccinate everyone. You vaccinate the underdeveloped, the lesser access parts of the world, and you prevent the possibility of creating future variants that could evade the protection of antibodies from whether it's prior infections or vaccine antibodies. It's once you clamp down and do your part in vaccinating as many people as possible in the shortest amount of time, you lower the chances of having to go through the speech again and saying that we are at a critical juncture as part of the pandemic, which has been literally every minute in the last 3 years. We have the ability. Why not just do it right now?
Doctor, we started to see a pullback in those infections in places like New York City that were at the very beginning of the Omicron wave here in the US. What are you seeing in your ERs?
So I'm in New York City, and it kind of feels like that scene of an action movie, or let's say a True Lies or Aliens, right? The drama, the main climax seems to be over. It's a big sigh of relief, and then the alien at the very end comes back one more time, like Die Hard or True Lies, the villain, the aliens just comes back one more time, and the protagonist of the story takes care of it pretty quickly. But it is a quick drama right before the end credits roll. That is what felt like with Omicron. It came and it went all of a sudden. I told everyone to be concerned but not panic. The end credits are coming, and that's what it feels like. It's very hopeful to know that if you got Delta, you could still get Omicron. But if you got Omicron, you're less likely to get Delta because there's just so many more mutations with Omicron. Having had Omicron protects you against anything that has fewer mutations, hence Delta, which is a worse and more deadly disease compared to Omicron from what we have seen, or the fact that most of us are fully vaccinated at this point, and it's only going to be more vaccinated from this point on, hopefully, that we just see the end credits and no more sequels.
For the vaccinations that have gone forward thus far, for boosters that have even been rolled out and administered, what does that future look like? Is it something similar to what we've been talking about with the flu and the annual flu shot that people have available to them? And what frequency or cadence do you believe that might look like in the future too?
So we had the flu that came about 3 to 4 months a year, once a season, one season a year, and usually the colder months. And we needed one shot a year to protect ourselves from that. And, even then a lot of people died from the flu, especially the older, the younger, the vulnerable, the immunocompromised, the pregnant. So we did once a year. COVID is year round. So it makes sense that we may need more than once a year, 3 times a year, if even at this point, when, what I've experienced. So it depends, this critical juncture in time. If you can make it endemic like the flu, when it just comes once a year, usually at the colder months when people are inside, we may just see something like a flu shot once a year. But if you let it go for a year-round pandemic like we saw the last 2 years, then you might see something to come more often, understandably. So one shot a year for the flu that comes 3 months a year versus more than once a year for COVID that comes year-round. That's why we're in a pandemic.
Doctor, going back to what you were saying about how things look in ERs in the city, we've learned that these things come in waves. And so in the past, while we've kind of let our guard down once the case count started to go down again, we kind of have the advantage of hindsight. And so now that you're starting to see things calm down just a bit, what do you think needs to be done to prepare for that next wave? Is it about the testing and building on what the White House has done, rolling out those at-home tests? I mean, what are some other factors that you think can be done in this window we have right now once those cases come down?
Fail to prepare, prepare to fail is what I always love to say. So you have a breathing sigh of relief. I don't procrastinate. I'm not one to be a procrastinator. I try to answer as many emails as I can and be ahead of the game. So I really love the ability to prevent what if history were to be a rhyme. If Delta came, if Alpha was in the winter times and Delta came around April, God forbid we'll see the next bad one around April, May. If history were to rhyme, I want to be wrong. But until then, we have a few months to prepare. And I think getting as many tests as possible, being more educational about what tests should be used for what, more robust testing at home, encouraging people to test more at home, reporting the results, or finding some way accountability to have the tests reported, instead of coming to the emergency room without symptoms to catch COVID just for a test. And also getting as many people vaccinated and boosted as quickly as possible so you prevent the possibility of an immunocompromised or someone without a vaccine antibodies to get infected and then create the next variant that makes us go through these waves again. So these are multifaceted approach, multifactorial ways that we can, make sure that we don't have to go through this again. I mean, we have the tools. It really depends on who wants to use them. Not about what, it's about how.
Dr. Sun, just lastly, while we have you, I'd love to know the pulse among some of your colleagues, those that you work with, especially the broader healthcare workforce, especially as we continue to navigate this pandemic even now.
We are so exhausted. We were so exhausted before the pandemic too. The pandemic didn't make new problems. It just reclarified and brought up all the things that we've been complaining about in the past to the forefront more quickly. And that's why you see a massive phenomenon of moral injury and burnout among us that we are now leaving. We're exploring other creative outlets in order to stay alive, because if we can't take care of ourselves, we can't take care of other people. And people are siloed in their experiences during this pandemic. They don't really, out of sight, out of mind. They don't see what goes on behind the walls of a hospital or the emergency room. And that's what we do. We want to protect the human population, the rest of our community, from the horrors that we see behind these walls. I mean, that's what the military does. That's what we do on the front lines. And it's very synonymous. But we're also human. And I think for people to understand that we're human just like they are, we run out of gas just like they do. And we also swore an oath to put other people above our own needs. That's just a habit that we've been ingrained into us in school. It's okay for us to understand that we need to also ask for help. But sometimes it's hard for people who don't know how to ask for help in language to ask for help. So if only society can just understand to reach out to us and check in on us and all the people that one at a time, individually, all the people that out there, makes a huge difference. But I can't really predict the future, what healthcare would look like, because it is a critical juncture in time of how we take care of ourselves at this point.
Yeah, well, we certainly appreciate all of the work that you and other healthcare workers have been doing. Hopefully you get some time for yourself soon. Dr. Calvin Sun, the Monsoon Diaries founder and CEO, as well as clinical assistant professor and attending physician in emergency medicine in New York City. Want to turn our attention back to the broader sell-off we've been tracking in the markets here. The Dow coming off of the lows, but it is still down about 657 points right now. The Nasdaq, the big laggard on the day. We have continued to see the tech sell-off with the Nasdaq overall down about 3%. Take a look at some of these big tech names. Airbnb certainly getting caught up in the sell-off there, down about double digits as these tech names continue to drag down the Nasdaq. On the other side of the break, though, CEO Brian Chesky talking about how optimistic he is about the company's growth prospects, especially as remote work fuels long-term stays. Why he says we are never going back to a 5-day work week. We'll have that conversation for you on the other side. Welcome back to Yahoo Finance Live. We are continuing to see a broad market sell-off here on this Monday. The Dow down nearly 700 points, but the Nasdaq is the one we've been watching here closely, with that tech sell-off continuing after we saw the Nasdaq enter correction territory last week. Down about 3% today. Watching the sentiment in the market, certainly a lot of attention today on what's about to play out starting tomorrow with that FOMC policy meeting kicking off, and taking a look at where the VIX is here. This is the level we have not seen since last March. So highest levels we've seen in months, and that really does point to the sentiment among investors as they continue to brace for additional rate hikes here. We're also watching very closely some of the small cap names, the Russell 2000 now entering correction territory on the year. It is down about 2% on the day. And then, of course, you know, as we said early on, tech, we're continuing to watch today. Airbnb, one of those names that's getting caught in the sell-off, but it is undergoing a big expansion into long-term stays fueled by the growth in remote work, with more and more users opting to use Airbnb as temporary living spaces. CEO Brian Chesky tells me the company sees significant business opportunities, and he's joining the ranks, staying in Airbnbs himself, to experience the dramatic shift in the way we work. Take a listen.
I think what prompted this is that I think that we're living through probably the biggest change to travel since the advent of commercial flying, because the entire identity of travel is evolving. Because people, many people don't have to go back to an office 5 days a week, they're less tethered to living in one place. And so what this means is that for millions of people, not everyone, but a large chunk of people, they now have the opportunity to travel anywhere, and in some cases even live anywhere. And so we're seeing, families going away for the summer. We're seeing people taking long weekends, but we're also seeing some people just living in Airbnbs. And I figured if millions of people are joining this trend, I should too, and use the product myself and try to really figure out how I can help us continue to design a better experience. And also, it's pretty fun. I mean, I've always kind of wanted to do this, be able to go somewhere for a few weeks here, a few weeks there. And suddenly, if I don't have to myself be back in the office, I think I can show people with a laptop and Wi-Fi in someone's house, you can run a huge company. You can do a lot of things from Airbnbs.
Yeah, Brian, I want to get to the specifics on the platform, but first, talk me through your setup here. I mean, you're running a big company remotely. Every 2 weeks, you're shifting up your location. What's the setup and what's the plan? Where do you go from Atlanta?
The setup is I have a bag. Inside that bag's a laptop. I turn on the laptop. I join the Wi-Fi. I can run the company. That's all it takes. I mean, it's literally, there's nothing else that's involved. The only other setup I have is to do an interview like this. Other than doing interviews like this, all it needs is a laptop and Wi-Fi, and you can work from anywhere in Airbnb, and you can even run a company like Airbnb. I'm kind of taking it one city at a time. A week ago, I didn't even know I was living on Airbnb. I was in Atlanta visiting a friend, and I thought, I don't have to necessarily go back to San Francisco. Why don't I just book an Airbnb here? And I've always wanted to check out Atlanta, so here I am. And I'm gonna hop around to some different cities and communities and really just have this kind of fun little adventure.
You mentioned that part of this is trying to improve the design of the system. And you've talked a lot about the evolution of your customers during the pandemic. They're staying longer. They're staying in different markets. 1 out of every 5 gross nights booked in Q3 were for stays of 28 days or longer. What do you think has fundamentally shifted about the way customers are using your platform over the course of the pandemic?
Well, before the pandemic, primarily, Airbnb was a way for people to stay in a city. And, about half our business was cross-border. People were crossing borders or staying in urban areas. And the reason why we were primarily travel was because most people had to be back to an office. We still have all of the travel business. And I actually think when borders start to reopen, there's going to be so much pent-up demand for travel that I actually am incredibly bullish in travel. I think it's one of the things people miss most is the ability to travel. But now there's an entirely new category, which is really, you could call it living. It could be a week, a couple weeks, months, or even an entire season. And what we've seen that's changed is a newfound flexibility. People are traveling everywhere, all the time. They're staying longer, and they're not just traveling, they're living. You can travel anywhere, you can live anywhere to the extent that you have flexibility. And, millions of people now have newfound flexibility. We want to design for that world.
How does that change the opportunities you see for the company? I watched an interview you did earlier. You seemed to tease out new products that could be coming out on the market a little later this year. And it sounds like there's a bit of a shift in focus here. Yes, you still have travel, but you're also more focused on long-term lifestyle. I mean, is that the right way to look at the platform, this shift that's happening from just short-term stays?
It's not a shift, it's an expansion. So we are still doing travel. It's a huge opportunity for us, but there's now this entire new category of living on top of traveling. So I wouldn't call it a shift, I'd call it just an expansion. And it's really exciting. And to be super clear, I think this summer, presuming that obviously the pandemic, the situation improves and borders start to reopen, I actually think there's going to be an explosion of travel and a lot more flexibility for people to live. So I think it's an and, not an or.
So with that expansion, though, what are some other products you're looking at, opportunities that you see to be able to offer on the platform as customers continue to use these Airbnb stays in a more different way?
Well, I mean, nearly half of our business in Q3 by nights booked was for stays of a week or longer. I mean, that's still travel, but it's a different kind of travel where at that point, you really are immersing the community. You need to have great Wi-Fi. You need to have a lot of amenities. And so I think the stakes get a little higher. We have to raise our game on, customer service, the protections we're adding travelers. We, because more people are flexible where they travel and live, our search tools need to continue to evolve to showcase all that Airbnb has to offer. We're seeing more and more people booking unique properties because the homes are becoming the destinations. People want to book tree houses and really interesting homes. And of course, the bread and butter of Airbnb is still there, and it's going to come back, which is people crossing borders, staying in urban areas all over the world. So it's just a really exciting time. All the opportunities that we used to have exist, but there's this whole new world open to us. And we're just focusing every day on making the experience as amazing as possible. And I would say there's going to be some pretty big offerings coming in the coming months.
You mentioned the different experiences that are on the platform. A treehouse is one you mentioned, but also you've kind of gone after some of these sites that a lot of our viewers are familiar with, the Home Alone house, the Carrie Bradshaw house from Sex and the City. What kind of bids have you gotten on that? And what does that tell you about how people are thinking about the experience of traveling?
Well, I mean, yeah, we have the Home Alone house. Could you imagine you can actually stay in that house, and it's really a cool experience. And I think we had like hundreds of thousands of people apply to stay at that house, if I'm not mistaken. I haven't checked the latest stats, but what it tells me is it's tapping into something that people want to have an experience. They don't want to just stay in their home and just, they want to get out of the house. They want to have an experience. A lot of people feel isolated and they want to spend meaningful time with other people. And so that's what this tells me. I think there's a lot of pent up demand for travel. I think people want to explore and live in different places. And they also want to have meaningful time with friends and family, and travel is a great way to do that. So I think that people want to dream. They want to get out in the world, and I think we can allow them to do that.
our worldview today, NATO is boosting its presence in Eastern Europe amid growing concerns about an imminent Russian attack on Ukraine. NATO said its allies were sending in ships and fighter jets to reinforce its deterrence and defense, while the Biden administration also considers sending thousands of U.S. troops to Europe as part of the military buildup. This follows warnings from both the U.S. State Department and the U.K., urging families of diplomats to leave Ukraine out of fears of escalating violence. The U.S. Embassy has also reportedly authorized non-emergency employees to leave the country. Russia has been amassing more than 100,000 troops along its border with Ukraine and deployed additional forces to Belarus. Kremlin spokesman Dmitry Peskov accused NATO and the U.S. of stoking informational hysteria and denied any plans of military action. Over in Mexico, another journalist has been murdered in Tijuana, marking the second media-related death in a week. Police say Lourdes Maldonado Lopez was murdered in Tijuana in her car in a residential neighborhood just days after photographer Margarito Martinez was shot outside of his home. Officials say they are now investigating both killings along with possible motives. Mexico is considered one of the deadliest countries for journalists, with 7 killed last year alone, according to nonprofit group Article 19. Maldonado Lopez worked for multiple media outlets and had called on Mexican President Andrés Manuel López Obrador to provide protection 2 years ago. She said, saying that she feared for her life, citing an ongoing lawsuit with her former employer, the former governor of Baja California. And all 3 journalists have been murdered in Mexico so far this year. And organizers of the Beijing Olympics are relaxing some of China's strict COVID rules with less than 2 weeks to go until the Winter Games. The new rules raise the threshold for a positive PCR test, and it reduces the amount of time a person is considered in close contact with a COVID patient from 14 to 7 days. The change comes as China struggles to maintain its zero COVID policy, with athletes and officials from the International Olympic Committee traveling over the next few weeks. The country reported 57 new COVID infections on Sunday, while 177 infections have been tied directly to the Games so far this month. Meanwhile, air pollution has reemerged as a new threat to athletes, with heavy smog enveloping Beijing. The level of hazardous particles have risen to 40 times the level the World Health Organization considers safe. Well, we're turning our attention back to the broad market sell-off we're seeing today. The Dow accelerating its losses right now, down more than 800 points, almost 900 points here. The Nasdaq continuing to be the big laggard as tech names drag down that about 4%. Now, we're also seeing cryptocurrencies moving in tandem with stocks, selling off as investors move out of riskier assets. And you see Bitcoin approaching that $30,000 level. $130 billion have been wiped off of crypto markets over the last 24 hours. We've seen Bitcoin and Ether down more than 50% from their all-time highs. We're looking at their lowest levels since July, and we're going to be breaking down some of those price moves in our next hour. Coming up, a new law in New York City leading to calls for more transparency around employee salaries. Employers bracing for some uncomfortable conversations to come. That discussion is up ahead on the other side of the break.
It's a down day across the board. The Dow down by 920 points right now, 2.7%. We'll round that off too at this hour. The S&P 500 also lower by 3.4%, and down right now, more than 4% is the Nasdaq Composite. You're seeing declines there racking up to the tune of 560 points. We're keeping a close eye on this as we move on throughout the rest of today's session. The deep declines continuing what we've seen early here in 2022, Akiko. And so we'll continue to keep that in focus for our viewers. But as of right now, we've got to get to our next guest as well. Job role, location, experience, and competitive market rates. They're just a few factors that shape compensation. And so now some new mechanisms are being enacted for salary transparency, some hybrid work considerations, and all of this as inflation outpaces that wage growth that we've been tracking too. Kevin Delaney, who is the co-founder and CEO of Charter, joins us now with more on this. And Kevin, let's just set the scene first and foremost. Help us lay out wages in comparison to inflation and where this plays into the broader employee-employer relationship.
Yeah, so we're at the period where there are a bunch of different cross currents that employers are having to navigate right now. One of them, as you mentioned, is inflation. So inflation's running, as you know, at about 7% annualized. And people are, as we see the raise cycle sort of starting to come up upon us, some employers are actually trying to factor that into the raises that they're giving. The other thing that we have going is we have people who are going remote and employers who have traditionally adjusted wages based on where you were working from. Actually, you're trying to have to figure out how to navigate that as well. And then the other thing that's happening on top of this is that they're in a bunch of different states. And now in New York City, there are requirements that employers are more transparent. So they disclose what salaries are for each position. And the net of this is that employers are having to deal with a level of complexity around salaries as many of them are heading into raise giving periods that they haven't seen in a long time.
So how is that likely to play out, Kevin? I mean, I tease this as uncomfortable conversations that are happening, but this is something especially a lot of the younger employees have been pushing for, not just in New York City, but in other states as well.
Yeah, that's true. So pay transparency has already come in places like Colorado has a law that's actually pretty similar to what we're going to see in New York, Connecticut. Some other states have less strict, but other requirements on pay transparency. The challenge is that for some employers over time, they've made a lot of ad hoc decisions about what people are paid. And it may be that someone got an offer to leave to go work somewhere else. As we know, there's a real war for talent and you want to keep them. And so you give them a raise. But over time, what this means is that people's salaries are out of whack for the same job. And so for companies that have done that, they're now having to reckon with the disparity among salaries for similar positions. We also know that there are wage gaps for women and people of color not paid as much. And so that's the goal of this legislation, these laws, is to actually try and shed some light on it. Ultimately, it should be good, but the result is that companies that haven't been really strict in their practices, gotten loose in their practices, they're really having to scramble. Will they give people some raises to kind of bring everyone up to the same level? That's among the measures that I know some of them are considering.
A lot of people are going to be watching that one. Kevin Delaney, Charter co-founder and CEO, appreciate the time today. Want to turn our attention back to the markets here, and let's take a look at airline stocks right now. Delta, United, American Southwest, and JetBlue all in the red right now, with Southwest seeing the steepest losses. Of course, we've been watching a broader market sell-off in this Monday session, with the Dow now down nearly 800 points. Speaking of airlines, disruption in the skies. The latest 5G rollout grounding some flights to and from the U.S. We've got Dan Howley on the case on the other side with a breakdown of what exactly this means for your next flight. That's on the other side. Welcome back to Yahoo Finance Live. We are continuing to watch an ugly day on Wall Street here, with the Dow now down 835 points, the Nasdaq down 500, about 3.5% here, and the S&P 500 off about 3%. We are seeing declines pretty much across the board here, but let's take a look at what's happening in the commodities space. Oil down in a big way. WTI down about 3.5%. Brent crude down about 3% here. A number of factors leading to the pullback there. A stronger dollar, a big one. The greenback hitting a 2-week high. And there's also, of course, a close watch here on what plays out with that FOMC policy meeting kicking off tomorrow. A lot of investors really watching closely here to see how hawkish the Fed is going to be, with some anticipating up to 4 interest rate hikes this year. Well, switching gears here, the latest rollout of 5G has led to some disruption in the skies, with some flights to and from the U.S. grounded. But what does this all mean for you? In what exactly does 5G technology have to do with flights? Let's bring in Yahoo Finance's Dan Halley to break things down for us. And this is a conversation that we were really focused on last week, because the 5G rollout was delayed a number of times because of concerns from the FAA. Break this down for us.
That's right, Akiko. Now they're delaying the rollout for another 6 months. So there's this kind of reprieve that the FAA and FCC and carriers like AT&T and Verizon have gotten for the time being, but this isn't fully fleshed out yet. So just to give you an idea of what happened and where we stand now, let's go back to December 2020. That's when the FCC was setting up to launch an auction for 5G spectrum. Now, AT&T and Verizon were very keen on getting access to this spectrum because it really is called kind of the Goldilocks spectrum. Now, both carriers have 5G that's slightly better than 4G LTE that you have now, and then a version of 5G that's incredibly fast but has super short range. We're talking like blocks maybe. And the interference with that is also incredibly high. I mean, if someone walked in front of you, between you and the cell phone antenna, you're not going to be able to get any kind of 5G. So this was a version that would eliminate both of those problems. It would provide massive range as well as huge speed boosts. So you can understand why they wanted to get that 5G. But just before the FCC was set to auction that off, the FAA had come forward with a memo saying, look, guys, we think that there's going to be problems with this radio spectrum. And that's because it sits incredibly close to the same radio spectrum that these altimeters in these planes use. And so the radio altimeter is essentially a way for the plane to say, well, there's the ground and here's me, and that's the distance. So it really helps keep planes from hitting the pavement in low visibility conditions. So this is something that's been known for years, and that's what's so frustrating when you look at the issues that crept up. So fast forward to a few weeks back, and what we had was AT&T and Verizon basically agreeing at the behest of the Biden administration and the head of the DOT, Pete Buttigieg, basically saying, you know, look, we really need you guys to hold off on launching your latest versions of 5G. There were conversations back and forth. And so now where we sit is there are what are called 5G buffer zones around different airports. And those are going to last for 6 months. More or less what they are is a way for 5G to be deployed, but not at its fullest extent. And now there's been conversations back and forth about why in Europe they have 5G near their airports and why we don't have it here right now. And the reason is because 5G here, according to the FAA, runs at higher power capabilities. So it is an increased chance of interference, and the way that the antennas are actually set up, where in Europe they're kind of face down, here they're facing out to maximize range, and that can also add to potential interference. But you know, as the FAA does point out, these buffer zones are much smaller than they have in Europe at their existing build out, so it shouldn't be too big of a problem. Now, the FAA said that they've cleared some 78% of flights now, or planes, in the commercial fleet. So what you could do is just get on a plane and essentially fly normally. There are some that are still being looked at to determine if the 5G will actually impact the altimeter. And if they are, then those planes would have to be retrofitted. But as I said, for the next 6 months, these carriers have agreed to not fully roll out their 5G around these different airports and will instead lower the power and have these buffer zones that planes can fly into. But as I said, this is something that was known since December 2020, and it all could have been avoided if these two agencies had really kind of coordinated more closely.
Yeah, Dan, safety paramount, but we do know they had a ton of time, as you were laying out there, to ensure that they were doing the necessary testing ahead of this 5G rollout. Yahoo Finance's own Dan Howley joining us. Thanks so much for the breakdown, Dan. We appreciate it. And everyone, join us on Yahoo Finance Tuesday, February 8th from 12 to 1 p.m. Eastern Time for a dedicated virtual event focused on the future of finance, brought to you by Grayscale. Along with our special guests, we'll be dissecting and defining what the future of finance means. We're going to speak to and seek to provide an understanding of the future of finance, especially the way that financial services are intersecting with technology, digital assets, and of course, the broader investing public. All that on February 8th, 12 to 1. Taking another look at the markets here before we go to break, taking a look at some of the biggest Dow Jones laggards here and now. Boeing, that is down by a little more than 5%, as well as Microsoft down by a little more than 5% as well. Disney, Goldman Sachs, Salesforce, all of those lower by more than 4% at this point in time. And we also are going to be taking a closer look and a deeper dive in conversation into BTC, USD, Bitcoin, everybody out there who is hodling, if you will. We're going to see exactly what that appetite to hodl looks like on the other side of the break as we're taking a look at Bitcoin here, first and foremost, sitting at about $34,355. We're going to see you at the 12 p.m. hour as we've just struck it on the other side of this short break. Welcome back to Yahoo Finance Live, everyone. Just past the 12 p.m. marker, noontime Eastern time right now. Brad Smith here with Akiko Fujita, and we are continuing to monitor this sell-off that we've seen on the day as a continuance of this trend that we watched early in 2022, and tech is taking the brunt of today's declines. We're going to dive further into today's action ahead of a big week for earnings and the FOMC policy decision to come Wednesday. Also, during this hour, we've got the CEO of Orange Theory Fitness joining Yahoo Finance with his vantage point of the industry and where people are working out from. Plus, the global crypto market cap that's plunged from some of those all-time highs seen just months ago after a dismal weekend for Bitcoin, and some of that activity continuing for both BTC and Ether. Where will crypto find its footing, and are owners willing to hodl through some of this turmoil? All that and much more. But perhaps we start off with Bitcoin. And for that, let's bring in Yahoo Finance's own David Hollerith. David, in the price action we've been tracking from the weekend all the way into today's activity, you got to know what sticks out to you the most and what's really driving some of this.
Yeah, I'll start with the second question first. What's driving this? It seems like the risk-on story that pinning to the macroeconomic backdrop, meaning cryptocurrencies are trading a lot like technology stocks that are higher up the risk curve. I think that's the majority consensus of what investors and analysts have been saying. So everyone's sort of looking at this upcoming Federal Reserve meeting that's taking place on Wednesday to see the results of how that might be interpreted. But again, the global market cap of cryptocurrencies has lost $1.43 trillion since its peak earlier in November 2021. And the correlation between tech stocks and cryptocurrencies has reached a 0.62, which doesn't really have a lot of meaning without context. But to give you an idea, that's sort of the highest correlation we've seen between stocks and cryptocurrencies. So right now, cryptocurrencies are very much trading like risk-on stocks. Now, why that's the case, we're still not totally sure. It's sort of unclear whether or not investors think that institutions have come in and they've bought into the asset class, and that has sort of made it like a very risky or more risky technology stock, or if it's because cryptocurrencies act as a kind of inflation hedge, in which case the Federal Reserve raising interest rates to combat inflation could, in a sense, it could undercut the narrative for cryptocurrencies. So we're kind of watching all that development. But as far as the drawdown since Friday and what we're expecting this week, a lot of people have seen that Bitcoin and other cryptocurrencies are a little bit oversold at this point. So there's reason to believe we will see a little bit more of a recovery in the next couple of days. But again, a lot is hinging on the FOMC meeting, which is taking place on Wednesday.
All right, David, appreciate the breakdown. And we're going to continue to watch this price action for all of the major cryptos. This all is $130 billion has been wiped off the crypto markets in total market capitalization, as David was breaking down there. Appreciate it again. Once again, David. Next up, we've got to get back to a ton of the activity that we've seen here today in the declines that you're seeing in this bottom corner of your screen, and now in full on your screen right now, as the Dow is down by more than 900 points right now, and the Nasdaq tech taking the brunt of the hit. The tech heavy average is down by more than 4%, 574 points. Joining us now with more on this, Sylvia Jablonski, CIO and co-founder of Defiance ETFs. Sylvia, great to have you here with us today. Help us contextualize this move, and especially what may be in play even prior to the major earnings that are set to be reported this week, as well as the Fed and their decision.
Hi, good afternoon, and great to be here with you today. Well, I think that there's a lot of uncertainty in the market right now, and you can sort of go down the list. We have the Fed meeting, what will happen with the taper and unwinding of the balance sheets, and how far rates will rise and when. Those are major issues and kind of have hit the panic button for the market. I think we've seen a lot of selling to meet margin recently. We have the news around Russia, and the U.S. services IHS manufacturing number didn't look very good either. It's to an 18-month low. So all of these things are impacting the market in the short term. And I think what has happened historically is that a lot of the dip buyers would sort of come in and push us back up, and we would kind of revert to a higher mean than this one. But if you look back at the market and you look back, since World War II, anytime that we've seen 10 to 20% pullbacks, which has been about 26 times, the market pullback has lasted for about 4 months. The 5 to 10% moves have lasted for about a month. So I suspect that, we're going to be in a wait and see pattern. We're going to have this volatility. We're going to have this sort of uncertainty and fear with investors on the sidelines until we get more news from the Fed and until earnings continue. But what that presents for me is an opportunity to buy. I'm always kind of talking about buying on the dip, but as an investor with a longer term time horizon, if I liked Apple at 180 because I think it's going to 200 or 300, I certainly like it at sub 160. Your last guest talked about crypto. If I liked Bitcoin at 50, 60,000 per coin, I certainly love it here at 33,000. So it's a good time for investors to think about getting in on some of these deals.
On the issue around the Fed, I mean, we've had a month now for speculation to run rampant. And I wonder how much of these rate hikes you think are actually priced in. I mean, if you think about the pullback that we've seen so far in this month, how much of that is overdone, just given that we haven't heard directly from the Fed? And how much of that you think comes in line once we actually get a statement come Wednesday, whether that is more hawkish or not?
I think that's a great question. And I think that's sort of the most important question of the week. So the way that I see it, it feels like the market is overpricing in rate hikes. And for the last couple of weeks or the last month, as you said, we had a really good reason to do that. Inflation was running hot, but the market was also sort of running hot and companies are doing well. The consumer continued to spend. But now all of a sudden the picture is looking a little bit murkier. And I think what that does is it gives the Fed some room and some flexibility. We've heard a lot of people say this, but it does seem to be sort of logically true that if we pumped all this money and liquidity into the markets at the heat of the pandemic to recover and to sort of hold up the economy, well, now when we're sort of seeing, yes, inflation, but then pull back in manufacturing, jobs are not sort of fully shaken out. And the market is looking, kind of in a panic mode. You would think that the Fed would sort of think about that and really consider the word placement this week in terms of the FOMC meeting. So, yes, we're going to have rate hikes, but perhaps hearing that we will wait and see and respond accordingly to, the markets and the economy is what would kind of turn things around here.
Sylvia, you mentioned Bitcoin and that if you liked Bitcoin at 50K, then you definitely like it at 34, 33K even. And so with that in mind, what type of kind of hold on for dear life propensity do you believe is in play here for so many of this asset, the asset holders of Bitcoin and even of other cryptocurrencies that have taken it on the chin, quite frankly?
Yeah, I think what happens in this type of market volatility and these type of pullbacks, you sort of have two types of people. I think you have investors that bought in at higher levels, lower levels, dollar cost average, sort of whatever they're doing, but they understand that this is probably looking like a bottom or pretty close to one, and it would behoove you to sort of hang on long term, particularly if you don't need to take the cash out of the market or out of cryptocurrencies. And then you have other investors that see 5 to 10% pullbacks and they're just out of the market, whether it's strategically to recognize early tax losses or something like that, or it's just absolute panic, it's going to zero. I want to sort of cut my losses here. And I think the latter group is actually the larger group. So, what I would say is if you are an investor in a lot of these assets, you went into them knowing that they're risky assets. And yes, they've pulled back. If you're not sort of comfortable adding to your position, hang tight because the markets historically have come back. So it's not sort of all over. And again, I would just really highlight the fact that Dave, your last guest said it as well. If you were looking for an opportunity to get in, I mean, particularly if you can tolerate the risk and the volatility and understand that it's likely to happen along the way with crypto, this is a good time.
With that said, we should point out NFTZ here, your NFT-themed ETF. And this was something we talked about before about what the upside is long term. No question, regardless of what you said there's a lot of people today who are saying, well, I'm looking at the chart here. It doesn't look good over the last several months. Has your long-term case changed at all?
It definitely hasn't. I think that the ETF looks like tech stocks look right now, like semiconductor stocks do. Any sort of disruptive technology right now is anything sort of related, second, third cousin to the Nasdaq right now is just getting crushed. But if I look at the future and what I want to invest in, I want to look at secular growth opportunities. I want to look at innovation. I want to look at the themes of the future. And when I think about that, it's Web 3.0, it's metaverse, it's NFTs, it's 5G, it's machine learning, it's cloud computing. And these are all themes that are very much on sale now. So I think that NFTs are where crypto was a decade ago. You saw these wild sort of swings in crypto, and you're going to see them in NFTs, but the total addressable market is growing. The total interest is growing. And if you think about Web 3.0, the most interesting thing about NFTs is actually the technology behind NFTs. And we don't talk about that a lot, but it's technology that can change the way that we live, work, and can automate so many things that are just absolutely mind blowing. And I think that, that's a reason to really consider the companies that are investing in the NFT space.
All right. I long wonder about what we are all going to look like and engaging like in the metaverse. And so we will see exactly how that pans out. Such a pleasure to have you here and get your insights on the day. That's Sylvia Jablonski, who is the CIO and co-founder over at Defiance ETFs. Thank you again for the time. And switching gears here, we got to talk about Apple. Apple reports earnings this week, Thursday. That's coming forward. We've also been tracking the stock here on the day. It is down alongside a lot of the other tech names that are in decline here. The Apple shares, you're seeing those on the screen, down by about 4.5% right now. And so with more on this and kind of setting this up and previewing it for us and what to expect, we've got Tom Forte, D.A. Davidson research analyst. Tom, great to have you here. Let's just start with what your expectations are going into this earnings report, aside from what we're seeing in the stock movement here on the day.
Sure. So when I think about Apple and I think about reporting the December quarter, the big question is to what extent was supply chain disruption? How did that impact their sales? We knew that in the September quarter, it negatively affected their sales by $6 billion. And the expectation was that lost sales in the December quarter would be even greater than $6 billion. So I think the first thing we look for Apple's earnings is how are they in the supply chain? When are things going to get better? And how should that affect their sales and earnings over the next 12 months?
Tom, with that said, Apple's coming off of a big milestone here, crossing that $3 trillion mark in terms of market cap. I know when we had the conversation around that, there were a lot of expectations, a lot of optimism around what's to come for Apple, particularly the AR/VR headset. I wonder how you're looking at that. I know that's not a this quarter thing, but could that be potentially a significant driver down the line?
So I think that's an excellent question. And I exactly believe what you just suggested, that Apple hit the $3 trillion market cap mark on the expectation that they're going to have something meaningful when it comes to AR, VR, and also potentially electronic vehicles. The challenge for investors is it's highly unlikely that Apple's going to telegraph their future product roadmap. So I think the question is, will Apple's management say enough and investors continue to bid up shares of Apple on the expectation that there's going to be these future products, the AR, VR product, and potentially electronic vehicles to drive future sales and profit growth for Apple? And I think that's, to be determined.
Getting back to the price movement that we're watching here on Apple as well today, Tom, I would love to know what you're making of this tech sell-off that we've been monitoring closely, and you're seeing Apple down, but that comes with the Dow plunging about 1,000 points as of right now, the Nasdaq down heavily by about 4.5% for the tech-heavy composite. Is the move here justified from your standpoint, and especially going into a major Fed decision where we know that in a tightening environment or in the lack of an easy money environment, that tech has tended to see some of this move lower in reaction to what is potentially to come from the Fed and their decision too?
Yeah, excellent questions. The way I think about it is earnings for Apple could not have come at a better time. Because ultimately, when I think about sell-offs and I think about pullbacks in the stock market, ultimately investors are trying to determine what is the appropriate multiple to pay for a stock. So to the extent that Apple's able to show that, hey, their next 12-month sales and profitability looks better than expected, then that may offset some of the investor anxiety on rising rates, which tend to have a negative impact on valuations, especially for technology shares, which often have materially higher multiples than other stocks in the market.
So is this a good time to get in? I know you can never time the market, but I wonder if the earnings reports to come are going to, put things back in the driver's seat, if you will. Today, it's about the fears around what we're going to hear from the FOMC policy meeting. And yet we've heard from other guests over and over that at the end of the day, it's not about broad tech. If you've got a company that is profitable, there's only more upside ahead.
If you have a 12-month or long-term investment horizon, it certainly seems like a great time to take a stance, to make a position in Apple, Amazon, even Shopify, some of these other high-quality growth names that have been materially pulled back on the sell-off. So yes, if you have the advantage of a long-term time horizon, is you're able to ride out the near-term volatility, because it certainly is super volatile right now.
Tom Forte, always good to have you on. D.A. Davidson, research analyst. Good to talk to you on what has been a very ugly day here, especially for tech. And we want to turn our attention back to the broader markets here, because we're now seeing the Dow down more than 1,000 points. We've seen those losses accelerate in the afternoon session here, off about 3%. But the Nasdaq, as we've been pointing out, the one to watch here, especially as we've seen this continuation of what we saw play out last week with the big tech names dragging down the broader index. The Nasdaq now down 4.5% or just over that, and the S&P 500 down about 4%. Coming up, we're talking about one of those funds that is getting hit hard here. Headwinds mounting for Cathie Wood's ARK funds. Its short interest grows. Our very own Inez Frey is going to break down the market action for us on that front on the other side. Welcome back to Yahoo Finance Live. Continues to be risk off in the markets today, with the Dow now down more than 1,000 points. About 3% decline is what we're looking at. The Nasdaq down about 4.5%, and the S&P 500 down nearly 4%, continuing those declines we saw from last week. One of the big ones getting hit here, Kathy Wood's ARK funds. And if you look at the innovation ETF alone, down more than 8% today on the day. We're talking about this as more and more short interest grows. Let's bring in Yahoo Finance's Inez Ferre, who's watching that story for us today. Inez.
And Akiko, that's right. ARK Innovation getting hit recently. But if you take a look at the flip side, there is a lot more short interest. And in fact, you've got this anti-ARK ETF called SARK. That's Total Capital Short Innovation. And that is up 8%. Let's see if we can put the chart up for that one. And this is a fund that is less than 3 months old. And it basically shorts ARK Innovation's ETF. Now, you'll recall that ARK Innovation has holdings like what you see on the screen right now. You've got Tesla, Zoom, Spotify, Coinbase, Shopify. It's all of these high growth names that are betting towards the future. But what SARK is doing, SARK, that fund is shorting this fund, and that fund actually has amassed $234 million in assets. And this is from Matthew Tuttle's Tuttle Capital Management. SARK is up 50% since its November launch. So when that ETF is up, the other one is down, obviously, as short interest has really increased in ARK Innovation. And in fact, Tuttle has said that on days when ARK is up, he's even seeing inflows on those days. So that basically lets you know that investors are betting that these high growth names, these momentum names, have more of a haircut coming in the future.
Speaking of haircuts and what we're watching in the future, we have to discuss the SPACs in the room and on the street, because 2020, 2021, it was massive in terms of the growth year over year, 248 in 2020, 613 in 2021. And so what is 2022 looking like for SPACs, for better or worse, this growth that we've been seeing?
Yeah, it's not looking too good right now. In fact, shares of half the companies that finished SPAC deals last year, those are down 40% or more. And that's from data by FactSet that was cited by the Wall Street Journal. You've got tighter regulation from the SEC. Now, the SEC wants more disclosures when it comes to these SPAC deals. And investors have been pulling their money out of these SPAC deals before they even are completed. Because remember that investors can put their money into these blank check companies. Then the blank check company announces their target, the company that they're going to merge with, and then hedge funds have been, in some cases, pulling their money out after these SPAC deals have been announced. That's what happened with BuzzFeed. BuzzFeed lost a large part of its investors before the deal had even closed, and this leaves those companies that are merging with these blank check companies with less proceeds at the end of the day. Brad? Akiko?
Yeah, that was a classic case of seeing the de-SPAC actually move the company in the wrong direction in terms of the number and the amount of funding, rather, that they were looking for. And that's great to speak with you here on the day and get this breakdown and outlook for what we're looking for in 2022 on the SPAC front. Inez Ferre, Yahoo Finance's own. And everyone, we want to give you another look at the market sell-off that we're tracking here on the day. We are in about the lunchtime phase of today's trading activity, and we're seeing the Airbnb shares move lower by about 13%. Also down 13%, you've got Moderna, ticker symbol mRNA there. Netflix in the red, similar to its logo, unfortunately, 10% in the red. And you've also got NVIDIA there, losing nearly 10% on the day. We'll continue to keep an eye on all of these laggards within the Nasdaq Composite as well. And coming up on the other side of this short break, in-home fitness, it bridged workout routines during the height of the pandemic, but gyms and boutique fitness classes are clamoring to revive their experiences and memberships. We speak with the CEO of one such company after the break. right. Well, it's very clearly a no bones day on the market here as you're taking a look at the Dow Jones Industrial Average chart here, blown up for you on your screen as we are down by a little more than 1,000 points right now, just about 3% in negative territory. We've continued to track declines on the day for the Dow Jones Industrial Average, as well as the other major averages you're seeing in the bottom corner of your screen. The Dow, the Nasdaq, and the S&P 500 are all in the red. The Nasdaq Composite down the most on a percentage basis. And so we'll continue to track that for you on the day. The Nasdaq Composite down by about 4.4% as of right now. As we keep an eye on that, we're also keeping an eye on one particular industry and how it's charting its path for reopening. No friends in the fitness industry for these companies. While Peloton faces headwinds for connected devices, plus an activist investor calling for an executive overhaul on-premise gyms and classes, they are trying to chart their own return to normalcy. And so here to discuss the state of fitness, we have David Long, who is the CEO of Orange Theory Fitness. David, great to have you here with us, and thanks so much for taking the time. Orange Theory, it had built a $1 billion unicorn status and sales, I should say, prior to the pandemic. So how has the pandemic reshaped the operations and even the correlating valuation, perhaps?
Yeah, thanks for having me on, Brad. Yeah, we reached 1.4 billion in 2019. Didn't know it was around the corner. And I think what's really been fortunate is we pivoted very quickly during the pandemic. We provided both complimentary workout of the day to our members around the world, as well as a live interactive experience. So our members, through temporary closures, could stay in the habit, which is so important, and stay in the habit of their regular exercise. As we come out on the other side of this and we look back at 2021, we added 500,000 new members to the Orange Theory brand worldwide. So even through Delta and through Omicron, we had incredible growth last year. And we really expect over the next few weeks to be back on that 10-year growth here that we've had.
David, the recent headlines around Peloton and the fact that the company is halting some production of its equipment products has raised, or sparked a lot of conversation about what the future of fitness, the gym looks like. They're one of the big beneficiaries during the pandemic, but what are you seeing? How's it evolved now that we're kind of in this space where, yes, the pandemic is still ongoing, people are still kind of learning to live with it?
Yeah, it's a great question. I mean, the at-home fitness had been around for decades before. It just obviously was in the limelight during the pandemic because that was really the only option. And I think this is really an and, not an or discussion. And as we learned from our members over the first decade and surveyed them every month throughout the pandemic, we learned that they just can't replace the in-studio experience, or the coaching, the accountability, the motivation, and that feeling of accomplishment of going to an on-premise studio. And so as we've come out of this, we really believe that that's still the cornerstone of most people's fitness regimen. And I think the advancement of digital platforms, and when we have our own, are really good ancillary and off days. But the core of really having somebody progress, understand how they're motivated and how they're getting results really still lives inside the studio.
I would love to know what the interest from potential franchisees looks like right now, incurring some of those costs to get off the ground and then continuing to try and woo members into that in-person experience with the precautions in place as of right now on a state-by-state basis.
Yeah, and so we're fortunate that our brand, pre-pandemic, had really more demand than supply for new franchise units to open, and it's the lion's share at existing franchisees that are growing. And so if you could imagine, that did slow during the pandemic, but we expect our growth throughout 2022 to pick up as far as new studio openings. And then when you look at the new member acquisition marketplace, it obviously varies by DMA. There are markets that have more restrictions. And we learned very quickly, back in 2020, how to provide the safest environment, how to pivot when restrictions change, and make sure that we're communicating really crisply, both to our existing members as well as folks that want to try us, so they know what to expect before they decide to walk through the doors and try Orange Theory for the first time.
Where are you right now compared to pre-pandemic levels? I mean, number one, if you're still behind, what do you think it's going to take to get there? And ultimately, in terms of recruitment, getting new customers through the door, is it about a better price point? Is it about safety? What are you hearing?
I think the right price point and making sure that the safety is there is really table stakes for us. It's really about building on the great experience that we already have and driving results and really showing incredible value for people that are only going to take 2 or 3 hours out of their week to make fitness a priority, and we have to deliver a great deal in those 2 or 3 hours. That's really been the cornerstone that's gotten us to this point. And when we look at recovery, some markets are very close to 100% recovery. Others are lagging because of longer term restrictions. But when we look in aggregate at our global business, we really expect to be back to 100% or plus recovery in 2022. And that's the way we're trending so far this year.
Yeah, I know a lot of people are itching to get back in the gym. David Long, It's good to talk to you today, Orange Theory Fitness CEO. Let's turn our attention back to the broader markets as we count down to the close here in what has been a ugly start to the trading week. The Dow now down about 3% here. The Nasdaq down 4.5%, with the tech names getting hit the hardest, and the S&P 500 down about 4%. It's also risk off for crypto as we watch that slide. More than $130 billion wiped off in 24 hours. We're going to be discussing the outlook as another country considers an outright ban on Bitcoin mining. We'll be right back. We're seeing cryptocurrency taking a major hit today, along with the broader market, and with Bitcoin hovering around that $34,000 handle. Bitcoin and Ether down more than 50% from the all-time highs. Let's bring in CoinDesk Global Macro Editor and CoinDesk TV anchor Emily Parker. Emily, it feels like there's not a lot of places to hide today, and Bitcoin certainly no exception.
That's absolutely right. As you just pointed out, this is part of a larger global macroeconomic story. We're seeing, a crash in the overall market as well. And there is no place to hide, not just for Bitcoin, but a lot of the altcoins are falling as well. So this sort of challenges this narrative of Bitcoin being a unique asset because it is performing like stocks. And it also challenges the narrative of Bitcoin decoupling from altcoins because a lot of them are falling as well.
And so as we were tracking some of those altcoins as well, I think even as we continue to kind of annex Bitcoin and Ether, given their top 2 cryptocurrency kind of market cap. At the end of the day, is this one of those moments where we could potentially see coming out on the other side of this, that furthering of this idea of the flippening in the future, and how far off from that would we potentially be?
Well, I mean, Ether's taken a pretty big hit, right? But so is everything. So I feel like it's just real. I mean, right now we're just seeing all the coins kind of moving in tandem. And I just, it's just really hard to know, because in theory, all of these coins perform differently. I mean, ETH performs very differently from Bitcoin. It's used for completely different purposes. It's fueling the NFT world. It's fueling the metaverse world. So these are completely different animals, but right now they are behaving in a similar way.
We've got a number of other headwinds that investors are watching in the crypto space too, Emily. Number one, Russia considering an outright ban on crypto mining. And then you've got the Biden administration reportedly working on an executive order on cryptocurrencies. How do you think that's going to weigh on the price moves?
Yeah, so let's start with Russia. So Russia has basically threatened to ban cryptocurrency trading and mining, which is a really big deal because Russia is an important cryptocurrency market, and it's also a really important center for cryptocurrency mining. We don't know if they're actually going to ban it, but they're threatening to. But the thing is I don't really think that that's the major driver behind the price crash, because when we first heard the Russia news, actually Bitcoin briefly went up. So it didn't react immediately to the news from Russia. It kind of reacted later. But yeah, I mean, if Russia actually does ban crypto, I think we will see a notable effect. It's interesting to think about why they might be doing it. It seems like one reason is potentially to stop crypto donations to opposition parties. So that is one possible motivation from the Russian government. As for the Biden executive order, this is also quite interesting. We might see something like this quite soon. Basically, the Biden administration is addressing a very common criticism that the US has a lack of clarity on crypto policy. There's just too many agencies involved. Very few people understand who's in charge of what. So this is an idea to get a little bit more of a cohesive approach to crypto at a federal level. So of course, it depends on actually what the results of this will be, but it could potentially be good for the industry.
Emily Parker, CoinDesk Global Macro Editor and CoinDesk TV anchor, joining us today. Thanks so much for helping us break down a lot of the moving parts to this story and the moving price action on Bitcoin and other cryptocurrencies as well. All right, everyone, take another look at the Dow Jones Industrial Average here. We're off of today's session lows, but still hovering in that range, unfortunately. Down right now by about 900 points, 33,356 is where we find ourselves at this point. It's a move lower of about 2.7% if you want to round that off, nobody would fault you. The Nasdaq, though, the deepest declines that we're seeing here on the day. And we've got our own Jared Blickry, who's going to be breaking down even more of that for us. So, Jared, let's get into it on the other side of this short break. All the King's horses and all the King's men couldn't find a safe spot in the markets here on the day if they tried. We're taking a look at the major averages. We're down across the board right now. The Nasdaq seeing the biggest declines, but off of the session lows. The Dow down by a little more than 900 points at this point in time, 2.74% in negative territory. S&P 500 also negative. We teased it before the break. Our own Jared Blickery is in studio and is going to give us a breakdown of exactly where some of this activity is taking place. He's got the map fired up. Jared, let me toss it on over to you.
All right, and I appreciate that intro here. Kind of an inauspicious start or return to the office here, at least for me. I hope to see you guys in a couple weeks here, maybe another month. And Brad, I know you're just 5 floors above me. So let's get straight to the markets. Nasdaq was down 4% at the lows. You can see it's off a little bit less than that right now, but a lot of carnage around the world. Europe just settled over an hour ago. We got Frankfurt down 3.8%, the CAC 40 down 4%. And let's check out the intraday price action on the Dow here. You can see almost hit 1,000 to the downside a little bit ago. And here we go. We are off the lows just a little bit, but it has been a slow and steady slog all the way down. And here's the Nasdaq down almost 4%, very similar chart. And the Russell 2000, going to spend a little bit of time on this because I want to put a 2-year chart and just show what's happened. Russell 2000 set for a bear market, to plunge into a bear market on the close. It would be off 20% from this high that we saw in October, November of last year. It was trading sideways, broke to the upside, and now we got a breakdown, and that is a big breakdown indeed. Also want to take a look at the S&P 500 on a longer term basis because we are giving up a lot of territory here. Let me just go to a 6-month chart and put the candlesticks on, and you can see what has happened over the last few days. Boom, 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 boom. This is not capitulation just yet. I'm thinking we're going to see more of this into Jerome Powell's presser after that FOMC decision at 2 p.m. on Wednesday. So everybody keep their eyes open for that. But in the meantime, we want to keep our eyes on the VIX because that is elevated. We have now hit almost 40. Haven't seen a level like this in, I believe, over a year. Here's a 2-year chart, and you can see you'd have to go back to early 2021. It may have taken out that high as well. So really seeing the fear in the fear index ratchet up here. A little bit of a respite in the bond market, down 2 basis points. That's the 10-year T-note yield. The 5-year down a similar amount. So is the 30. So the bond market really causing a lot of angst to stocks recently, but sometimes selling begets selling and weakness begets weakness. Here's a 2-year chart. Let me dial this back down to a 1-year. That's a 13-week T-bill. Rising ahead of the Fed, expected to raise interest rates. It looks like we have a tantrum on our hands, and we don't even have the taper completed just yet. Now, here's the dollar. Also looking at this, this was a flag pattern, got a breakdown here. Now that looks like a false breakdown, so higher dollar around the world. We're seeing the U.S. dollar versus a ruble at multi-year highs, so very much putting a pain trade on some Wall Street investors. Here's the sector action. All red, lots of dark red to the downside. Tech, XLK is off 3.5%, followed by consumer discretionary. That's off 3%. The least bad, we got staples here. That's down 1.5%, followed by utilities, but very, very defensive setup there. And let me just put the NASDAQ on, and we can see the carnage. This is only today. Tesla down another 7%, Amazon, Apple, each down more than 3%, guys.
Yeah, there's no positive spin on this, Jared, but appreciate you breaking that down for us. We've got much more to come on the other side. We're going to continue to watch the markets closely as we see this sell-off to kick off the trading week. We'll be right back. Welcome back to Yahoo Finance Live. A move to risk off here in the markets to kick off the trading week as we continue to watch the sell-off on Wall Street. The Dow down about more than 700 points now. The Nasdaq continuing to be the big laggard on the day, with tech stocks selling off in a big way. Now off of the lows, but down about 3%. And Brad, certainly a lot of things in focus here. The Fed, of course, the FOMC policy meeting kicking off tomorrow. A lot of investors going to be looking to that Fed statement on Wednesday, whether in fact the central bank turns more hawkish. But easy to forget, in this big sell-off, we're still going to see a lot of drivers potentially later in the week with some big names, Microsoft and Apple, reporting their earnings.
Yeah, that's right. As the Nasdaq is getting cooked here on the day, we're taking a look at Microsoft. Of course, they're going to be reporting on Tuesday. Wednesday, we've got Tesla. Later on in the week, we've got McDonald's and Apple as well. So we're going to be breaking down and watching all of those companies moving forward throughout the rest of the week.
Certainly going to be watching that as well. In the meantime, we're going to wrap it up here for our 2 hours, but much more to come here on this market sell-off. Keep it right here on Yahoo Finance Live.
An ugly day on Wall Street with the Dow tumbling 1,000 points and the S&P 500 slipping into correction territory as the stock market stages a broad-based sell-off. How much lower will stocks go, and how can you protect your portfolio? It's hard to find winners today amid all the carnage, but we found some. Kohl's, Peloton, and Unilever all higher after activist investors demand change to unlock shareholder value. We take a closer look at what's quickly becoming the year of the activist investor. And later, cheese fondue. It may seem like a questionable dining choice during COVID, but the Melting Pot restaurant chain says business is better than ever. We speak with the CEO about how they're dealing with higher inflation and an uncertain economy. Hello, everyone. Welcome to Yahoo Finance Live. I'm Alexis Christoforous here with Karina Mitchell, and the selling has just intensified on Wall Street. The Dow down more than 1,000 points. The S&P 500 now in correction territory, and the Nasdaq off about 4%. And Karina, more than a third of S&P 500 stocks are more than 20% below their 52-week highs.
That's exactly right. It is an ugly looking day across the board. And let's get right to those numbers. The Dow seeing its seventh straight down day. It was off by as much as 1,000 points, slightly off session lows at this point. The S&P was down more than 10%. It is in correction territory as well. Its fifth down day. And the Nasdaq falling deeper into correction, seeing the steepest declines. Looking at those numbers, you can see the Nasdaq is off by 483 points. Sector-wise, no safe place to hide. All sectors in the red. Tech is the biggest loser, consumer discretionary, and energy also seeing a down day today, and the VIX up near 40 at the moment. Over to the bond market to take a look what's happening there, and we can see the 10-year also lower, slightly lower at 1.72 now. That is ahead of the FOMC meeting. And Bitcoin also taking a bath before a remarkable reversal. It is now up by 33 points. That is hard to believe. About 130 billion was wiped off the crypto space in just about 24 hours. But now you see Bitcoin is in the green. That is about the only thing we see in the green. And with more on what is a grisly looking day, let's bring in Yahoo Finance's Jared Blickery in studio.
Thank you, Karina. And let's get straight to the charts here. I don't even have to say it. Let's go to the Wi-Fi Interactive. We are right here. Dow, as you said, was down about 1,000 at the lows. So it is off of the lows right now. And we can see on the intraday price action, not by much right here. And it's the Nasdaq that's really taking it on the chin. We saw the Nasdaq off 4% at these lows. And we haven't seen a down day like that in some time. S&P 500 not looking that much better. And the Russell 2000 just spent some time looking at a longer term chart, but the Russell 2000 set to enter a bear market on the close. And how did we get here? Well, the Fed has definitely taken a hawkish pivot recently, but we have that big meeting on Wednesday, and we also have that big Chair Powell presser on Wednesday as well. I think that we have probably reached peak hawkishness in the Fed, and the Fed's going to dial back some of that. With the Russell 2000 in a bear market, with the S&P 500 and NASDAQ in correction territory, you got to think there's a little bit of dovishness coming our way, but is it going to be enough? The market will tell us. Here we have Apple and Amazon. Those are each off more than 3%. So are Alphabet and Microsoft, by the way, and Tesla off more than 6%. And just to make things a little bit worse, I'm going to give you the first 15 trading days of the year. That is 2022. We're seeing Amazon down 17%, Tesla right there with it, and Microsoft down 15%. Let's go to the sector action. And you can see energy. This is the last 15 days as well. Energy, the only sector in the green, but we were looking at gains of 15, 16%. Even energy getting wiped out here. And let's take a look at the sector action for today. Tech, the one dark red spot, that is down the most, about 3.25%, followed by healthcare. And, you know, if you were looking for some green, I will give you some green here. Kohl's on a merger Monday has some news. They basically firmed the news. Looks like we got rid of that. They basically firmed some of the news we got over the weekend about a possible takeover. And Wall Street analysts are saying that the price a little bit too low. So we're seeing some nice bounce here. Let's take a look at some of the others, and we can see also that Shopify being down 4%, Amazon down 3%, but some of those green names looking a little bit better. And let's see if we can find this on a market cap basis. Not really seeing the ticker I'm looking for, but we can see Macy's in sympathy. Maybe somebody would like to take over Macy's as well. Macy's up 11% today. So that is your source of green. You take a look at the travel sector, looking pretty bearish here. Carnival Cruise Line, that stock is down more than 6%. So is Norwegian Cruise Lines. Airbnb down 11%. And let's take a look at a one-year chart. A lot of these stocks peaked one year ago, and that looks to be the case with Airbnb, now down 23% over the trailing year. And we got to take a look at Bitcoin because, well, you blink and it's gone back into the red. Sorry about that, Karina. But you take a look at what's happened over the last year. We have given back almost all of the territory gained since August, and we're getting down to that 28 to 30,000 level. That is a huge potential area of support. But if that breaks, look out below. I'm going to put a 2-year chart on. We're going to see could easily hit 20,000, even 13,000. But that is about the lowest price target, at least that I have heard from the street here, guys.
Wow. All right, Jared, we're going to talk much more about cryptocurrencies a little later on in the show, but thanks for finding some green amidst the sea of red today. From tech stocks to cryptocurrencies, we're seeing investors flee these riskier assets. I want to welcome in now Tom Essay. He is founder and president of the Sevens Report. Tom, good to see you again, and thanks for being with us. I think the question on everybody's mind is, first off, why the aggressive selling today? And are you seeing any signs that the end could be near? Perhaps there's a capitulation on the horizon.
Hi, Alexis. Thank you very much for having me on. I think that you know, all of a sudden the market has really been faced with multiple challenges, and some of them have been looming, and now the market really, investors have to face them. So we have a more hawkish Fed. Earnings are so far not spectacular, which is a change in the last several quarters. And now we have geopolitical issues going on with Russia, Ukraine, and NATO. Throw it on top, still more pain in the growth area of the market. And look, you know, it's clearly a bit of a rout today, but now all of a sudden we are getting into an area where you can start to discern some value in the market. We've come down pretty quickly, and while I'm not going to say today is the bottom, we're certainly getting to an area in this market where a lot of future bad news has been priced in, and now all of a sudden it's looking like a much more balanced risk-reward outlook.
So it sounds like you're saying that there may be some opportunities even amid all of this volatility. So where are you looking at?
Sure. Hi, Kiko. So basically, we're looking primarily in the value space, right? We do like the value names. We do still like financials, especially insurance companies. I know banks are getting hit because of earnings, but we like insurance companies. We like large cap, especially here in the U.S., and then very high quality tech. I mean, one of the words we're using a lot in the report is quality. Lower PE names with strong cash flows, good dividends or share buybacks. Look, I mean, we were listing some really good stocks that are down a lot. Microsoft down double digits, Amazon down double digits. We don't know if this is the bottom, but that's not Bitcoin, right? I mean, these are companies that make a lot of money. So I think for investors that can stomach the volatility and have a longer term time horizon, it makes sense to be nibbling on the buy side today.
You know, is there anywhere to hide right now in this market? Is any place considered safe? I mean, if you're sitting on cash, is it best to sort of wait this out and see where the chips fall? Is it better to put that money to work in something like the Treasury market? What do you do?
I wouldn't go into treasuries. I think that inflation is here to stay. We don't know exactly how high it will be, but it's here to stay, and that's negative for bonds. I think that there is something you can do. You can go into these high quality names, these large caps, value ETFs. I think that's the best place to hide because, frankly, the economy is not rolling over, right? I mean, they're all of a sudden everybody's gotten really afraid. Oh my God, the Fed's going to hike 4 times, and they're going to do quantitative tightening. Well, we're still at 0% rates. I mean, they're still actually doing QE today, right? So the economy is not about to nosedive. I know the PMIs were soft this morning, but that was Omicron related. So I think if you look to these companies that are cyclically oriented, again, going to your financials, your materials, your industrials, large cap, low valuations, that's the place to hide.
And then, Tom, you know, the Fed starts its 2-day policy meeting tomorrow. What do investors want to hear on the other side of that meeting?
They want to hear that the Fed is not going to kill the recovery, essentially, right? So I think more specifically, it would help if Powell sort of diminished the talk of 5 rate hikes. If he stuck to 3 or 4, I think the market can live with that. That's priced in. And then perhaps most importantly, he needs to sort of defer on quantitative tightening and or balance sheet reduction. If he does that, it'll help the market calm down a bit and sort of stop thinking that the Fed is all of a sudden on this kamikaze run that's going to crash the economy, which isn't what's happening, right? But markets get ahead of themselves, and that's where we are right now. So I think that Powell can take the press conference to soothe the markets in the context of rates rising. We are getting a rate hike in March.
Tom, what do you do with oil at the moment? It looks as though things are intensifying, as you said, between Russia, Ukraine, and NATO. So where do you put, excuse me, where are the opportunities there? I mean, you look at oil today, it's actually down more than 2%. You might actually think it'd be rallying with, some sort of military activity seemingly imminent in that part of the world. And if something does happen there, what happens to the overall stock market?
Yeah, I think that oil is just sort of being sucked in with everything else going risk off today, right? But I think oil is still very well positioned because we have constrained supply still coming out of the pandemic, and we have strong demand. Remember, the stock market is not the economy. The global economy is actually still doing quite well. We're not seeing this huge decline in global economic demand due to Omicron, and Omicron is now thankfully fading quite quickly from the global scene. So I think that the fundamental outlook for oil is very positive, and we need it, right? We don't have very many sectors that are doing very well in the market right now. Energy is one of the few. So I think we need oil to continue to do well. If you see oil roll over hard, that's just going to make people even more nervous about future economic growth. It's going to be a pile on. So I think for the good of the market, we need to see energy hang in.
All right, Tom Essay, founder and president of Sevens Report Research. Thanks for being with us on this wild day on Wall Street. And a reminder to step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. You'll get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek ad-light experience. You can check it out at yahoofinance.com/plus. The head of the World Health Organization says we could see the acute phase of the pandemic this year. What will it take us to get us there? Here's another live look at the Dow Jones Industrial Average, now down more than 740 points, was off more than 1,000 earlier. Much more on the market sell-off straight ahead.
Welcome back to Yahoo Finance. Well, the Federal Reserve kicks off its two-day policy meeting, and investors are anxious to hear what is said at that meeting and if things turn slightly more hawkish. Here with more on that is Yahoo Finance's Brian Chung. Investors are very anxious right now, Brian. What will the Fed say and do?
Absolutely, Karina. A lot of people are hinging their moves, perhaps, on the words of the Federal Reserve Chairman Jerome Powell, who will be speaking at 2 p.m. on Wednesday following the Federal Reserve's first policy-setting meeting of 2022. A few important things to remember as we head into that meeting, which is going to kick off tomorrow, but we won't get the policy statement until Wednesday afternoon. First of all, there's no expectation for the Fed to begin raising interest rates in this meeting, and that's because the Federal Reserve needs to wrap up its process of quantitative easing first. Keep in mind, that's the Fed's process of buying assets in the open market, U.S. Treasuries and agency mortgage-backed securities. It was a pandemic-era tool to message to markets its intention to keep its money printer on. The Federal Reserve had set a course in December for that process to end in mid-March, and the Fed has very clearly said that it won't start to raise short-term interest rates until after that process is done. So it's more likely that in the absence of a interest rate hike this week, Federal Reserve Chairman Jay Powell will more likely tee up that first post-COVID interest rate hike coming in March. Now, again, I want to remind our viewers that the jittery-ness that we've seen in the markets is due to a number of factors. The last guest, for example, was pointing to geopolitical risks that have nothing to do with the Fed, but it is indeed the case that some of the likes of Goldman Sachs, for example, have noted that it's possible the Fed could get even more hawkish than the 4 interest rate hikes that a lot of those on Wall Street are penciling in. But of course, keep in mind we haven't heard any new commentary from the Fed over the last week or so because of the customary blackout period ahead of the Federal Reserve meeting where no Fed speakers speak. So the sell-off that we've seen since Thursday afternoon is not because of any new Fed speak. It could just be jitteriness ahead of that anticipated meeting later on this week. Karina?
Hey, Brian, what would Powell have to tell the markets tomorrow to sort of ease some of their concerns? Would it have to be, hey, look, we may not raise 5 times, maybe we're going to raise rates 3 times this year?
Well, again, he won't be speaking tomorrow. He will be speaking on Wednesday, but the Fed chairman is expected to have that press conference, as is the case customarily for the Fed chair to speak at each of the 8 yearly meetings. But when it comes to rate hikes themselves, keep in mind that when we talk about the number of rate hikes, and by the way, those are about 25 basis points each is colloquially what people mean when they say one rate hike. That is a lot of that is coming from the projections that we get from the Fed's dot plots. That's the summary of economic projections, essentially, where the many policymakers on this committee plot out where they could see interest rates going in the next few years. And you can see ahead of you on the screen, the last update that we had was in December, where the median member of that 18-member committee saw the case for at least 3 interest rate hikes through the end of this year. But we are not going to get an updated version of that dot plot in this month's meeting, and that's simply because the Fed only does that 4 times a year. It only happens in March, and then in June, and then in September, and then in December. So we're just not scheduled to get another one of those updates. And outside of that, the Fed chairman tends to shy away from speaking on behalf of the entire committee in saying X amount of rate hikes or Y amount of rate hikes in a given time period. Instead, though, expect to see the Fed chairman be very, very kind of stern on the idea of raising interest rates as much as they have to get inflationary numbers down. CPI showing 7% year-over-year increase. Fed chairman told Congress 2 weeks ago that if we have to raise interest rates more, we will.
All right. Thank you so much, Yahoo Finance's Brian Chung. Investors really looking for any kind of dovish clue from the Fed on the other side of that meeting. All right. Want to bring in now Yahoo Finance's Inez Ferre. And Inez, there is certainly no safe space in today's session. Virtually nothing. Everything looks to be in the green. Meme stocks as well.
That's right. Meme stocks in the red again today. And take a look at our Wi-Fi interactive board. There's only a couple of names in this meme stock chart that are in the green, that being Macy's and also Dillard's, in sympathy with that Kohl's headline that Jared had been mentioning earlier in the hour. But let's take a look at the flagship names. AMC and GameStop down 10% for AMC. In fact, I'm going to pull up a 1-year chart because AMC is trading at $16 a share. We haven't seen this price since around May of last year. That's when the stock really took off. So anybody that held this stock, that bought after May, bought above this price and held it for all this time, has seen losses, because we are watching as this stock has been heavily under pressure, along with GameStop as well. GameStop right now at $96 a share, prices that it hasn't seen since February of last year. You'll remember that this stock was at an all-time high, intraday high of more than $483 a share back in January of last year, when this whole GameStop meme stock phenomenon really started. I'm going to pull up a 2-month chart so you can see the losses in some of these names. AMC, GameStop down more than 50%. And I also want to mention Robinhood. Over the last couple of months, this stock has been under pressure, but take a look at this 1-year chart that we're looking at. This company went public back in July of last year. It hit an intraday high back in August of $85 a share. It's now more than 80% off of its peak. So you can see the decline in Robinhood. This is seen by some as sort of a proxy for retail traders, because this company saw a huge influx of retail traders. It saw large volumes of crypto trading, especially in the second quarter of last year and in the first quarter of last year, at the center of also the GameStop phenomenon. Reporting earnings, by the way, this Thursday. So we'll be taking a look at those earnings after the bell on Thursday for Robinhood. But overall, a tough day for meme stocks, and it has been really over the last few months.
Okay,
it has
indeed,
been
a tough day.
Sorry
Alexis,
about that.
did you
I
have
just
a
had I had a quick question for Inez. Are there any, Jared brought us some bright spots earlier. He had mentioned Kohl's and some of the other retailers rising, sort of in sympathy with it. Are there any of these meme stocks that are bucking the trend and investors are pouring money into that speculative space?
You know, I took a look at the 2-month chart, and you can see that over the last 2 months, you did have Hostess Brands that's in the green, even though today it's in the red. But over the last couple of months, up 6%. You also have a small biotech firm here. Look, a lot of these names are also meme stocks for a short while, or they may be more trade swings. Really, GameStop and AMC are sort of the flagships that retail traders have said that they will hold, and that this is a long for them, and they want to really stick it to the short sellers. But overall, you have seen the overall basket that's been lower.
All right. Thank you so much, Inez Ferre, for that report. It is certainly a tough day across the board. We're going to take a quick break. On the other side of it, we come back and check the markets for you as well. The benchmark's now off session lows, but still deeply in the red. Also, activist investors turning the screws on Peloton and Kohl's. More on that story coming up.
Welcome back, everybody. A dramatic day on Wall Street. There you see the ugly truth of it. The Dow Industrials down more than 2%. As bad as this is, the Dow was down 1,000 points briefly today before bouncing back just a little bit. The S&P 500 slipping into correction territory today, down now 10% from its recent high. And the Nasdaq already in correction territory. It's off another 2.75% right now. Taking a look at the bond market as people continue to flee these riskier assets, including Bitcoin, by the way. We do have the yield on the 10-year at 1.72%. The yield on the 30-year down as well to 2.06%. And one thing that is up for sure today, the VIX. Yep, that fear gauge. It is now at its highest level in months. It is up now better than 20%. Well, 2022 is still young, but it is shaping up to be the year of the activist investor. We have got shares of Peloton, Kohl's, and Unilever bucking the downward trend today. All of them are soaring as activist investors demand change at those companies to unlock shareholder value. Yahoo Finance's Brian Sozzi has been watching this story, which has been changing throughout the weekend, Brian. And I know that you reached out to Peloton, curious if they had anything to say.
Yeah, this is turning into a pretty ugly situation over at Peloton, Alexis, which now has an activist investor knocking on its door for the first time since going public a couple of years ago. And that activist investor is the little-known Blackwell's Capital. That founder, or the chief investment officer, Jason Antabi, sending a very scathing letter to Peloton's board of directors today, demanding that the CEO, chairman, and founder of Peloton, John Foley, that he be fired immediately, not laid off, is fired completely. And the team at Blackwell's, which a source telling me has amassed close to a 5% stake in Peloton, highlighting a series of just grievances with Foley's leadership, whether that is how he handled the response to the consumer safety issues on the treadmill, to even, and he took it here, Peloton, Foley putting his wife, Jill Foley, in a key executive position inside the company. So you have a bigger story on this on the Yahoo Finance platform right now. But again, this is an interesting situation. And it comes at a time where Peloton stock is down about 83% over the past year, tons of mistakes, operational miscues at the company. What I do find interesting here, Alexis and Karina, is that this activist attack comes despite Foley and other insiders having a voting control of the company. They can vote. They essentially can manage what decisions the board makes. So that is not normally a company or a situation that an activist will attack these dual class structures. But nonetheless, you get the sense there could be some real changes coming to Peloton very soon.
Yeah, exactly. With a 5% interest, it's kind of, how much muscle power does Blackwell's really have? But more bad news may be on the horizon for Peloton because they are reporting earnings, I think, first week of February 8th. And based on guidance, it's not looking that great.
No, the company was forced last week on a report from another news outfit that they were just halting all their production. They came out and pre-announced those results, and they weren't that good by any stretch of the imagination, Karina. They missed on their subscribers. Revenue was under pressure here. And you get in the sense when these earnings, these full results come out on February 8th, likely to see more losses, have to wonder if there will be any guidance from the company, and it'll probably be another stinker of a quarter from Peloton.
Before we let you go, what's the latest on Kohl's? I know they're entertaining 2 possible takeover offers right now. And also Unilever joined the group over the weekend. Nelson Peltz, activist investor there, demanding some change.
Yeah, it really is turning into the year of the activist investor, like you mentioned, Alexis. And what you're seeing with Kohl's here, now 2 reportedly competing bids for the company. First, coming out of Starbird, about $9 billion reported bid here. Source tells me that is a legitimate offer that has been put on the table. And then the other one from retail private equity giant Sycamore Partners. So 2 big names in investing here, really kicking the tires on Kohl's, which has been a bad laggard going on a couple of years here. Hence, you've seen an activist investor, Jonathan Duskin over at McCallum, attack the company. We had him on last week here and really voicing a lot of important grievances with them. And then Unilever, I mean, really a dog of an investment the past 5 years. Stock is only up 32% compared to about an 87% return for Procter & Gamble, which is one of their key competitors. And the last thing you want to see, Alexis, you've covered a lot of activist cases in your time. You don't want to see Nelson Peltz over at Tryon kick the doors down at you because he is one of the most aggressive names in activist investing, and big changes can be coming to Unilever as well. He already drove a lot of changes when he tried to shake up P&G a couple years ago. That has worked out well for the company.
And then Brian McCallum also pressured Kohl's recently, to boost stock and do better business, basically. And Kohl's had a response for them. They said they are making initiatives and strides.
That's what they say, Karina. I've covered Kohl's, the Kohl's disaster for some time. This is a company that has consistently hyped its own performance despite really having any numbers that back up these claims. Margins have underperformed rivals. The stock price has stunk. And you have a clear, I think, a series of missteps within their own management team that when you have those things come together, you see a McCallum come up here and demand changes. And I do think some form of sale of this company is coming soon.
Yeah, I think that's a fair assessment, calling it the Kohl's disaster. I know you've been on top of it all for us. Brian Sazi, thank you. It is one of the most anticipated earnings reports of the season. Tesla is getting ready to show investors its bottom line. That's going to happen Wednesday. We've got a preview for you right after this.
Welcome back to Yahoo Finance. Well, stocks are taking a big hit at the start of a packed earnings week, with Tesla being one of the companies reporting its quarterly earnings this Wednesday. Here to help break down what's in store for the EV giant is CFRA Research Senior Equity Analyst Garrett Nelson. Garrett, thanks so much for being here. What do we expect from those earnings results? I know for the previous quarter, revenue came in at $14 billion. And then what is the outlook for revenue going into the rest of the year and perhaps next year as well?
Well, thanks for having me. You know, all signs here point to another very strong quarter for Tesla. We know what their production and sales were for the quarter in terms of vehicles sold. That came out a few weeks ago, and it was a record high quarter for Tesla. So they've also gotten really good at beating consensus. So Tesla has now beat 8 of the last 9 quarters. So, but we think with the record quarterly production and the sales that they posted for Q4, that really bodes well in terms of their ability to beat, just given the high fixed cost nature of auto manufacturing. When you have a quarter and when you have such strong volumes, that tends to really drive down unit costs and gives them a lot of bottom line leverage. So we're expecting another very strong quarter, and really investors will be focused on what guidance they provide in the release.
Garrett, you have a buy rating on Tesla right now, 12-month price target, $1,250. What do you see as possible headwinds to that target and to that rating?
Yeah, the stock's really pulled back significantly since the start of the year, and it's this broader sell-off in the higher growth stocks. A lot of tech stocks have sold off. Tesla trades more like a tech stock than an auto manufacturer, so we really view that as a buying opportunity. In terms of headwinds that we're looking at, it's really consistent with what the headwinds that are facing all auto manufacturers here, which is supply chain issues and semiconductor shortages. But Tesla's done a very good job navigating those headwinds. And we think there's potential upside to 2022 consensus numbers with their 2 new factories starting up. We think the startup of the new factory in Texas is now imminent. And then the startup of the new factory in Germany will be coming probably in the second quarter. So, we're very bullish on Tesla. We look at consensus numbers, and those 2 factories will essentially double Tesla's production capacity when they come online. So it's a big event, and we think the company will provide more information regarding their longer term growth plans beyond this year. Remember that the company has a long term growth plan to grow their annual volumes by a factor of 40 in between the years 2020 and 2030.
And Elon Musk sat out the last earnings call. So I wonder, does he sit in this time? Because a lot of people are very interested to learn about vehicles that are down the pike, particularly things like the Cybertruck that was supposed to sort of go into production this year.
So it's rumored that he will be on this call. So we view that as a positive factor. Normally he's not going to be on the call if it's if there's no good news or no new developments to report. So we think that's another reason why we're bullish heading into the quarter. As far as the Cybertruck, that's been a concern recently regarding the story, but the company's rumored to have upwards of 1.3 million reservations for the Cybertruck. And even if it's been pushed into early 2023 as far as first production, we think investors are willing to be patient. And that reservation count is very bullish when you compare it to some of the other EVs, such as Ford's F-150 Lightning or GM Chevy Silverado electric. So we're very bullish on the Cybertruck, as well as the Semi, which will be coming fairly soon.
I know that for the first time, Tesla plans to produce its own cells to support its electric vehicle production. How might that impact the company going forward? And I'm thinking specifically about what those costs might mean in real terms to Tesla.
I think that's an area where investors are really looking for more information. Since Tesla held their battery day several quarters ago, they really haven't provided an update as far as their plans and how they're progressing in terms of producing their own battery cells. We know that over time, they have a plan to reduce their battery cost by over 50% and increase the intensity and power of those battery cells. But I think that's definitely an area where investors are looking for more information from the company.
And then who is Tesla's biggest competition? Is it players like Rivian and the EV space, or is it more from legacy car makers?
That's a good question. It's really all of the above. We view Tesla's closest comp in terms of the specs of the vehicle, the quality of the product. Right now, we think that's Lucid. The Lucid Air, really has comps that are really on par or maybe even slightly superior to a Tesla vehicle. The rumored Tesla's been rumored to have developed the Model S Plaid to compete with the Lucid Air, but incumbent traditional automakers have numerous EV models that you're going to be seeing on roads later this year and more so next year. So, and really the traditional automakers have increased their investments that they're dedicating towards EVs dramatically over the last year. So, it's going to be a mix of both traditional automakers and upstarts such as Rivian, Lucid, Fisker, and others.
All right, we will have to leave it there. A lot of people are very interested in those earnings results out on Wednesday. Garrett Nelson, CFRA Research Senior Equity Analyst, thanks for stopping by today. We are going to take a quick break. On the other side of it, we speak to the CEO of fondue franchise Melting Pot for his take on the state of restaurant recovery amid a lot of volatility and economic uncertainty. Stay with us.
We have a market sell-off underway all day long on Wall Street. Right now, though, the Dow is off its worst level of the day after falling more than 1,000 points. It's now down more than 700. The S&P 500 in correction territory with a loss today of 2.5%. And the Nasdaq Composite, as we know, has been in correction territory. Just piling on here, it is down another 2.5%. Few things at work here. We've got the Federal Reserve meeting this week. Investors on edge about that. Heightened geopolitical tensions between Russia and Ukraine as well. I want to take a look at the Dow losers today, because as you can imagine, there are plenty of them. We have got Boeing, Visa, Apple, which, by the way, out with earnings this week, all lower, along with Intel and Merck. Last I checked, there were only 2 Dow stocks actually in the green. That was Home Depot and Travelers Corporation. All right, I want to switch gears now and talk about the restaurant industry, because we know the pandemic decimated restaurants, shuttering some 90,000 of them across the U.S. But here's a success story. Fondue restaurant franchise The Melting Pot has reopened all of its restaurants, and sales sales are actually better than pre-pandemic. Joining us now is Bob Johnston, Melting Pot's CEO. Bob, good to have you here. I want to talk about some of the challenges to your business and to your industry in a moment, but first talk to us about this turnaround. Why do you think foot traffic is so strong at your restaurants?
Sure. Well, thank you for including the Melting Pot story in the conversation today. And I think there are several reasons. The two main ones are that the concept is a very special concept. It's a restaurant where you don't go to just have a meal, but rather you go to escape and create some memories. And some people go there even to pursue their future. And I think that's something that everybody is looking for now, is an opportunity to escape what's going on around them, what we've all experienced over the course of the last 2 years. But secondly, and I think one of the most important things, all of our locations are franchise locations. This means that they're owned and operated by independent business owners whose neck is on the line. It's important to them and their families that they succeed. And the way that we do that is by providing an experience that brings the guest back again and again.
And then you said that you actually anticipated some of this inflationary pressure that the restaurant industry has been seeing. How did you then navigate to make sure that you avoided some of those pitfalls?
Yeah, well, one of the great things about the Melting Pot franchise opportunity is that we have a team of over 50 really talented support folks here in Tampa, Florida, that support all of our franchise locations. And one business unit focuses on purchasing and distribution. And, this is something they do every day, not just as a result of the pandemic, but they look at what the futures are on various commodities and do very intelligent buying on behalf of the franchisees to try to stabilize or drive down cost where able. And it's been difficult to drive costs down in this environment, I think, for any business, but especially for restaurants. But they've done a magnificent job in stabilizing cost and protecting the profits for our franchisees.
When I think about fondue, just the nature of the meal is one of sharing, of bringing people together around this one pot, and you're sort of dipping your food in there. It's very communal. And I have to think that's not real popular during COVID. I mean, did you have to change protocols within your restaurant to make people be at ease?
Sure. Well, it's a fair question, and I'm happy to report that we continue to serve our guests in an extremely safe environment, pre-COVID, during it, and we will after it. But it's a fair question to ask, and what the numbers are proving is that the guests are finding our environments to be comfortable, enjoyable, and most importantly, they're finding them to be safe.
And then, sir, in this sort of inflationary environment, how worried are you about it's a tight labor market, people are having to pay more for their staff? Is that something that you're concerned about? We've seen the year has gotten off to a really rocky start. There's a lot of economic uncertainty at the moment.
Yeah, I mean, it's a challenging time for all businesses, and the restaurant business certainly. And we feel very blessed. We have been performing enormously well. 2021 ended up over 22% higher than 2019. You can't comp against 2020 because of what happened there. But we're up 22% in sales, and that's with 2,372 days of zero sales due to COVID-related closures in the first part of last year. So, it's really tremendous, and we count ourselves to be very fortunate. Now, there's been a lot of hard work that's gone into that. You talk about the labor environment. We were prepared for this. We're in the restaurant business. Finding and keeping good employees is always something that we've had to focus on. So we were ready for this. And our feeling is the best way to create an environment that attracts talented people and makes them want to stay is to focus on them. We don't just give a day's wage for a day's work. We feel committed to taking our team members from where we found them and bringing them someplace else. We're a stepping stone industry. Nearly all of our team members are on their way to something else. Our job is to create a learning environment, a comfortable environment, a rewarding environment, a fun environment for them while they're with us.
All right, Bob Johnston, CEO of The Melting Pot. Thanks for sharing your story today. The beaten down cruise line industry betting on a summer rebound coming up. The business changes in store on the high seas.
Welcome back to Yahoo Finance. Well, we're going to shift gears a little bit and talk about the cruise industry. It's betting on a big comeback over the summer, despite an uptick in COVID cases, both felt at sea and on land. With more on this, let's bring in Yahoo Finance's Danny Romero. Danny, the cruise industry has been hit hard, including recently the CDC saying people shouldn't go on cruises even if they're vaccinated.
Yeah, Karina, you nailed it, right? I mean, the cruise industry is really betting on the summer for that rebound. Industry experts say that bookings are looking strong for this summer and the next, despite that some cruise companies have canceled their sailings for this for this year as well, and all due to the variant. But they're still remaining bullish for their outlook. Let's take a look at Carnival, the largest cruise company. Since September 2020, they've carried 1.2 million guests on their ships, and by late November, 61% of the company's capacity of operating with guests on board expects to have a full staff by the spring. However, the variant has caused people to test positive, but again, not resulting in drastic medical outcomes. Royal Caribbean reported that they have carried over 1 million guests on board, and over 1,700 people have tested positive. The positivity rate of 0.02%. but only 41 people were hospitalized. But again, to get on board, passengers have to be fully vaccinated and show that test before boarding the ship. And even though the CDC still advises people to avoid cruising, industry experts say that right now bookings are taking a little bit of a dip, but they are expecting that that will quickly turn around. Take a listen.
Booking activity, not when someone travels, but when they book, right? So booking activity leading into Omicron was crazy good. November, December, off the charts, better than 2019 booking trends, lots of pent-up demand, lots of stuff. Little different in terms of what they were booking. They were booking a little further out in some cases, right? Booking summer of 22 and then into 23 and 24, as I explained. We've had about a 2-week dip, 2-3 week dip due to Omicron. And it hasn't been as nearly as bad as it was with Delta variant.
And like you hear right there, there is really that strong optimism that, you know, people will return to cruising by this summer or the end or the late half of the year. Alexis, Karina?
Danny, I know that some of those large cruise companies, we were just looking at their stocks, Carnival, Royal Caribbean, Norwegian, they didn't get federal relief from the government. So how were they able to stay afloat with all the uncertainty?
Yeah, you're right. Some of those companies really didn't benefit from the federal aid. Carnival, for example, lost $9.5 billion in the year and in November and $10.2 billion in the year before that. The company has roughly $33 billion of debt and $9.4 billion in liquidity. The company said that in December that it expects to return to full profitability in the second half of this year. Carnival now operates around 50 ships from its 94 vessel fleet after selling or recycling 19 of its vessels at the start of the pandemic. So it expects that all of its ships to be operational by early summer, but other operators aren't doing so well. For example, Genting Hong Kong expects to run out of cash by this month and have requested liquidity help. So a lot of these companies are really looking at how they're going to deal with this variant and also restructure their business if they need to. Alexis?
Oh. Okay, Danny Romero, we will have to leave it there. Thank you so much. And we are going to take a quick break. On the other side of it, we continue to monitor the market sell-off. Stay with us.
Bitcoin bounce back. The granddaddy of cryptocurrencies staging a dramatic turnaround, clawing its way back into the green after briefly sinking below $35,000. Still, Bitcoin down nearly 50% since its November record high. What's next for Bitcoin and the alt cryptocurrencies as investors flee the stock market? Tensions are escalating between Russia and NATO as the U.S. and U.K. reduce embassy personnel, signaling a military conflict could be imminent. What would that mean for stocks? And could it be the trigger that sends crude oil to the $100 a barrel mark? And the 2022 tax filing season officially kicks off today. How the pandemic and higher inflation are changing this year's taxes. We have everything you need to know. Welcome back to Yahoo Finance Live, everyone. I'm Alexis Christoforous here with Karina Mitchell. And I guess the good news, we'll call it, is that stocks have managed to bounce off their session lows. At one point today, the Dow was off more than 1,000 points. It has basically halved that now. And last check, I saw the Dow down about 580. The S&P 500. Oh, it's even better than that. The Dow now down just 424 points. The S&P 500 down 62. It is now just out of a correction territory. It slipped there earlier in the session. That, of course, meaning it is down 10% from its record high. Nasdaq, though, in correction mode, it is off more than 1% right now, but has managed to close below its 10% record high, which does put it squarely in a correction. Want to check in with Jared Blickery now for more on today's sell-off. And I don't know if this is just some bottom feeding here, some investors looking for some bargains, but we are way off our session lows, Jared.
That's right. And this is a very illiquid market that we're dealing with right now. You take a look at the Wi-Fi Interactive, even the Russell 2000 has turned green. And let's just take a look at that. We're talking about the Russell potentially slipping into a bear market on the close. Looks like it's going to miss that right now. I think this is IWN. We'd have to look at the underlying index, but it looks like it may have turned the corner for the day. And here's the Nasdaq. Nasdaq was off 5% at the lows right here, and we were just screaming higher, but is this going to last? Is this just a dead cat bounce? Unfortunately, due to the low liquidity in the market, I'm not making much of this rally right now. But nevertheless, we want to take a look inside the market. NASDAQ 100 looking a bit better than it did earlier in the day. At least we're seeing some pockets of green here. You can see Costco up just a meager 18 basis points, Qualcomm, Broadcom. So it looks like some chips are getting some of the buying action today. Facebook now up 0.5%. But you can see Tesla is still down over 4%. And let's take a one-year look at Tesla. You can see after all this volatile action, we're just coming back down and testing the 900 level. That's a pretty big level. I think on an intraday basis, we were back there about a month ago. Nevertheless, going to want to focus on that. And let's take a look at some of these other heat maps. Travel sector still looking pretty bad. Avis Budget Group just barely turning green there, but Carnival Cruise Lines had been off 5-6%. At the lows. That's still down 3%. So is Norwegian Cruise Line here, and Airbnb down 8% as well. Want to take a look at the semiconductors, see what's turning green here. Mentioned Qualcomm and Broadcom. Applied Materials also up 0.5%. Skyworks up about 0.6%. So seeing some signs of life here, but still AMD, Nvidia, two of the big high flyers, each down more than 4.5%. So is ASML. And you take a look at something that has turned a little bit green today, and we can talk about some of the impetus for Kohl's in just a second here, but just wanted to show you that this has been a very strong sector all day long. And as for A, she let me know that the home builders also looking green. She's going to be up at 3:40 p.m. to tell us why, guys.
Okay, and you just said it right there. Kohl's one of the rare bright spots today in the market. Jared, stock is up as analysts mull some takeover offer bids.
That's right, and this story dropped this morning a little bit out of the blue, but kind of catching traders by surprise, I would say. $62 could go a little bit higher. A lot of analysts saying that the suggested purchase price of $64, a little bit too low, could be as high as $70, $75. But let's take a look at a two-year chart so we can really get a handle on what's going on here. This is a stock that has been trading sideways for just about over a year. And in one day, it has managed to climb from the bottom of its range to the top. And if it can't punch through there, probably going to get some more resistance, and it's going to have to consolidate around these higher levels as it entertains some of these offers. And I do have some notes from Bloomberg Intelligence on this, and they're writing this. UBS's Jay Soul, he's writing that the investor group may face challenges in getting financing for a Kohl's deal. They're talking about that activist investor in the company right now. For one, Sol doubts that the value of the company's real estate will be sufficient to serve as adequate collateral. And two, he doesn't think an operational turnaround plan exists that will justify lending creditors enough capital to make the deal happen. They're maintaining their sell with a price target of $38. And you can see that's considerably below the current price right here, guys.
Yep, that it is. All right, Jared, the Yahoo Finance Plus investment idea of the day is Netflix. Got a bullish call here from Argus Research. I know they're maintaining their buy rating, but they're cutting their price target. What's the thought process there?
Yeah, well, we saw this big down candle on Friday. That was after they released their earnings after the bell on Thursday. Huge 20% decline, kind of uncharacteristic for the company lately, but on a valuation basis, maybe a buy right here. And I think that's what Argus Research is saying. So they did lower their price target to 570, but they are maintaining their buy, and that's after those fourth quarter results that we were talking about. Netflix missed its subscriber addition guidance in the fourth quarter, projected a weak first quarter, that's the current quarter right here, and also a full year for the year 2022. Management's guidance upset the market, driving down Netflix shares. We are lowering our price target to 570 from 720. Management does see new content releases as key to the subscriber acquisition and engagement, and therefore worth the price of higher costs and lower profit. So we're lowering our 2022 EPS estimate to $11.96 from $12.90, establishing a 2023 forecast of $14.79. And finally, valuation metrics for Netflix are at the bottom of their historical range. And so by that metric, well, maybe it is a buy here. So if you like falling knives, why don't you dabble?
I try to stay away from them personally, but Jared Blickery, thanks for the live report there from our studios. All right, want to bring in Colin Martin now. He is fixed income strategist at Schwab to talk a little bond market. Colin, good to have you here. I guess no surprise to see that investors, when they're fleeing riskier assets like the stock market, they're piling into the relative safety of the Treasury market. Just talk to us a little bit about the action you're seeing in the Treasury market today and what your expectations are for the Federal Reserve later this week.
Well, we're seeing exactly what you mentioned we'd expect in these types of days when stocks and risk assets are falling. We're seeing a bid for high quality Treasury securities. The 10-year Treasury yield is down sharply from the highs we saw last week, getting back down to the 1.7% area, which again makes sense when there are risks out there. The risks that have been beginning to price into the market lately have been the prospect of Fed tightening. And when you throw these geopolitical risks into the equation, that gets investors a little skittish. However, we're not seeing too much of a repricing just yet in terms of the outlook for the Federal Reserve. Expectations for the number of hikes have come down a little bit, but when we look at the Fed funds futures market, they're still pricing in close to 4 hikes for most of this year. Again, it's very early right now. We're not expecting a hike this week. We do think there should be a hike at the March meeting. But when we look at what the outlook is for the rest of the year, the markets might have been a little bit too aggressive. They might have gotten a little bit ahead of themselves. And we're more in the 3 hikes in 2022 camp.
And, for the first 3 weeks of the year, it really seemed that bonds were rattling the equity market. But the last couple of sessions, that seems to have flipped. Is that just something temporary? Do we see yields continue to rise? And then if so, the 10-year is at 1.72 at the moment. When do you see it touching 2%?
We do think it should continue to rise, or rather resume the upward trend, but we don't see too much upside in the 10-year Treasury yield. Coming into this year, we thought it could trade in the range of 1.75% to 2%, and we hit that range pretty quickly, although now we're back sort of in the middle of that range. We do think it should move higher, but it really comes down to how quickly and how aggressive the Fed is with its pace of rate hikes. If the Fed feels the need to act too aggressively and it hikes too quickly, that can really slow down growth expectations, which have already come down a little bit lately. And then ultimately that means where they end up, the Fed's terminal rate, how high they can get its Fed funds rate, won't be too high. So that limits the upside of the 10-year Treasury yield. Likewise, if they can actually take a patient approach, not act as aggressively. And if they're able to bring the rate of inflation down while not disrupting the economic recovery that we're currently in, that can allow them to actually get to a higher Fed funds rate, hopefully above 2%. In that instance, we can see the 10-year Treasury yield move a little bit higher. For now, though, we think we're probably going to be stuck in this 1.75% to 2% range with a little upside, but we need to get a better read on the Fed's pacing and timing and really what their plans are for the balance sheet before we revise higher our outlook for long-term Treasury yields.
Colin, I'm curious where you're seeing people concentrate their attention right now within the bond market. Is it corporate bonds, muni bonds? Are they taking on a little more risk with some of the junk bonds? And also, what about the duration of the treasuries that they're buying up?
Yeah, so far, we're still seeing investors focus more on short-term Treasury yields. When we talk to our client base at Schwab, there tends to be more of a short-term bias just because there is a risk, a lot more interest rate risk when you invest in longer maturity securities. So we are focusing a more short, a favoring of short duration investments today. If we do continue to see yields move higher, we'd suggest our clients and investors move a little bit further out and lock in higher yields, but we're not suggesting that just yet. One area, though, where we are seeing some demand is investments with floating coupon rates, specifically the bank loan investment type. Those are risky investments. They're like high yield bonds, but they have floating coupon rates. They have a lot less interest rate sensitivity. And we have seen a lot of investor demand there to start the year because holding them can kind of offset the risk of higher yields with your portfolio. And they're one of the few investments so far in 2022 that have posted a positive total return to date.
Because bond investors have been hit really hard, particularly at the beginning of the year. So when does that start to moderate, and do things get easier from that perspective? Is it in the first half? Is it at the second half of the year? When do we see some moderation?
No, we'll probably see more moderation in the second half of the year. What we hope is that we see a modest increase in rates, because when you see a sharp rise, that's really what spooks investors. You look at your account, and if yields rise, the price of your bond investments fall. That's a cause for concern, and it can cause investors to unfortunately, unload some of their bond investments. When in reality, as yields rise, it should be an opportunity to lock in those higher rates. Ultimately, what we expect is a flatter yield curve, meaning we see a lot more upside with short-term interest rates as opposed to long-term interest rates. But most importantly, we expect more volatility this year. So you need to be ready to ride out the ups and downs. As the Fed is moving from its very, very easy monetary policies to policies that are, one, they're going to start as less easy and then eventually get to tight, that should just lead to a bit more volatility, really for all types of investments. So we think that's what's important for investors to focus on, but not necessarily panic if you are in high quality investments like treasuries or high quality munis or corporate bonds.
All right, Colin Martin, fixed income strategist at Schwab. Thanks for your time today. We appreciate it. And coming up, Goldman Sachs weighs in on the state of small businesses in the U.S.
Welcome back to Yahoo Finance. I want to get you a quick check of the markets before turning to our next guest. You can see that the Dow is now down by 582 points. That's about half, it's halved its losses over the session. It was down by as much as 1,000 earlier in the day as investors dumped risky assets. The S&P now down by 81 points and the Nasdaq still in correction territory, down by 230 points. All right, let's turn to our next guest. Small businesses are reeling from the effects of Omicron, according to a new national survey released by Goldman Sachs' 10,000 small business voices. Here with more data and details are Joe Wohl, Goldman Sachs National Director of 10,000 Small Business Voices, along with Yahoo Finance's Danny Romero. Thank you so much both for being here. I want to start by asking you, just from the data that you've seen, what are the most significant challenges that small businesses are facing? I know labor is a big concern.
Yeah, so in addition to the Omicron, variant, which obviously has had a devastating impact for a lot of businesses over the last month or so, our data shows 71% of small businesses have seen a revenue decline as a result of the variant. About a third of them report having to close temporarily or scale back their operations. So that in and of itself has obviously had a tremendous impact on a lot of businesses. In addition to that, we really see, what effectively is a triple whammy of labor shortages, supply chain disruptions, and inflationary pressures. And, if you look at our data back in September vis-a-vis today, what you see is that across the board, everything has gotten worse. So, over 80% of small businesses say inflationary pressures have increased since September, supply chain disruptions have grown. And when it comes to labor shortages, 87% of small businesses that are hiring are saying that they're having a tough time finding qualified candidates. And 97% are saying it's having, a real impact on their bottom line. So, if you take that in culmination, what we're seeing from our data is that our small business owners feel like, more federal aid is necessary, just given the conditions right now.
And Joe, it's Danny. Going off of that point, like you said, you mentioned in the report about the importance of federal relief. If we don't see that, what are the impacts we're going to see for small business owners?
So, I would preface, I think if you talk to just about any small business owner, no one wants a handout. I think what is necessary right now is that there are some government loan programs, not grant programs, loan programs that expired at the end of last year, notably the COVID EIDL loan program, which the Biden administration, to their credit, modified to make it much more flexible and also increase the amount that you could take out from, 500,000 to 2 million. So they pretty dramatically revamped it to get capital out the door in, the third and fourth quarter of last year. And we hear from business owners that took advantage of those loans that for many, it saved their business. And unfortunately, that loan program, came to a close. The reason that's so important is that for many small businesses, if you look back at their 2020 financial statements or 2021, they simply are not going to qualify for a loan, or if they do, they're going to get, an interest rate that's much higher than they otherwise would. And what's nice about the COVID EIDL loan program is it doesn't take into account the pandemic impact. And so that's, I think a good first step for Congress, just in terms of helping a lot of small businesses that are struggling right now, as a result of, the roller coaster of the last couple of months.
Yeah, and Joe, another interesting point was that a third of operators say that they had actually more of a difficulty in 2021 than they did in 2020, even though a lot of them, in 2020, they had to shut down completely. So why is that? What are the factors contributing to that?
Well, I think a lot of it is the changing conditions. Like if we go back to June, things were looking very good. In fact, when we asked business owners back in June, do you think the U.S. is on the right direction or are we on the wrong track? 67%, 2/3 said things are headed in the right direction. It felt good. Masks were coming off. Mandates were being lifted. And then today, if you look at that data point, it's 28%. So we've seen a dramatic, drop in just confidence when it comes to, just the operating environment right now. So I think it's a combination, of factors. It's obviously the turbulence of COVID and not knowing what's coming next. And then it's the, unusual economic conditions we're in right now that is, I think a lot of small business owners just don't feel like they can catch a break.
Yeah, speaking of which, Joe, when you, I want to get back to the supply chain issues, because very often it's a David and Goliath sort of situation, and these small businesses feel like the suppliers give priority to those larger businesses that sort of buy in bulk. So how optimistic are the small businesses you talk to about the supply chain issues easing anytime soon?
So only 13% of small businesses that have been, impacted by disruptions to their supply chain think that it's going to ease up in the next 6 months. So 13% think it'll ease up in the next 6 months. So not a lot of confidence in terms of that getting better anytime soon. And to your point, we asked a question along those lines. About 2/3, of businesses say that they have seen large operators, in their space get priority over them because of their large volume orders. So small businesses feel like they're getting, the short end of the supply chain crisis, but it's obviously bad across the board.
Okay, we will have to leave it there. Thank you so much for your time. And yes, that is from the Goldman National Survey released by Goldman Sachs, 10,000 small businesses, and our guest there, Joe Wall from that company. All right, thank you so much. We're going to take a quick break, but on the other side of it, Bitcoin seeing a remarkable day today, taking a bath, but then recovering nicely. We'll find out what the outlook for crypto is ahead.
All right, Bitcoin investors getting a bit of whiplash today. The cryptocurrency fell sharply earlier below $35,000, but as you can see here, has since bounced back a bit, rallying now nearly 3%. Not the case, though, for its fellow cryptocurrencies, including Ethereum and Doge. Solana also sharply lower. We want to bring in Gareth Soloway now, president and CFO of InTheMoneyStocks.com, for a closer look inside crypto. Gareth, thanks for being with us. So it looks like Bitcoin is sort of broken off from the pack, moving a bit higher today. Any reasoning there, do you think, as to why we saw that dramatic turnaround in Bitcoin this afternoon?
Yeah, absolutely. So on a technical basis, and I'm a chart guy, it's all about how much it was down. It was oversold. And what's fascinating about Bitcoin is that if you go to the April 2021 high to the low in June and July, that distance fall that it had before going to 69,000 is the same distance that it has fallen now. So it's really remarkable. It's a $36,000 fall was the fall from April to June and July, and now we've now fallen that same amount to the downside. So you have this almost round trip of Bitcoin in terms of falling where you're going to get a technical support level. In addition, you also, if you connect the high from the 2007 bubble high of around 20,000, it connects perfectly through the lows of the earlier portion of June, July of 2021 and right to the current levels right here. So on a technical basis, it was oversold. The technicals are telling you a bounce. I don't think it's a bottom. I think ultimately we're in a bear market, but I think you're going to get a bounce back to $40,000 to $45,000 on Bitcoin.
And when do we see that bounce back, and does it continue into the rest of the year in a volatile environment now?
Yeah, so there's no doubt that the connection between the stock market is there. So the tech sector is bouncing as well off of the lows today. You're seeing kind of this run into high PE stocks, which then coordinates with Bitcoin and the high risk nature of cryptocurrencies. So I do think this is a shorter term bounce that's inside of an overall bear market that's starting for assets. So I would guess this bounce lasts for about 4 to 6 weeks. And then my guess is you'll start turning down again. And just with the stock market as well, you'll start heading lower.
And when we do start to head lower, Gareth, where do you see the floor for Bitcoin?
Unfortunately, it's looking to be sub 20,000 when all is said and done still. That's a level that I talked about when we were at 69,000 earlier in late in 2021. It's that the deleveraging that the Federal Reserve is now causing is going to translate into a major deleveraging in cryptocurrency prices. And you have to have the dot-com washout. There's no doubt about it. Bitcoin was a new technology with blockchain, and that's the same thing that went on in the late 90s that created the bubble then. It has to deflate. You'll see major players like Bitcoin and Ethereum survive and thrive just like Amazon has, but you got to get that washout, and it should come later this year.
And then I want to know who will help sort of, help it rebound. Is it the institutional investor? And then how much more regulatory clarity do we need to see in this space?
So one of the biggest things for Bitcoin to survive and thrive, I truly believe, is regulation. You have to get some of this safety things put in place, FDIC insurance. I mean, there's so many situations where people are getting robbed in their cryptocurrency accounts because they get, hacked or they get, phished or stuff like that. So you need to see regulation come in. That will give a lot of other investors confidence to go into that space. You will then also see institutions, pension funds, and bigger players getting into there as well. So I'm a big believer that you have to see that regulation come in to make it safer for investors. And then once you do, you have a perfect situation for digital gold to go much higher than the recent highs of 69,000, 100,000, then 500,000.
All right. This week we're going to probably hear from Elon Musk. He's expected to be on that earnings call for Tesla after the bell on Wednesday. And I'm wondering if anything from Elon Musk can sustain Dogecoin. I mean, he talked again recently about the company perhaps accepting it as payment for its cars. Do we need another announcement like that to help the sector turn around?
Yeah, I mean, and there's always that short-term pop from Elon Musk if he does mention it. I'm sure he'll get asked about it. My biggest thing is that when I'm investing in cryptocurrencies, I want to know there's a scarcity aspect. I invest in cryptos because they're not the US dollar that the Fed and the government can just run up and print more of. And so you don't have that with Dogecoin. Every minute, I believe, there's another 10,000 Dogecoins printed. So it's essentially the same as if you're holding the dollar. So I mean, yes, it's a digital way to make transactions, but in this day and age, we have so much of that already that, without something else, I just don't see Dogecoin having sustainable long-term value.
All right, you heard it here. Gareth Soloway, President and CFO of InTheMoneyStocks.com. Thanks so much for your time today. Coming up, we're going to get you all a check of the oil markets as geopolitical tensions between Russia and Ukraine intensify.
Welcome back to Yahoo Finance. Well, it has been a red day across the board on the market front in equities, and energy also taking a hit. That's something that we haven't seen recently as oil falls on strong dollar and the possibility of quicker rate hikes, of course, by the FOMC. Here with a look at all of that and how crude settled is Yahoo Finance's Jared Lickery. And Jared, tensions between Russia and Ukraine not helping matters either.
Yes, that is correct. And a little bit of everything is kind of spilling over into the oil market today. Also, we have contract rollovers. So we're not talking about March futures. So let's take a look at the settlement. We got March futures settling at $83.31 per barrel, still trading in the electronic market. Here's the overnight price action from yesterday's open on Sunday evening. And you can see just kind of following the general market weakness that we have right here. Now, on a longer term basis, let me put a 3-month chart up, and we can see we did take out these highs from before. We have the highest prices, or had the highest prices since 2014, and we're just now backing off a bit. But really, this price decline that we're seeing, not that material, especially when we're talking about the Nasdaq being off as much as 5% today, the S&P 500 off as much as 4%. Really, a 2.5% decline for crude oil is a drop in the bucket here. I want to go to our energy heat map, and let's see if we can find this. And here we have, let's see if we got any green, only Halliburton, which reported earnings earlier this morning. That stock is up about 0.9%, but still seeing some fairly deep losses, especially in the overseas measures. We got BP down over 4%, Royal Dutch Shell down more than 3%. A little bit better here in the U.S. We got ExxonMobil and also Chevron. Those are each down more than 1% here. Finally, just want to take a look at XLE on a sector basis. This is a stock and ETF that really flew to the upside recently. $60 is a huge price level, and it still hasn't technically cleared it just yet. A little bit of a wiggle room for there. So interesting to see how we have this general market weakness just as XLE has climbed to a very important level, and we'll be tracking all of this. We'll be tracking all of this as it develops throughout the week here, guys.
Okay, Jared Lickery, thank you so much for that report. And we are going to switch gears now. It's time for the ETF report brought to you by Invesco QQQ. It's been a rocky run for markets lately, and here to discuss how investors can position themselves amid all the volatility is Dave Nadig, ETF Trend CEO and Director of Research. Dave, thanks so much for being here. So last year was a record year for inflow into ETFs. This year is starting off on very shaky ground. Do you see the same sort of inflow this year? And if so, which sectors look safer than others at this point?
Yeah, I mean, I don't think we're necessarily in the bag to beat last year's $900 billion in inflows. It was nearly a 2x on the previous record. However, flows have been very strong so far this year already, and they've been very strong into equities despite what we've seen in the markets. One of the things that's been most interesting to me is how much attention sector funds themselves have gotten. Sector funds largely got forgotten by investors over the last couple of years in favor of thematic ETFs, things like ARKK. But what we've seen just already this year is a lot of interest in traditional sector rotation plays. Financials, energy, and staples are the three that I would highlight. Jared was just talking about XLE and the run it's pulled in $1.5 billion already this year. XLF has pulled in $2 billion by itself, and XLP, the staples ETF, also another $1.5 billion. So what we're seeing is really classic rotations into both inflation and rising rates plays. And I think financials is probably the place to look the tightest. Financials was the third best performing sector last year. It's the best performing sector so far this year among the ones that are not energy, labeled energy. So I think it's very interesting to think about why folks are rotating in there. Financials are often tricky to time around interest rate hikes. We know we're heading into them, but that balance between the curve shifting and rates coming up can be very tricky, especially as a lot of banks are coming off of a very, very strong 2021.
Yeah, good point. And I mean, you mentioned XLF, Dave. For investors looking for an alternative to that, where else can they look? Maybe where there isn't as much exposure to those mega cap financial stocks.
Yeah, so XLF is a fine ETF. It owns the 69 financials firms that are in the S&P 500. It's very heavily dominated by the likes of Berkshire Hathaway, Citi, JP Morgan, Bank of America, all in there with very large positions. If you want to look a little less mega cap, I like the equal weighted strategy here. It would be the Invesco RYF. It's an equal weighted basket of the exact same stocks that you'd find in XLF. It is a little bit more expensive, but it actually beat by a decent amount last year during that big run up that we had. And if you are looking for a more traditional cap weighted exposure, I also like Fidelity's approach here. It's FNCL, tracks the MSCI version of a financials index. It adds a whole lot more names. You're getting almost 400 securities in there. That helps dilute some of that exposure to those mega cap names. You're also getting it on the cheap. It's only 8 basis points.
And then I'm wondering how you're looking at gold, because it's getting a lot of attention from people at this moment.
Yeah, gold was a terrible trade all last year, and investors pulled their money out all year. I mean, billions and billions flowed out. So far this year, that's completely reversed. GLD, the gold ETF, is the highest gaining asset gathering ETF so far this year. Obviously, that's folks rotating into gold as a safety play here. For folks who are using Bitcoin for that, obviously gold looked like a slightly better play here. The caveat I would put is that this has turned out to be hot money. GLD is not a place people are actually parking money for the long term anymore. It may have used to have been that. Now it's a trading vehicle for getting short-term exposure to bullion. So I wouldn't read into that somehow the entire market is running to safety. What I would read into that is people are nervous and they're looking to stay invested in something, and they don't like the US dollar sitting in a bank account.
Dave, we've got some breaking news on the geopolitical tensions here between Russia and Ukraine. So we've got the Wall Street Journal reporting that the U.S. military has ordered several hundred troops on standby to potentially deploy to Eastern Europe. If we see military action there occur, what happens to inflows into ETFs? Are you already seeing some jockeying for position?
I mean, I think that's a lot of what we've seen already for the last 2 weeks. The general nervousness about being invested in risk assets as a bucket. I think the geopolitical tensions are absolutely there. I think they're also a little unknown. Remember, the Ukraine is one of those places where we've had some on and off again news over the last 5 years, but it hasn't been quite the predictable nature of what we've seen perhaps even in the South China Sea or in the Persian Gulf. Ukraine is a little bit more unknown territory as far as U.S. politics is concerned. So I would be paying close attention to there. I personally think the risks of any kind of hot war are very de minimis, and I expect calmer heads to prevail. That being said, recognize everybody else is watching the same news you are, and it's real easy to hit the sell button when you're feeling nervous.
Okay, that is very true indeed. We will have to leave it there. Dave Nadig, ETF Trends CIO and Director of Research, thanks so much for your time and insight today. We're going to take a quick break, but on the other side of it, it is officially the start of tax season. We'll have tips to help you prepare. Stay with us.
Welcome back, everybody. The volatile day on Wall Street continues. The Dow now off more than 700 points. Each of the three major indexes off more than 2% right now. The S&P 500 back in correction territory, and the Nasdaq Composite solidly in a correction with a loss today of 2.5%. We now have a third of all S&P 500 companies at least 20% below their 52-week moving high. Hard to find any green in today's market. Some of the retailers doing well, namely Kohl's, as it entertains two bids to take over the struggling retailer. All right, let's switch gears and talk a little tax time, because it seems to have snuck up on us, but the 2022 tax filing season officially kicks off today. So how has the pandemic and higher inflation impacted tax season? To help us answer some of these questions, let's bring in Tim Spiess, EisnerAmper partner and CPA. So Tim, I know the season starts today. I just want to get this sort of housekeeping rule out of the way. What is the deadline for returns? Because I know the deadline changed the past 2 years because of the pandemic.
Right. Well, right now, as far as we know, it's April 15, but we will see how that goes.
And so how does this tax season look different from last year? Because there are some things like child tax credits that one has to take into account this year.
Right. That's a very good point. And I was going to speak to that later when we talk about benefit plans generally and employer plans, but that's correct. The other is the gift tax exemption, which is now $16,000 per person. For a married couple, that's $32,000. And the estate exemption, which I'll briefly touch on, is now increased to a little bit over $12 million, 12.06, and $24.12 million for a married couple. And those are three things: childcare, thinking about estate planning early in the year, making gifts early in the year. That's a good way to start this segment.
What about the tax brackets, and how have they changed because of higher inflation?
Well, the brackets have gone up. They're a little bit more confiscatory, but on par, they're pretty similar to the 2020 tax brackets. Remember, now we're in 2021. We're filing 2021 tax filings now this year in 22. So I would say they're not. They've expanded at the probably from $0 to $400,000. The brackets have expanded. They've increased slightly, and I would say that as you're looking at your 2021 information for tax filing purposes, the tax brackets and where you are and your income tax liabilities projected for 2022 should also equally be considered. And now would be the time to adjust withholding exemptions, employee benefit plan elections, contributions of 401k plans, and the like.
And what should people be aware when it comes to estate tax exemption? Because that increased this year, correct?
Oh, absolutely. Yes. I mentioned that for a single person, it's 12.06. A married couple is 24.12. And there's tremendous opportunities there. We assist clients with establishing, for example, LLCs or partnerships for their investment portfolios. Your previous guest talked about investments generally. And that's important. So in the context of just investment planning, risk tolerance is extremely important. Understanding what your particular risk is. It's good to work with a professional. You can actually measure your risk tolerance to design a portfolio, and you can rebalance as you go. Some sectors, as your earlier guest spoke about this year, are going to be experiencing volatilities, or probably be volatility generally. So relooking at your asset allocation in sectors is also appropriate.
What about the backlog the IRS continues to struggle with as it relates to the child tax credit, even some economic stimulus payments? They're still trying to work their way through it. So what does that mean for people's refunds? Are those going to be late as well?
Early, I would tell you, because not that we've had many clients, and I think this is probably true across the board, filing and getting refunds back. The IRS was fairly good with the stimulus payments last year and in 2020 as well. and also with correspondence and fulfilling refund requests where they've been requested. The service is challenged, though, like many businesses are in the context of workflow and turning things around. So I think it would be practical to expect some delays in refunds. And of course, the best way to accelerate a income tax refund, unless you're applying it, is to file early. Early in the tax season, the IRS is not necessarily as inundated. Anyone that can be filing in the next 2 or 3 weeks or so probably should do it if they don't have a terribly complicated tax filing. Others are unable to. They have K-1s, more sophisticated 1099 reportings, capital gains and losses, and it's difficult to file earlier. But filing as soon as possible, if you're in a refund position, is certainly optimal.
All right, Tim Spiess of Eisner Amper, thanks for your time today. And coming up next, the very latest on the escalating geopolitical tensions between Russia and Ukraine.
Welcome back. Well, Russian stocks and the ruble are taking a hit over rising tensions between Russia and the Ukraine. Here with more is Yahoo Finance's Rick Newman. Rick, NATO, U.S., and Russia all bolstering forces. They all seem to be egging each other on. It is getting quite tense.
Yeah, that's a good way to put it. It's getting serious. So the latest news is that the Pentagon is preparing troops for a possible deployment to Eastern Europe. It doesn't mean that President Biden would send these troops to Ukraine per se. They could go to the region and assist in evacuating Americans who are in Ukraine or other things like that. So this doesn't mean that some kind of ground war between NATO or U.S. forces and Russian forces is imminent. But this is a very serious situation, and analysts don't think Vladimir Putin, the Russian president, is bluffing. President Biden himself said last week, he said it was that he thought it was more likely than not that Russia would invade Ukraine. There are reasons for Russia to want to do that. Ukraine wants to align itself with the NATO nations and with the West, Europe and the United States. and Ukraine borders Russia, of course. So this used to be a kind of a buffer zone for Putin between the NATO countries and Russia, but as it leans more toward the West, it's less of a buffer. And Putin does not want NATO influence right up on his western border. So that's how we kind of got into this mess.
So, Rick, has the Pentagon sort of laid out the circumstances that the U.S. would need to see in order to deploy our troops?
No, it hasn't, and I'm not sure they will. So everything is a signal to the other side at this point. So if we're hearing that the Pentagon is giving these standby orders to American troops based here in the United States, that's real. But the question is that a bluff by the Biden administration? Is that just sending a signal to Russia? Don't expect us to just look the other way if you do invade Ukraine, or do they really mean it? I mean, let's keep in mind, President Biden just concluded the pullout of U.S. troops from Afghanistan after 20 years, and of course that did not go well. So it seems unlikely that Biden would commit troops to any kind of open-ended deployment that might involve hostilities. And of course, the Europeans have troops too. They perhaps should be the ones taking the lead here. But this is a chess game at the moment. Neither side is quite sure what the other is going to do, and each side is making moves trying to give itself the best advantage for whatever's going to happen here.
But they are taking precautions, right? They're withdrawing some of their embassy staff.
Right. So President Biden did order family members, did not order them, but said family members of embassy staff, Americans in Ukraine, should leave the country now. And it also said that Americans who are in Ukraine, and there are apparently more than 10,000 Americans in Ukraine right now, should consider leaving the country, because if hostilities do ensue here, if that happens, then the United States cannot guarantee it can help get those people out. So it's basically saying, if you want to get out safely, now is the time to do it.
All right, we will leave it there. Rick Newman, thank you so much for that report. I want to get you another check of the markets before we head out for the day. It has been a sea of red across the board. So looking at the three majors, see the Dow is now off by 661 points. At its peak, it was down by over 1,000 points. So it has sort of picked up some steam from their well-off session lows at the moment. The S&P is down by 95 points, and the Nasdaq still in correction territory, down by 286 points. Sector-wise, utilities, the big laggard, as well as consumer staples, also lagging. Let's get you over to the bond markets and see what is happening there as well. We can take a look at the 10-year yield, and we see that is at 1.72. It's been pretty stable. That's been where it's been for most of the session. And the 30-year yield, you see, is at 2.07 at the moment as well. And of course, it has been an extremely volatile session, an extremely volatile couple of sessions. So taking a look at the VIX now, you see the numbers there as well. It was up closer to 40 at one point during the trading day. But we will leave it there. That will do it from myself and Alexis Christoforous. But there is much more market action ahead as we send you over to our colleagues to the closing bell and beyond to see where these markets settle. And don't forget IBM also reporting after the close.
Animation.
Stocks are selling off at the start of a busy week, with the S&P 500 falling more than 10% from its record closing high at session lows today to trade in correction territory. Investors are anxiously awaiting the ramp up of earnings season, with reports from Microsoft, Tesla, and Apple all on tap this week, and not to mention the Federal Reserve's latest monetary policy decision and press conference coming out midweek. We'll break down how to navigate all of these events with Michael Lee, Altium Wealth Portfolio Manager and Market Strategist. Plus, investors are bracing for higher interest rates from the Federal Reserve and higher rates on mortgages this year. We'll discuss just how high rates need to go to deter the still hot housing demand with Patrick Zalewski, Dreamfinders Homes Chairman and CEO. And later, we'll discuss the outlook for the burgeoning sports betting industry after a wild weekend in the NFL's divisional round games. Oppenheimer senior analyst Jed Kelly will join us in a bit for that chat. We have an hour to go in today's session. I'm Emily McCormick.
And I'm Adam Shapiro. That hour can feel like a lifetime for some people, especially when you consider the last 15 minutes could see quite a bit of extended volatility. It's what we've been watching all day. As we take a look at the markets, we have been trending down. We're off the session lows, but we are still off about 1.5% on the Dow. The S&P 500 at one point was off more than 3%, now off about 1.75%. Nasdaq is off about 1.5%. The words fear and capitulation, we're going to be hearing those a lot over the next couple of days. Let's go straight to Jared Blickery to find out where we stand and what we should pay attention to as common investors.
Well, we're in the midst of a market sell-off here, but well off of the lows. You take a look at the Nasdaq, that had been down almost 5% at these lows here, and you can see just climbing steadily, trying to get back to the unchanged. We got some nice candles that we'll take a look at in a second. Just want to show you the Dow. As you mentioned, Adam, had been down more than 1,000 points, now off less than 500, so a step in the right direction here. But you take a look at what the VIX is doing. VIX is pretty elevated, and this spike could be concerning. 34, 35 handle, you have to go back some period of time in order to see a spike like that. In fact, you go back about a year, and that's when we saw the last one. That was around GameStop, which, by the way, we're about to lap in a week or so. So really interesting time here for the markets. Also want to check on the Russell 2000. That's down about 0.25% right now, and we can see actually, I don't know if you can see this, but this is a 20% decline. So it could fall into a bear market, the official 20%, not so official to some people, but that could happen on the close as well. And then you take a look at what some of the bond market is doing right now. 10-year T-note yield down 2 basis points. The 5-year down a little bit as well, down 4 basis points now. Kind of a little bit of relief from that big surge that we saw a couple weeks, the first few weeks of the year. And then we got to take a look at the US dollar index, because on a longer term basis, I'm going to put a 5-year chart here. Actually, let me bring this back down to a 1. We did have this consolidation area that we had over the first few weeks, and actually the first few weeks of December. We broke down, false breakdown. Now we're back up inside the range. Surging dollar, not good for a lot of risk markets, but we will keep an eye on that. And of course, a lot of it has to do with what the Fed and the FOMC are going to do Wednesday. I've been saying all day, I think we're at peak hawkishness in the Fed right now. And if the Fed is looking at losses of 10%, 15%, 20% in some of these indices going into that meeting, I have to think there's going to be a little bit of a walk back, but I don't know if you can bet the farm on it. Nasdaq 100 is looking ugly, but it looked a lot uglier on the open. Tesla's down 5.5%. Alphabet and Apple down more than 2%. Apple's reporting earnings this week, this Thursday, and then we got some of these other guys into the next week, Amazon, Microsoft, and Facebook, I believe. Looking inside the travel sector, we've seen cruise ships and the cruise lines under a bit of pressure today. These guys are also off of their lows. Let me see if I can get a 2-day view on Carnival Cruise Line, still in the lower half of this range. And you take a look at what's happened year to date, a lot of these stocks just kind of falling out of bed very recently, giving up all of its gains that it had early on in the year, and now 4% in the red. I do want to show one of the heaviest hit sectors this year. XLV, the healthcare sector ETF for the S&P 500, now down, I believe, 8 or 9 days in a row. It'll be one of those on the close, and a lot of losses there. Johnson & Johnson, that stock is down 10 days in a row at the close, assuming it doesn't recover those 3.5% losses there. So a lot of these stocks are looking ugly, but there's one sector that's showing a little bit of life here, and that would be the retail sector. A lot of this has to do with the M&A news about Kohl's that we got earlier. Just going to show Kohl's pretty quickly here on a longer term basis. It's up 32% today. Let me put a 3-year chart because it has been going sideways for some time and is right back up to the upper end of its range. So not being able to punch through that right now, not surprising, but a lot of analysts calling for maybe a $75 takeout price instead of the $60, $65 that had been floated over the weekend. In sympathy, we're seeing Macy's up 15% and a lot of these other guys just kind of on the, I would say there's one pocket. If there's one pocket today that's taking some money in, I think it's getting the bulk of it. So we are seeing some signs of life in the retail sector. Of course, we're going to be tracking this as well. And just want to round out the discussion with Bitcoin. Finally showing some green over the prior 24 hours. And look at this number, 36,115. Well, we did hit 33,000. And it's funny, keep seeing the Dow and Bitcoin, those prices overlap. It doesn't mean anything, but it's just interesting to watch sometime. Bitcoin having kind of a rough go on it, testing the lower end of, I'd say the mid 30,000 area, but really it's a 28 to 38,000, 28 to 30,000. That is that longer term support. And you can see that on the longer term chart that we have right here. Guys?
Jared Blickery, thank you so much for that comprehensive look at today's trading. Let's talk much more about the latest market action and expectations for this week's Fed meeting with our next guest. Michael Lee from Michael Lee Strategy joins us now. And we thank you so much for your time this afternoon. Taking a look at the price action that we're seeing in stocks today, of course, this is just extending the volatility that we've seen over the past couple of weeks so far. Is this, in your opinion, all about the Fed and expectations for tighter financial conditions? Or what do you think is driving the selling that we're seeing?
You know, Emily, I think you hit the nail on the head there. I think this is everything to do with the Fed and the fact that as of right now, there's simply no consensus as to what the Fed is going to do. Inflation numbers keep coming in hotter. Some economic numbers are coming in hotter. Some are coming in cooler. And as a result, you just have a wide range of opinions, wide view of where interest rates are going and what the Fed is going to do. I don't think anybody is sure what the Fed is going to do, including the Federal Reserve themselves. I think this year you could see very different thoughts on the dot plot, very different sentiments in the meeting minutes as we go from month to month, from meeting to meeting, because this is very much a fluid situation. And there's nothing that the market really hates more than that sort of uncertainty. The entire risk asset class universe is priced in one way or another off the U.S. Treasury curve. And so as that Treasury curve is in somewhat of a flux, and there's such a wide range of viewpoints as to which way it's going to go looking forward, it becomes very difficult to price anything. And as a result, a lot of risk capital just walks away from the market.
So, Michael, you mentioned that there is no consensus in the market and perhaps even in the Fed itself over the next move here. What information, economic data, market data do you think would inform the Fed and market participants about what that next move might be?
Well, look, I think the Fed's between a huge rock and a hard place here. I think the accelerated bond buying, the size of QE doesn't necessarily help the economy, but it stabilizes capital markets. And the full force that came with it a little less than 2 years ago absolutely stabilized capital markets, and then the economy took off. And in my opinion, maybe a year ago or a little over a year ago, they should have slowly but surely reduced that level of bond buying to where it's at a manageable number. So you start with this taper and what has become an accelerated taper from the initial thought to now rate liftoff instead of maybe coming in September, as some were predicting last fall. It's looking more likely it's going to come in March. And you have smart people out there saying that 50 basis points in March is a realistic number. So what
Michael,
I think will
Michael,
yep.
I got to interrupt you on two things there. Because you've pointed out that when you everyone take a step back and take a deep breath, because you've pointed out not a lot has changed in the last year. When you look at this market versus where we were 52 weeks ago, still up 12% on the S&P 500. But when you talk about the Fed, we hit highs on the S&P 500. You had to have your head under a rock and underwater to not know interest rates were going to start going up in March. So what changed all of a sudden?
Adam, exactly. So that's my sentiment, is that over the last 3 to 4 weeks specifically, we went from the consensus being, okay, accelerated taper to 3 rate hikes to, well, you know what, maybe it's not going to be 3 rate hikes. Maybe it's going to be 6 rate hikes. Maybe it's going to be 5 rate hikes. And then you have this varying opinions out there. And then you have people like Larry Lindsey the other day saying, maybe they'll raise twice, but then abandon ship. So you just have this wide disparaging viewpoints of where the Fed is going to go. And what I think has happened is a heightened level of uncertainty as to which way the Fed is going to go. I don't think there's been any fundamental change in the economy over the last 3 or 4 weeks since we started this accelerated sell-off. We've had some good news, we've had some bad news, but nothing to say, okay, well, the market should all of a sudden in the blink of an eye be worth 10% less. So I think we're in a little bit of no man's land. I mean, to me, this is reminiscent of what you saw a lot in 2018, albeit it's happened a little bit faster. You also saw some sell-offs like this, again, not to this degree in 2016, 2015, 2014, 2013, 2011, and 2010, all based around what the Fed is going to do. When there's this level of uncertainty, you get a heightened level of volatility and somewhat directionless in stocks. And I'd say, earlier this afternoon, we looked on our way back to much smaller losses than the news about, 8,500 troops being authorized or being heightened alert for deployment kind of derailed that. And here we are fighting back. I wouldn't be surprised. Maybe we don't get back to those all-time highs if we recover a lot of these losses, only to see sell-offs like this a few more times before we come to some sort of consensus. I'd say these next few Fed meetings are going to be some of the most significant in the history of the United States Federal Reserve.
Michael, what areas of the market sectors or names specifically do you think are best positioned to rally back, as you mentioned, see some of this recovery after the sell-off that we've had the past couple of weeks?
Yeah, so as Jared was mentioning, the healthcare sector has really been unloved. I would be, is the sentiment there too negative for it to rally back? I think, I don't know. That's something I own. I'll continue to own. Energy, you've now, in my opinion, gotten an opportunity to step back into a sector that's red hot and doesn't look like it's going to get derailed anytime soon. I like XLRE and utilities as well. But look, we'll see where the market's going. I don't know how you can not own tech. It's a matter of, are you dramatically underweight or are you equal weight in the XLK as you have it up there? We've seen some unique events happen over the last couple of weeks. Microsoft making not only its largest cash acquisition ever, the largest cash acquisition ever. If the boardroom at Microsoft thought their stock was overvalued or fair valued, why would they pay for this deal with Activision in cash? So in my mind, that's a pretty bullish sentiment. Then that's acquiring company making that big of an acquisition, that's that big of a major player in all the major indexes is going to weigh in the market. Combine that with Netflix, and all of a sudden you have an avalanche. And to understand these sorts of sell-offs, you need to realize that you have momentum players that are going to push markets in both directions. However, when you go to the downside, it gets much, much more uglier versus when you get momentum to the upside. Now, why is that? It's because people panic on the way down, and no one panics when they make more money. So what I think you're seeing right now is a lot of confusion going on, and I think this confusion remains with some rallies and some ugly sell-offs until we can get a fairly tight consensus of the Fed, whether it's 4 or 5 rate hikes or it's 3 or 4 rate hikes or something more narrow than people saying we're going to get 50 basis points in just 6 weeks versus no rate hikes at all. I think the range of viewpoints is too wide. It's too hard for large players to commit large amounts of capital, if that makes sense.
All right, we'll leave it there for now. Michael Lee of Michael Lee Strategy, thank you so much for coming on this afternoon.
Thank you.
Coming up, we'll discuss more on the market sell-off as the Dow drops more than 400 points but comes off session lows. Keep it right here on Yahoo Finance Live.
right, let's check the markets as we get closer to the closing bell, 45 minutes. And you can see a bit of an attempt to recover from the session lows. I mean, the Dow at one point was off 1,000 plus points. You've got it down now 374 points. The S&P 500 is recovering a bit. It is now down a little bit more than 1%. Again, it was off more than 3%. And then the Nasdaq has pulled back quite a bit from its session lows, although it is still down almost 1%. Let's talk about this, but also some other things that are underway in these markets with Matthew Tuttle. He is Tuttle Capital Management CEO and CIO. And I know we want to talk about, too, how some stars of yesteryear, and might be tomorrow's stars like Cathie Wood, how they're doing. ARK, by the way, is up slightly today on a crazy day. But I want to get back to what we were just talking about with all of this discussion about investors today apparently taking the Fed realistically. Because I went back in the notes from Brian Chung and from everyone here at Yahoo Finance, and it was September of last year when Jay Powell said, look, taper will be done by middle of next year. And there was the discussion of potential liftoff, and certainly by November. Powell was sending the message to everybody. He said it, end of March. So I just want to ask you, has there been a tremendous overreaction today by those who've been selling?
So I don't think there has been, and here's why. So the market environment that we've been living in for the past couple of years that allowed for meme stocks and unprofitable technology stocks to be trading at massive multiples was fueled by the Fed. Quantitative easing, 0% interest rates. There is no alternative forcing money into these assets. And just the fact that they're going to be pulling the punch bowl away, that they're going to be raising interest rates means we've got to reprice all this stuff. And, whenever Wall Street goes to reprice things, it's not an efficient mechanism, it's messy. And that's what we've been seeing, the past couple of months in unprofitable technology, and this year pretty much spreading to everything.
Matthew, this is Emily here. At the index level, though, of course, we have been seeing some pretty notable selling across the S&P 500, the Nasdaq Composite, of course, still in a correction. Where do you think this repricing process and the volatility and the selling that comes with this actually finds a bottom?
So I would expect there to be a lot of volatility, a lot of back and forth until probably the end of the quarter. The cool thing about markets is they try to be forward-looking, so the Fed doesn't have to finish raising interest rates for the market to kind of find a bottom and go back up. So, our best guess at this point, unless the Fed kind of comes out of left field with something, is the market takes the quarter to figure stuff out and then can kind of move on from there.
I want to get back to when I was talking about the stars, and I mentioned the ARK Innovation ETF. It's down, if I've got this correct, I'm checking on my computer right now. Last 52 weeks, it's off by about 45%. This falls in line to what you've been saying about repricing some of these high-tech flyers. But is there something else? Because a lot of us look at ETFs as a way to protect ourselves from being all in on, say, one big tech fund. And there seems to be a misconnect, at least for ARK, over the last 52 weeks.
There definitely is a misconnect. A lot of people have looked at ARK as kind of the end-all be-all. At the end of the day, it really is, for lack of a better way to describe it, a sector fund. And that sector is unprofitable technology. And, just like any sector, utilities, REITs, you name it, it's, they're going to have good periods, they're going to have bad periods. Unprofitable technology is going to do the same, but because this stuff is so high multiple, it's magnified more than any other sector. And that's a lot of what you've been seeing lately.
So, Matthew, if you are one of those investors who's perhaps invested in ARK Innovation Fund or invested in individual high growth or even just mega cap technology stocks, just look at what happened to Netflix after its earnings report last week. What do you suggest that these investors actually do? Should they be thinking about rotating into other sectors, or should they be holding through some of this volatility?
So they should have been thinking about rotating quite a bit ago, unfortunately. If they're using this type of stuff the right way, meaning it's a small part of your portfolio, maybe you just ride it out. But if if this is a large part of your portfolio, or you're the guy who got in, February 15th last year at the highs, you've got to look at de-risking your portfolio here, going into, Fed raising interest rates. We got to figure it gets worse before it gets better.
Given that fact, I mean, the SARK ETF, the Total Capital Short Innovation ETF, you have to have a stomach for this kind of volatility, even with an ETF. So what do you want to say to people who might want to short, whether it's, ARK, who are looking at opportunities here to do that, whether it's through your vehicle or others?
So, I would look at SARK in a bunch of different ways. I'd look at it as a tool. So you could use it to make bets on the current macroeconomic environment, Fed raising interest rates. You could use it to hedge portfolios. To us, this is a way better hedge than inverse Nasdaq or inverse S&P funds, because in those types of ETFs, what are you shorting? You're shorting FANG stocks, Apple, Microsoft, and Google. Whereas, if you use SARK, what are you shorting? You're shorting Teladoc, DocuSign, companies like that. I would rather be doing that if I want to express a negative view on the markets, or I'm looking to hedge part of my portfolio.
Good advice for a lot of people who are looking for sound advice right now. We appreciate your joining us today, Matthew Tuttle, Tuttle Capital Management CEO and CIO. Clearly, we're going to take a breather. When we come back, we're going to check these markets where we stand as we head toward the closing bell.
Welcome back. Let's get another check of where markets are trading this afternoon, because we have paired losses. The three major stock indexes coming off session lows, still sharply in the red, but definitely not quite as red as things had been earlier. Now, as we can see, the Dow Jones Industrial Average currently off more than 300 points, or about 1%. The Nasdaq Composite off about 1% and sinking further into a correction. And the S&P 500 is off about 1.1% this afternoon as we speak. Now, taking a look at the sector action in the S&P 500, leading to the downside are utilities, healthcare, and information technology. So definitely seeing those big tech stocks coming under pressure yet again during today's session. Whereas on the flip side, we do have energy, consumer discretionary, and the industrial sectors outperforming, although all 11 major sectors in the S&P 500 are in the red today. Now, in terms of session lows, do you want to highlight that the S&P 500 at its worst point of today's session had been in correction territory. The number that we're looking at for that close is 4,316.9. We are currently above that level, as we can see here on the screen. But if that index does close below that level, we will be in a correction, or 10% below the S&P 500's most recent record close. But let's shift gears now and focus on our 2 and 2. That's 2 stocks I'm watching and 2 stocks Adam is watching this afternoon. And let's take a look first at shares of Coinbase, because like the broader stock indexes, Coinbase is pairing losses from session lows. It had been down more than 8% earlier today and had been underperforming even relative to the broader market. And the big reason for this is because of the recent slide that we've been seeing in cryptocurrency prices. Now, Bitcoin prices have also stabilized this afternoon, but earlier today, we did see the largest cryptocurrency by market cap trade lower by more than 8% to trade below $34,000 for the first time since July. Now, other major cryptocurrency prices had also extended declines today, including Ethereum and Litecoin. And cryptocurrency prices and stocks linked to crypto, like Coinbase, have been under pressure the past couple of weeks now because of concerns that tighter monetary policy from the Fed would lead to reduced liquidity and impact speculative assets. And also want to point out that a new proposal from Russia's central bank suggesting a full ban on the use and creation of all cryptocurrencies in the country has also added to the risk-off tone among digital currencies heading into this week, since that proposal did come out at the end of last week. Now, for Coinbase, those shares are down more than around 30% so far for the year to date. Then want to shift gears now and talk about shares of Peloton. Now, this stock, as we can see, is actually up about 8% this afternoon, but for context, this is coming after a more than 80% drop since its record high from January 2021. And today's move higher comes after the activist investor Blackwell's Capital sent a letter to Peloton saying it has, quote, grave concerns about the fitness company's performance, and it also called on Peloton's board of directors to fire CEO John Foley immediately and consider a sale. Now, Blackwell's Capital took issue specifically with Foley's pricing strategies, the fact that he hired his wife as a key executive, and also his handling of Peloton's treadmill recall last year. Now, Blackwell Capital has a less than 5% stake in Peloton, and it's unclear whether any of these demands will gain traction. But at least for now, that stock is seeing a pickup after a recent decline. Adam?
Emily, want to go to the airlines, and we're going to do what we call a 5-board, show you 5 of the airlines, the biggest: Delta, United, American, Southwest, and JetBlue. And you can see Southwest barely flat, a little bit positive today. They're going to report earnings on Thursday. And one of the things investors might be picking up on is the fact that when you look at TSA throughput, the people going through the nation's airport security, it has held steady despite the Omicron wave and all of the discussions we've had with airline CEOs from companies that have already reported. So there's an expectation that this visiting friends and relatives, the domestic portion of travel, has held up well for Southwest. Again, they're going to report before the bell on Thursday. But something else to keep in mind. You've got Helene Becker over at Cowen. Cowen tracks airfares every week, and they make this, you can go to their notes to see this. And what they have found is that published fares are up 9.7% year over year, and they're up 7.5% week over week. Why is that? Well, if you're planning to get out of Dodge for, whether you're in a cold part of the country and you want to go somewhere warm in the spring, good luck getting a ticket. I was on a site last night, and not really great deals to be had. You're going to be paying top dollar if you want to travel, and the airlines, most of them selling off today, but there's an expectation they're going to, rebound come the spring. Take a look at Macy's. When was the last time you looked at a retailer like this, a department store, and saw their shares up? You see that number? 16%. That's an OMG scream, right? So here's what's going on. Not only is Macy's up today, but you have other department store stocks trading higher. On the news that the Wall Street Journal broke, that Kohl's has received a $9 billion takeover bid from Starboard Value LP. So this is having positive effects on other stocks, and Macy's is one of them. Just remember, too, we won't get Macy's reporting for the fourth quarter until February. But the third quarter, before we went into the holidays, Macy's really blew away expectations with sales over $5.4 billion, which was much higher than the street expected. So we're getting ready for Macy's to report their holiday sales quarter. Plus, you got this positive news for the traditional brick and mortar retail sector with this offer regarding Kohl's. Emily?
Adam, we're going to talk more about the streaming wars and bring in New Construct CEO David Traynor on the heels of Netflix's disappointing subscriber growth reported in earnings last week. That's on the other side of this break.
Okay, let's check the markets as we are 27 minutes to the closing bell. And here's where we stand now. We are well off session lows when it comes to the Dow. Now off about 184 points. Remember, at one point today, off more than 1,000 points. You have the S&P 500 also trading down, but off of its session lows. Now down just 25 points. At one point, more than 3%. Nasdaq has recovered as well. Now down only 0.25%. Whenever you get a kind of report like we did from Netflix, you think of that, and it didn't quite go this way, but back in 1912, somebody aboard the Titanic tapping Captain Smith on the shoulder saying, there's an iceberg straight ahead. Well, the person doing the tapping right now is our next guest in the stream, and that would be, as we bring into the stream, David Traynor, New Construct CEO. And the reason I use that Titanic analogy is when I saw your note, I also want to let you know Alexandra Canal is joining us, by the way. But I got to ask you this, David. I saw that you have a price target on Netflix of $170. And the stock today is trading up. I hit the wrong button, but the stock today is trading at $383. Help me understand where you're going with that, because I feel like there's an iceberg straight ahead.
Yeah, I think, look, in general, I think the market is sort of reconciling to reality. And look, Netflix, our report, the original meme stock, or a meme stock original, to play on sort of one of the Netflix titling cliches, really just seeks to hold the business accountable to its valuation. And when you look at the current stock price, it implies effectively they're going to have more revenue than Fox and Viacom combined, and something like 500 million subscribers. So the current valuation is still really outlandish, especially when you take into account the fact that, look, Netflix has burned billions of dollars, 10 billion of the last 5 years to be specific. The business hasn't made money since they were in the business of distributing CDs. The streaming business is highly cash flow negative, and it's only going to get worse. I feel like just recently here, we've seen the market wake up to the fact that competition is crushing Netflix, and competition is only going to get worse. And it's just sort of the dream is over, I guess, so to speak.
David, I do want to push back a little bit on that price target. It still seems pretty aggressive considering we have potential growth in Asia and the international markets, still a lot of upside there. This year alone, we also have some big heavy hitter Netflix shows coming back like Bridgerton, The Crown, Stranger Things. So really convince me on your thesis here that Netflix is that overvalued.
Yeah, look, the international markets are the least profitable consumers or subscribers. They don't really make money on those subscribers, and that's where most of the growth has been coming from, which is why they remain cash flow negative, right? And the only year they were cash flow positive was 2020 by a small amount, and that's when they got crushed in terms of cutting back on content because of COVID, right? Now they've announced that they're going to spend 17 billion, I don't remember what the number is, on creating content. They're going to lose money on all this. So in as much as we may love these shows like Stranger Things and others, and they got new product coming out here, you got to remember they're losing money on that. And the real problem here with Netflix is that they're at a major competitive disadvantage to firms like Disney, because Disney can make billions, and they make 20 billion, excluding the Fox acquisition over the last 5 years, compared to Netflix losing 10 billion, because Disney has more ways to monetize content than streaming. Streaming is a commoditized business. I mean, how many YouTubers are out there? Anybody can stream content, and you need other ways to monetize that content if you want to have a sustainable platform. Which is why you've seen all of the traditional studios, right? They build a reputation, a brand, a content monetization platform before streaming, not the other way around. All streaming is another way to onboard customers. And it can be a loss leader for these other firms because they already make money. Netflix is just a loss leader. And that's why our price target is so low, because look, they're not making any money at the current model. And if they're never making any money, the price target should be zero, right? So 170, I think, is really fairly generous and gives them credit for fairly high sustainable margins, not as high as they are now, and a little bit more growth.
David, speaking of growth and speaking of monetization, Netflix has been breaking into video gaming, of course. And what do you think is going to be that next big avenue of monetization for Netflix then? Is it going to come from gaming? Do you think they potentially break into advertising, as has been speculated over the past couple of years? Where do you see that growth beyond just adding new subscribers coming from?
I mean, look, if they haven't done it yet, I don't know what they're waiting for, right? I mean, why wait to be profitable if you can be profitable, if it's a real viable option? And I see these other markets, whether it's gaming or NFTs, like they hinted out the other day, it's sort of like the Elon Musk way of promising things that keep my stock price elevated, or the AMC or GameStop way of promising things to keep retail people invested in the story. I don't think, they're going to make money in gaming. Like, look, Microsoft is a 300-pound gorilla. Sony's a 300-pound gorilla in that business. Netflix doesn't have a chance to compete with those firms. That gaming is an extremely capital-intensive business, just as content creation is extremely capital-intensive. In order for Netflix to go toe-to-toe with those incumbents, they'd have to spend tens of billions of dollars. They can't do that. Their investors don't have the appetite for that. And then when it comes to other ways of monetizing the business, I think all of that advertising, look, if they could do it, they would. If they bring advertisements into Netflix the way it is now, they get crushed in terms of subscriber growth. They know that. That's why they haven't done it. I just don't think it's a really good business, not as good as it's been hyped up for people to believe.
And David, you did say that Disney has a huge advantage over Netflix, as it can monetize content in a number of different ways. However, I do remember when Disney Plus first debuted, that was one of the biggest risks because Disney was so distracted by all of their other businesses that the streaming side would suffer. Meanwhile, Netflix has poured a ton of money into content, especially compared to competitors. And really, besides those big franchises like Star Wars and Marvel, the Disney Plus library doesn't have a ton to work with. So considering all of that, don't you think Disney can really hurt itself in the long run?
I don't think so. You're right. Like, Disney Plus isn't necessarily the focus for Disney because it doesn't have to be, right? Because they make money in so many other places. Disney Plus is just another way for Disney to onboard customers into the current profit-making machine. It's another way for them to grow their business by bringing more people into the fold through streaming into what is already a profitable business, right? So that's the advantage. And Disney didn't need to rush. They could do it whenever they did, and they did it later because Meanwhile, Netflix is the one that sort of had to burn all that cash to bring people into the streaming loop. But you look at Hulu, you look at YouTube TV, Apple TV, HBO Max, Paramount, like what's on the screen now, right? These are all other competitors. It doesn't just have to be Disney that kills Netflix. It's the dozen or so other streaming firms that Netflix has to compete against. And right now it's priced as if it's going to be by far the largest streaming firm and be able to continue to raise prices. And I just don't think it's realistic. I think we're already seeing the impact of competition, and that competition is only going to get stiffer.
All right. We want to get you back here because this is a story that's going to play out all year because streaming's not going anywhere. As for Netflix, part 2 when you join us again. Thank you so much for joining us. And David Traynor is the CEO at New Constructs. Ali Canal is one of our producers and also the reporter who does Fame and Fortune for us and covers streaming as well. When we come back, for a brief second, the Nasdaq went positive. We're going to check these markets. We are in that threshold, the last 20 minutes of trading. And although we got to talk about inflation and mortgage rates and housing, get the Pepto-Bismol because here we are heading toward the closing bell. Talk about inflation. One thing where it hits everybody is whether you're renting or even buying a house with mortgages. Housing prices are high, mortgage rates are going up. Inez Ferre has been following what is going on in the housing market and what might still be coming at all of us. And Inez, what have you got for us?
Well, Adam, we're finding that inflation is still keeping these prices higher for homes. And if you take a look at the mortgage rates, which have been rising, you had last week Fannie Mae or Freddie Mac announcing the 30-year at 3.56%, up 11 basis points from the prior week. And you have the 15-year at 2.79%. So the mortgage rates have been rising. And those home buyers that were perhaps hoping that if the mortgage rates rise, then you would see sort of a tapering off of prices or perhaps even a little bit of a relief on home prices. Well, they're still going up. And part of this, of course, has to do with the low inventory, but also part of this has to do with inflation. Keep in mind that in the 70s, early 80s, you had interest rates that were 15 to 18%, but you still had home prices going higher. As far as what the correlation is between mortgage rates and between prices, it's really between activity. So the activity in sales is expected to slow down a bit. But even so, I mean, Fannie Mae is saying that sale of existing homes in 2022 will slow down by 3.2%. That's still the second fastest annual pace since 2006. And as far as prices are concerned, Fannie Mae is expecting a rise of anywhere between 7 and 8% in prices this year. But that's on the conservative side, because you had Goldman Sachs last year predicting that this year you would see home prices go up by about 16%. So net, home buyers that have been sitting on the sidelines are now also trying to rush out to buy homes before the mortgage rates go higher. They're still seeing high prices for the homes.
All right, Inez, we're going to keep talking about what's coming down the pike, not only for people trying to buy a home, but even those who want to build one. Let's bring into the stream Dreamfinders Homes Chairman and CEO, Patrick Zalupski. And it's good to have you here. Your stock went public a year ago. You are trading higher today. And you are in, what markets are you building in? I saw Denver, I think Jacksonville, Orlando, and Washington, D.C. Where else?
Thanks for having me, Adam. That's correct. We're in predominantly the Southeast in the markets you identified, as well as Texas. We completed a large acquisition in the 4 major Texas markets last year. And so that positions us well in one of the largest housing markets in the country.
Patrick, this is Emily here. Dreamfinders Homes, of course, your company is one that creates, builds, and sells homes in these high growth markets. Can you tell us about where you're seeing some of the most demand and how these trends have changed over the course of the past 12 months?
I mean, we're seeing steady demand across all of our markets now. As you guys identified, we're in what we believe to be high growth Southeastern markets, including Texas and Colorado. But it's been steady. We continue to remain bullish on housing. We think the cost inflation and some of the sort of tempered buying has been maybe a positive for home building, just to slow down the rapid appreciation we saw in the second quarter and third quarter of 2021. So, we're looking for a nice steady market where we can continue to take market share. And we sort of see that as the outlook over the next several years.
Remove the shade from the eyes of those of us who don't know your industry as well, especially when you look at millennials who might be, household formation. Which is going to be the bigger impact on them? Is it the price of the new home? Because we know that lumber prices, commodity prices going up. Or is it the interest rate? Because when you get to be someone who's Gen X, 3.5% interest is still in my mind, wow, because we were alive during those 15% interest rates.
That's right. To your point, rates are still historically low. I think it all factors in, right? Everything is a cost input, and it sort of, the output is what can a buyer afford. And so if rates go up, then maybe there's some adjustments in the buyer's decision where they have to be in maybe a few less upgrades in their home, a few less bells and whistles, or they have to be in a different community than they were expecting. Maybe they have to go a little further out to get a more affordable price versus an infill location. So all of those variables go into the equation. And, that's where Dreamfinders, we think, has really strived to be successful, where we want to provide value no matter what the circumstances are. So our goal at the end of the day is just to provide great value to our customers. And so if rates are going up, we have to take that into effect. Or if costs are going up, we have to take that into effect. So it could mean a smaller home, or as I said, you may have to drive a little further out to a maybe a little less desirable location.
For those who are considering perhaps building their own home rather than purchasing an existing home, what do you think the main factors are that some buyers should be considering when making that decision? And where have you seen people really falling in terms of whether to build their own home or purchase one that's already existing over the past year, just given the current market environment?
Sure. Well, clearly the resale market is significantly larger than the new construction. It's probably 80 to 85% of all homes sold every year are resale versus new construction. So we're a smaller segment of that. But there's a customer out there that wants to design it the way they want to have it. They want to pick out the options they want. We'll offer a high degree of customization, structural options, air quality systems. So there's a lot of benefits in technology that exist now in new construction that you just won't be able to achieve through a resale home in a lot of cases. So those are the benefits that we want to tout. But we believe in home ownership. So whether it's new construction or resale, we like to see a robust housing market, and we want to grow the overall pie.
All right, we'll leave it there for now. Patrick Zalewski is Dreamfinders Homes Chairman and CEO, and we thank you so much for your time. Let's get another check of these markets before we head to break, because as we can see, the Dow Jones Industrial Average has swung back into slightly positive territory, definitely seeing quite the reversal here from what we had at session lows. The Nasdaq Composite also higher by about 0.3 percentage points as we head into the final 10 minutes or so of trading. That tech-heavy index had been off nearly 5% at session lows. So again, seeing quite the recovery happening in these final minutes of trading. But coming up on the other side of this break, we have the countdown to the closing bell. Stick with us.
All right, less than 7 minutes to the closing bell. A tremendous swing today when you look at the Dow off more than 1,000 points, now positive by 150 points. Jared, help us understand, though, what's really happening here.
The market is very illiquid right now, and we're seeing moves to the downside and to the upside just get exacerbated by the low liquidity. And if you blinked, you missed it. What bear market or what correction territory were we worried about earlier? Even the Russell 2000 now up 2%. It was down something like 4 or 5%. NASDAQ up 1/3%, had been down 5%. And I just want to show you one of these candles here. This is today's price action, and this is a strong rejection of this price level. However, we see these candles quite a bit in bear markets, and that's kind of what the market is trading like right now. NASDAQ still in correction, hasn't hit 20% to the downside, but we do see these flashy rallies when the market gets a little bit excited and also a little bit illiquid. The last time we saw something like that, you would have to go back to March of 2020. So 2 years ago, in the midst of the pandemic, we got a couple of these candles, and that started a big price decline. The market jumped up a few percentage points, but then sold off about 25% to the downside. And so you got to take into consideration, are we repricing something into the market as drastic as COVID 2 years ago? A hawkish Fed? Well, you have to make your bets here, and that's what the market is doing. Here are the Dow Jones transports, not looking too bad right there, but let me just jump into the Nasdaq 100 and take a look at some of the heat maps. Guess what? Amazon now positive along with Alphabet. This was a vastly different picture only an hour ago, much less at the beginning of the day. Facebook also up more than 1%. And taking a look at some of the biggest winners and losers here, to the top, Peloton, up almost 10%, followed by Datadog and Atlassian, Splunk. But these are a lot of names that have got absolutely beaten down over the last, 2 months for some of these, since the beginning of the year for the others. So let's take a look at the sector action and see exactly where the money is flowing now. Now, most of these sectors had been down at least 1%, some 2-3% at the lows. Now we have consumer discretionary, a real bright spot. That's up almost 0.9%. You can see those numbers kind of increasing there, followed by communication services. That's a Facebook story, and energy as well, industrials, financials. So looking like the market is scooping in, buying some tech, some of those beaten down mega cap names, along with energy, which has been the best performing sector of the year. Have to see what happens into the close, and especially into that Powell presser on Wednesday, guys.
Yeah, we're still 2 days away from it. We're going to be hitting all of that. We're going to take a quick break, but we have the closing bell for you in less than 4 minutes, right on the other side of this commercial break. Okay, before we check the markets heading toward this closing bell in less than a minute, I want to let you know the folks that are going to help us understand what we've witnessed today are standing by. We have Sean O'Hara, Pacer ETF Distributors President, joining us, along with Brian Vendig, MJP Wealth Advisors President. And we are going to ask them about opportunities that might be created from what we witnessed today. But let's look where the markets are setting up. Because talk about a swing. The Dow was off more than 1,000 points at one point. It is going to settle most likely in positive territory, up about 100 points. The same with the other two indexes. Let's take the closing bell and then digest it right after this.
And that is the closing bell this Monday, January 24th. And what a volatile day of trading it was. As Adam was mentioning, taking a look at the swings that we saw in these major stock indexes, the S&P 500 closing up by about 0.3 percentage points. At session lows, that index had been off by about 4%. The Dow, of course, had been lower by more than 1,000 points at its own lows as well. That index is going to settle higher by more than 100 points, or about 0.3 percentage points. And the Nasdaq Composite really recovering losses here, had been down as much as 4.9%, now closing higher by about 0.6%. Let's turn back to our panel to digest what exactly happened during today's session and where we might be heading. And Brian, I'll turn this first question over to you. What do you think this massive swing in the indexes suggests about the markets and where we may be headed?
Sure. Thanks, Emily. I think today's market action really puts a head on the uncertainty that investors are dealing with, because we have a bite-sized sandwich to get through around that. On the bookends, we have Russia, Ukraine, obviously going from late Friday into the beginning of today as a concern. Of course, everyone's waiting to hear about Federal Reserve policy, and I think the markets have been extremely concerned about the number of rate increases paired with balance sheet tapering. And then also we've had a mix of earnings. So when you put all those things together, it's not surprising that you have a day like today where the market is completely schizophrenic. And I think more will settle in as we get through the course of the week, especially with comments coming from the Fed on Wednesday.
Let's talk about that, Sean, because we're all going to be paying attention to Jay Powell on Wednesday. But what we witnessed today, was it too soon to be bottom fishing and looking for opportunity?
Well, thanks for having me. I think the only thing that's certain is that when interest rates rise and when you have an inflationary cycle, PEs have to go down. There's an inverse relationship there. The question is when and how fast and how far. And so we had a little bit of a panic sell this morning, probably more than anything driven by what's going on in Ukraine and Russia and the potential fear of that war. But I also think that there's a certain amount of sentiment in the market that's starting to wake up to the multiples that are being paid at the top and the big mega cap names in these indexes, which control such a big share of the overall asset weighting that when they struggle, then they really do pull these indexes down, even an index like the Nasdaq 100 or the S&P 500, where there's more names than, say, the Dow Jones, which only has 30. And so I think for investors, we've made an awful lot of money the last couple of years. It's been driven mostly by multiple expansion. We are going to have higher interest rates. Inflation is going to be a problem for a while. And history tells us that we'll see PE contractions. And so I think in this environment where the money will be made is by buying stocks that are of high quality, that pay dividends, that generate a lot of free cash flow and have a high free cash flow yield. They will tend to do better in a rising interest rate, rising inflation market. So I don't think you need to be scared away of investing in equities. I just think you need to rethink your strategy and have a forward-looking strategy as opposed to trying to continue to do what has been working for the last 2 or 3 years.
Brian, as we head into this January Fed meeting, monetary policy statement and press conference, what do you think the market needs to hear in order to remove some of the uncertainty around what the Fed's next move is going to be and exactly how hawkish and how tight financial conditions are going to be this year?
That's a great question, Emily. I think what investors are looking for is getting clarity on the pace of the change and also thinking about how open the Fed is going to be in being flexible and adaptable with their policy decisions. I mean, the Fed, as many have said before, is in a very tough spot. They know history has shown that if they move too quick on interest rates, it adds to the risk of moving the economy into a slowdown and the risk of a recession, which we don't think is on the horizon, but they're definitely sensitive to. And at the same point in time, they're also trying to manage the unknown regarding the timing and sequence of supply chain inefficiencies resolving themselves over the balance of the year, which should cause headline inflation to come down. And obviously that's something that they hope for. So from our view, I think the markets have priced in that we'll see a 25 basis point increase in March. We'll see another one in June. But I honestly believe that the market's been way too pessimistic about the second half of the year and pricing in rate increases that might be unrealistic, considering that there's still an opportunity for full year inflation to come down. We think that the Fed has a chance to maybe do 3 rate increases this year, but the third might not come till December. We also have to keep in mind that we do have midterm elections as well, and they like to maintain historically their independence around that time period also from a political perspective.
Sean, if you were to follow what Brian just shared with us about interpreting whatever that statement says and what Jay Powell says on Wednesday, how do I, as an investor, then put that to use on Thursday and Friday? Because we talked about it last hour. We knew back in November, Jay Powell signaled that we were going to finish the taper in March and that we were going to have liftoff. So I guess the big question is, what has changed? Nothing's really changed.
I honestly don't think anything's changed other than some of the rhetoric around the outside from 3 to 4. You've got some folks going on some of the TV shows saying that they think they're going to have 6 rate increases this year. And so the Fed is, as the other member of the panel said, they're sort of in a box. If they make the first 2 cuts and then things slow down, then they might have to retreat. But if they make the first 2 cuts and the economy seems to be fine with that and sort of gets up off the ground and starts to grow again at a fairly rapid pace, then they'll continue, which might be viewed as a negative. So there's a whole bunch of variables that need to go into our thinking. On the fixed income side, I don't think you want to own government bonds, and you don't want to own duration in this environment to any great extent. So I would be buying adjustable rate securities like floating rate or bank loans. I'd buy high yield in this market because high yield securities tend to do well in a rising rate, rising inflation environment. And then on the equity side, if we are going to buy this notion that the Fed's going to raise and you're worried at all about inflation, then I think you need to rethink your stance on whether you're overweight growth, which has been great, or whether you start to shift to more high quality value type names in this environment, which tend to do better in those types of cycles.
Brian, we got purchasing managers indices out from IHS Markit this morning, and the composite PMI for the U.S. was at an 18-month low. Given the flow of economic data that we've been getting and what we'll likely be getting out of the Fed this year, is there a risk of a recession, or are we going to keep growing into the end of this year at least?
Emily, we do not think that there's a risk of recession in 2022. We definitely recognize that there's been a slow down in economic data, and definitely over the last couple of months and weeks, we know that that is tied to the impact of the Omicron variant globally as well as domestically. We are optimistic about the reopening still for the services part of the economy this year. It wasn't fully reopened last year. We think there's a good probability of that happening this year. We also think that in light of all the noise that have happened in the market since December into this year, we also want to look at smaller companies as an opportunity. I agree with Sean that you want to have parity within your portfolios based on valuation between growth versus value, specifically in the cyclical side. But don't forget small caps as well, I think is an opportunity, as well as looking at the private markets in real estate, which is also another great hedge for inflation while trying to add some predictable cash flow to your investment. So again, I think these types of corrections are normal in a market that's concerned about policy changes and the path of the global economic recovery. We think that the market can weather through these changes. The path of the recovery is still in place. And I think investors should take out their shopping list right now and think about the balance of the year.
Brian Vendig is MJP Wealth Advisors President. Sean O'Hara is Pacer ETF Distributors President. Thank you both for joining us. Let's get back to Jared Blickery, who has a final thought for us. And Jared, there's an interesting article in Bloomberg today, which apparently pointed to the VIX and a metric that you can use with the VIX to signal market bottoms, and that we might have actually gotten that metric. But what do you want us to consider after what we've just witnessed today?
I think we need to consider that we are in potentially, not necessarily, but potentially a massive repricing of risks similar to where we found ourselves in February and March of 2020 at the beginning of COVID. This time around, we have a Fed that has a lot more sway. In fact, it's all kind of surrounding the Fed right now, whereas they didn't have that kind of optionality 2 years ago, except to throw everything in the kitchen sink at it. Here is the VIX. You talked about the VIX. Well, this is a huge reversal, and this could be an early step in the right direction here. Let me just put a one-year chart. We can see we've had many big spikes before. Looks like this one is actually taking these out. But you go back on a 2-year basis and you can see this doesn't even approach the volatility that we saw in the early part of the pandemic. So are we heading back that way? I don't think so, but we need to keep our eyes and ears out because we are seeing a lot of risk on, risk off behavior, more risk off than risk on. Here's today's leaders market. Now, retail had a really nice day off of the Kohl's news. That was a bright sector. So XRT is a retail ETF. That's up 6%, followed by 3% for the home builders. ARK components, ARK ETF fund, that's up over 2.8%. Then you have software, IPOs, internet, regional banks. We have the stocks, that's chip stocks, transports. So we've seen this screen before. We saw it early on in the year, and it looked like this was going to be a dip buying opportunity. That was not a dip buying opportunity. In fact, there has been several that have just been slammed and taken out. Even Dr. Marko Kolanovic over at JP Morgan issued a all clear, it's time to buy value, probably at the expense of growth, but even that didn't work just yet. So you want something to buy here? Maybe energy. It's time to start dipping your toes back into that. And if you have some growth stocks on sale that you must buy, like Apple, you're always going to be an Apple. Well, it's on sale now. But I think we need to wait to see what happens with the FOMC on Wednesday. That's just too big of a wild card right now.
All right, Jared, we will be playing those cards all week long. When we come back, we haven't mentioned Bitcoin today. We're going to, because after what we witnessed over the weekend and last week, there was a little bit of good news if you are following Bitcoin and other crypto assets. And we're going to hit that right after the commercial break.
IBM earnings just crossed the wires, and let's head right over to Yahoo Finance's Jared Blickery with the details. Jared?
That's right. We have the stock up about 7% in after-hours trading, and here are the numbers. For the fourth quarter, revenue came in at $16.7 billion, beating the street estimate of $16 billion. And when you break it down by segment, we have consulting segment revenue, that's $4.75 billion, up 13% year over year. Software revenue, $7.27 billion. Infrastructure, $4.41 billion, that's a slight drop year over year. And then financing revenue of $172 million, that is down 30% year over year. Now their operating EPS EPS that came in at $3.35, beating the Wall Street estimate of $3.23. And then adjusted gross margin came in at 58%, beating the estimate of 56.1%. I do have some commentary by the CEO, Arvind Krishna, said we increased revenue in the fourth quarter with hybrid cloud adoption driving growth in software and consulting. Our fourth quarter results give us confidence in our ability to deliver our objectives of sustained mid-single digit revenue growth and strong free cash flow in 2022. Here's another note. IBM's post-separation baseline free cash flow for the year was $7.9 billion, excluding certain charges and pre-separation activity. Also, they ended the year with $7.6 billion of cash on hand, and that is down $6.7 billion from year-end 2020. And companies on its earnings call tonight is going to discuss their 2022 expectations. And I just want to chart this real quickly. IBM has actually been an outperformer over the last 2 months when we saw tech and especially software really flag. So some of these legacy brands like IBM and also Cisco kind of bucking the trend there over the last 2 months. You can see up about 10%.
Jared Blickery, thank you so much for that breakdown. Well, it's not just stocks that rally back this afternoon. Bitcoin prices are back above $37,000 after falling below $34,000 for the first time since July earlier today. Our next guest joins us to break this down. Noel Atchison is Genesis Trading Head of Market Insights and joins us now. Noel, you pointed out that Bitcoin's 30-day correlation with the S&P 500 has continued to increase and just recently reached the highest level since July 2020, whereas Bitcoin's correlation with gold is now only about 15%. For investors, what does this mean in terms of how to use Bitcoin in a portfolio and balance out risks from other investments?
That's a really good question, Emily, and hi, great to be with you. I do have to say that everything I say is my opinion, not that of my employers, and of course, as usual, nothing I say is investment advice. But that question, Emily, the difference between the correlation of Bitcoin with the S&P 500 and the correlation with gold, when Bitcoin is supposed to be digital gold, comes to the very crux of what we're seeing in the market. We're seeing two very different Bitcoin worlds. The price moves that we've been seeing over the past few weeks are macro-driven. Investors are treating Bitcoin as a risk asset. But here's the thing, all of the selling, well, most of the selling is coming from short-term holders. In other words, traders, short-term retail perhaps that don't have a high conviction, but also macro investors that are treating Bitcoin as a risk asset, other cryptocurrencies as well. Therefore, it behaves like one when they are running to safety. This does not take away from the fact that there's still a lot of accumulation going on. Long-term holders have been accumulating Bitcoin steadily for months now. 75% of Bitcoin is held in what are known as illiquid addresses. The amount of Bitcoin that hasn't moved in over a year is almost 60%. And those are the holders. The majority of Bitcoin out there belongs to holders who do see Bitcoin as a longer term store of value, who do see it as digital gold, only that's not what is moving the price. Therefore, that's not what we see in the correlation.
So as we catch our breath and we try to slow down to see what's actually happening here, you pointed out that there's a metric that those in the crypto world would probably understand very well, but help us who aren't necessarily, at your level, understand what spend output profit ratio means when it comes to Bitcoin in particular.
I love this number because I'm a total nerd, and the fact that we get to see data on chain in a transparent fashion that gives us deep insight into investor sentiment and behavior. This is something that investors in traditional assets, when they understand this, I mean, you literally can see their heads explode. SOPR, now that you're asking about, Adam, is a metric that tells us whether investors are selling at a profit or at a loss. And this is really exciting, it can be split into long-term holders and short-term holders. Long-term holders, when they're selling at a profit. Short-term holders, no surprise, they are selling at a loss. And the loss at which they are willing to sell is increasing. This is a signal of what we would call capitulation, which is also a sign that support is on its way.
I'm wondering, as we take a look at Bitcoin prices today, as I was mentioning in my intro, they are up during afternoon trading, but they are still down by essentially half from their November highs. I'm wondering, what does sentiment actually look like among traders right now? And what do you think that indicates about the near-term price action we should be expecting?
That's a very good question. It's any kind of rally will take it. Let's face it, this relief rally that we're getting is indeed very good news. But stepping back a bit, too soon to tell. We could see the short-term sellers that I was just referring to take this brief rally as a sign, yay, now I can get out of even more at a slightly higher price had I continued to sell lower. It could be the turnaround. I have mentioned also that support has been building, but to be honest, as long as there is so much uncertainty overhang in the market, and as long as markets generally are waiting to see what comes out of the FOMC meeting on Wednesday, as well as what's going to happen to inflation, not to mention economic growth in the leading economies, I think we're in for some choppy times.
Why would those long-term holders who are sitting on their crypto assets not have taken what we witnessed, because it's always trading, taken advantage of the lows we saw? Wasn't this an ideal time to jump in, especially if you're a long-term player in this?
We're seeing that. We are seeing long-term holders, according to the on-chain data, continue their accumulation. There was a very, very slight dip over the weekend, but minuscule. We're seeing long-term holding continue. It's been increasing steadily for the past few months, and this does signal conviction from those that fully understand the potential.
What catalysts do you think Bitcoin or other cryptocurrency investors should really be looking for this year? Because it seems like some of the known unknowns, at least, are coming from Fed policy, coming from regulation, coming from potentially geopolitical and other regulatory risks outside of the US. Where are you seeing some of the catalysts that investors should be watching?
Well, aside from what all investors in all types of assets are waiting for, crypto-specific catalysts, I would say, would be greater regulatory certainty. Regulatory uncertainty is often cited by institutions as one of the biggest barriers to more investment from them at the moment. So anything that points to greater regulatory certainty, such as the rumors of an executive order that might be coming down from the president's office over the next few days, could, again, we don't know what it's going to contain, but if it points towards greater regulatory clarity over this year from the various agencies, then that could be taken as very good news for the crypto ecosystem overall.
One last thought on all of this. When we look at crypto, there are more affordable, like Solana, crypto assets that we could be purchasing, and yet all the attention is Bitcoin. That didn't turn around today. Solana is trading down right now. Any explanation for those of us who don't have quite the cash to go buy a $36,000 Bitcoin, but want to look at those more affordable assets?
I love that question. It speaks to one of the biggest differences, Adam, that we're seeing in the market between now and last time we had a 50% drawdown from all-time highs, and that is the diversity of the market now. Sure, they're more affordable, but in the end, you know, it's not necessarily what you buy, it's what you pay. There's a different fundamentals. All of the different assets that you see in the top 20 of the market cap rankings now have different fundamentals, different use cases, different technologies. Even 3 years ago, 4 years ago, last time we were in a bear market, there was Bitcoin, and if you felt really daring, then perhaps Ethereum. That's not the case anymore. Now the market is diverse. That in itself gives it a certain degree of resilience, a large degree of resilience, really, and also makes it a much more interesting proposition for any type of investor to find a thesis that he or she identifies with, and then invest in the new technology that the tokens in this industry represent. So why is Bitcoin outperforming some of the smaller cap stocks? Because it is more liquid, in my opinion. It is easier to get in and out of. That's why it tends to fall by less when things are falling, tends to rise by more when things are rising, but that can turn very fast. The smaller assets, they are more volatile. They tend to move more sharply in either direction. But meanwhile, we have a lot of growth, a lot of fundamentals, revenue even, and total value locked on smart contracts in some of these blockchains that are changing the whole valuation proposition of this industry.
Noel Atchison is Genesis Trading Head of Market Insights, and we thank you so much again for your time this afternoon. Coming up, we'll discuss how real estate can be a hedge for retail investors in this year's market environment. Stick with us.
So we talk a lot about ways to not only grow wealth, but to protect the gains you've made, hedging your profits. And one way to do that is real estate. And you don't necessarily have to buy the land or the building. Let's talk about this, and not necessarily real estate investment trusts, but a new way, not necessarily new, but a way that you can get in on all of this. And Ben Miller is Fundrise co-founder and CEO. It's good to have you here. And your platform actually offers investors who might want to protect some of the gains that they've enjoyed over the past couple of years as the largest direct-to-investor real estate investment platform out there. So if I come to the platform with some money I want to invest, how would it work?
So before Fundrise, you couldn't invest in real estate in small increments. We basically made real estate investing as easy as buying a book on Amazon. So you go online, you go onto fundrise.com and you say what you're looking for. It could be fixed income, it could be long-term appreciation, could be diversified risk. And we build you a portfolio of real properties. And that wasn't possible without basically the technology underneath of our platform.
This is Emily here. I understand that this may vary based on the portfolio of funds that an investor is actually seeking out on your platform, but what kind of returns should investors expect through Fundrise?
Well, I mean, what's happening is inflation is driving real estate by huge measures. Last year, real estate equities were up 30 to 40% in a single year. So this year, I think inflation will continue to be a huge driver of real estate. You know, I don't expect it to be as high as it was last year. But the reason why we're seeing so much growth, we're seeing something like 3,000 new signups a day, is because there's so much demand for a hedge from inflation. I mean, the stock market basically is usually punished by inflation, and so really everybody's asking sort of what is going to happen if inflation basically takes hold this decade.
You're offering something for people with as little as $10 if they wish to invest, up to $100,000 if they wish to invest. Is there daily liquidity, or are those funds tied up over a period of time in order to get the return?
Yeah, it's liquid every quarter. So basically you hit a button and you can get liquid every 3 months, every 90 days. So it's not as liquid as the stock market, but arguably, you know, you don't need it to be as liquid every day. Basically, it can be liquid quarterly. So, and it's real estate. You know, real estate is a long-term investment. You don't trade it. You invest in it because of long-term macro trends you think that will lift it in the coming decade.
Well, and to that point, what sorts of long-term macro trends or what sort of factors do you think investors should be considering to identify opportunities on your platform in real estate? Because, of course, it is a little bit different than looking at the balance sheet of a company and trying to find opportunities based on expected future earnings and cash flows.
Well, so, you know, with all the inflation on the market's something like seeing 7% inflation. People are asking basically, how does it play out? How do you basically take advantage of it rather than get punished by inflation? So you have to look back to the 1970s. The last time inflation was this high, the stock market fell 36%. From 1970 to 1980, the stock market fell 36% and real estate went up 200%. And so what people are looking for in real estate is stability. And then when you're trying to figure out what kind of real estate, people usually ask what regions. Do you want to invest in Austin, in the Sun Belt? Do you want to invest in multifamily, single family, industrial? And that's where people can get more granular if they want to. Generally, people are more making a decision about wealth preservation, and real estate is up there, top 3, I think, for most people who are trying to preserve their nest egg.
And this is different than what some of us would understand as crowdfunding, because these funds, depending on, as an investor, which fund I place into, are going toward already built, perhaps real estate developments. If I'm looking for an income generator that might be kicking off rents, those kinds of things.
Yeah, I mean, our funds are mutual funds, but they're novel because instead of mutual funds of stocks, they're mutual funds of properties. And you invest in them directly, not through any intermediaries. So that's one of the big differences, is that most people really can't get at real property. And if they do, it's through a lot of layers. And so what the technology did was reduce the costs of entry. And so the big difference between last time, the 1970s, when inflation was roaring, is that most millennials and Gen Z don't own houses. They don't really own real estate this time around. And so they're not going to likely participate in that inflationary driven growth. So we basically made it possible for people to invest at $10 or even or $100 increments with technology. So that's a way for them to participate, even though they may not be able to afford a house at this time.
As you've charted out for us, the Fundrise platform itself has gone through an evolution in the types of offerings that you actually have on the platform, from individual deals to funds, and now, as you mentioned, to a portfolio of funds. Where do you see the future of the company heading?
Well, so underneath it, all of our offerings is technology. We have something like 100 software engineers at the company. So slowly but surely, what we're doing is using software to eat up the value chain of real estate investment. So before, if you want to invest in real estate, you either had to buy a whole property yourself or go through broker dealers or intermediaries. Now you can do it online, a click of a button with no commissions, no upfront costs. We're slowly now going through the rest of the value chain, the operations, the investment management, and using software basically to eliminate MBAs. You know, this coming decade, the white collar employee is going to be under pressure from software as AI and different algorithms can do a lot of their work for them and reduce basically overhead. So will the MBA be replaced by software? I think that we'll see a lot of that this decade. And our company is basically trying to drive that value change in our industry.
And we look forward to the future. Ben Miller, Fundrise, co-founder and CEO, all the best to you. We're going to take a quick break, but we got to talk some football right after the break.
Welcome back. Mobile sports betting apps launched in New York just earlier this month, and so far, New Yorkers have placed a staggering $603 million worth of bets. Oppenheimer senior analyst Jed Kelly joins us now for more on the outlook for sports betting. And Jed, when you hear numbers like that for New York, more than $600 million, again, this is a very top line number, and many companies so far have been trying to bring users to their platforms by offering welcome offers and other promotions. So how sustainable do you think this initial pop in business is going to be for the state and for other newly launched states for sports betting?
Yeah, and thanks for having me. New York's following a similar playbook to other states, right? The operators are coming in, they're advertising aggressively, maybe not as much as in some other states that we've seen in Arizona because of New York's high tax rate, but that's what you're seeing. And we typically see for 2 months, it's usually pretty aggressive. Then it settles down. You might see some promotional activity around the March Madness, the NCAA basketball tournament. It'll probably trail off then, and then into football season, beginning of football, that's when we would expect the operators to be more aggressive. I think right now we're still in an early part of creating a new market, so promotional activity is pretty important, and it's still early days, and we're not seeing a ton of product differentiation yet, but that's where we are right now.
When you talk about the early days of a market, I can think back to 2007. We're talking 15 years ago, having a discussion with a lobbyist in Washington from the gaming industry about national legislation to bring about this market that seems to be getting put together piecemeal state by state. As an investor, I don't know if I can afford to wait for the federal government to get involved, but what you just pointed out, I mean, state by state, it seems like we're not there yet. Should we be waiting before putting our toe in?
Well, if I think what you're looking at is the start of a new age of fan interactivity, right? And I think digital companies like DraftKings and Flutter's FanDuel are going to be leading the fan interactivity, fan engagement. The leagues are fully behind it. So I think right now we're in a period where high beta industries like sports betting are out of vogue. But I think you look at DraftKings, their vertical tech stack, what they're building. I think longer term, yeah, these are compelling platforms that the leagues are behind. You have to remember, the NFL is now fully engaged in sports betting. They took a pretty big equity investment in Genius Sports, so they're fully behind it. And you look at the growth that we've seen in the UK, we're about 15 years behind them. We think it could be a huge industry. You also have college kids now that are coming up and not betting through illegal channels, are going to be betting through legalized channels. That'll be another leg of growth. And the leagues realize this is a huge revenue stream for all of them.
Well, growth in terms of revenue, of course, is one thing. But when we take a look at the bottom line results for many of these companies, I mean, Bloomberg consensus data is showing no profit for DraftKings until mid to late 2024. What's your outlook on when we should start to see these companies turning a profit here? And are investors just going to have to put up with a lack of profitability until this becomes more widespread?
Well, I think you have to look at it. I think that's the key, right? Because if California legalizes by 2023, that's the 7th largest economy in the world. There's going to be a lot of spending. I know if you look at our estimates, we're on the lower end. We have EBITDA losses out till I think 2025. So for sports betting, you're creating a new market. There's going to be a lot of investment. But this gets back to how we view these companies as fan interactivity platforms. And if you watch what DraftKings trying to build around NFTs, what they potentially could be doing around media, these are higher margin businesses where they can cross-sell other products into. So I think if they can get into more higher margin businesses around their cross-selling, that could boost profitability, but you're going to see continued losses. That's just the environment we're in. We're still early. I think what's going to be key is, you're now 5 years, almost 4 years into New Jersey going live with legalized sports betting. And I think when DraftKings, if they have an analyst day or on their 4Q earnings, they're going to speak about their profitability in New Jersey. So if you can start to kind of say, hey, look at these 2018 cohorts, they're starting to turn profitable, that could give investors some comfort. Right now, it's a very challenging market for this type because, stocks without any positive cash flows are kind of out of favor right now.
Real quick, you brought up the media component to this, and we've had on David Gandler from Fubo TV before, and I believe they have the deal with FanDuel. That seems to be the right model, or what would you like to see that model grow? Because you've got people watching sports on Fubo, but then they can engage with the gaming platform to bet.
Yeah, I mean, Fubo and FanDuel do not have a deal. I think you're thinking of DraftKings and Dish Network. Fubo's trying to build out their own platform. But to your point, what you kind of want to see, right? If you kind of look at like the bucket what the fan spends in, right? They spend sports on media, so their cable subscription, sports betting, ticketing, apparel. Anything that where you can kind of create a more immersive experience where you can actually bring a sports book into a user's home, that's a good experience. I think Fubo is on a right track, right? They have a multi-view product at Apple TV that's very good. Now, can they develop a sports betting product? You know, that remains to be seen. They've gotten a lot of personnel to get the legal requirements and get the licensing. But what Fubo's trying to build, and also DraftKings is trying to look and do the same thing in media. If you look at their hiring from Verizon. So I think we're going to be eventually where the sports books have some media component where you can stream tier 1 events. And I do think that's a good strategy.
All right, we'll leave it there for now. Oppenheimer senior analyst Jed Kelly, thank you so much for your time and insight. Coming up, we'll have a discussion with David Long, Orange Theory Fitness CEO, and also talk about the latest on Peloton's wild share price ride. That's on the other side of this break.
Want to check where Peloton closed today because the stock actually traded higher, and this was a very volatile day. But Peloton's been under pressure over the last year. Let's take a look at this because it closed up roughly, what was it, about 9, almost 8% today. But there are a couple things to keep in mind with Peloton because pandemic stocks under pressure as Wall Street rethinks the future of fitness amid the supply chain pressure that's underway. Peloton feeling the burn from activist Blackwell's Capital to oust CEO John Foley and consider a sale. Orange Theory CEO David Long talked with Yahoo Finance about at-home fitness and what they found through surveys about people's attitudes returning to the gym and other things. Here's what he said.
We reached 1.4 billion in 2019. Didn't know it was around the corner. And I think what's really been fortunate is we pivoted very quickly during the pandemic. We provided both complimentary workout of the day to our members around the world, as well as a live interactive experience. So our members, through temporary closures, could stay in the habit, which is so important, and stay in the habit of their regular exercise. As we come out on the other side of this and we look back at 2021, we added 500,000 new members to the Orange Theory brand worldwide. So even through Delta and through Omicron, we had incredible growth last year. And we really expect over the next few weeks to be back on that 10-year growth tear that we've had.
David, the recent headlines around Peloton and the fact that the company is halting some production of its equipment products has raised, or sparked a lot of conversation about what the future of fitness, the gym looks like. They're one of the big beneficiaries during the pandemic, but what are you seeing? How's it evolved now that we're kind of in this space where, yes, the pandemic is still ongoing, people are still kind of learning to live with it?
Yeah, it's a great question. I mean, the at-home fitness had been around for decades before. It just obviously was in the limelight during the pandemic because that was really the only option. And I think this is really an and, not an or discussion. And as we learned from our members over the first decade and surveyed them every month throughout the pandemic, we learned that they just can't replace the in-studio experience, or the coaching, the accountability, the motivation, and that feeling of accomplishment of going to an on-premise studio. And so as we've come out of this, we really believe that that's still the cornerstone of most people's fitness regimen. And I think the advancement of digital platforms, and when we have our own, are really good ancillary and off days. But the core of really having somebody progress, understand how they're motivated and how they're getting results really still lives inside the studio.
I would love to know what the interest from potential franchisees looks like right now, incurring some of those costs to get off the ground and then continuing to try and woo members into that in-person experience with the precautions in place as of right now on a state-by-state basis.
Yeah, and so we're fortunate that our brand, pre-pandemic, had really more demand than supply for new franchise units to open, and it's the lion's share of existing franchisees that are growing. And so if you could imagine, that did slow during the pandemic, but we expect our growth throughout 2022 to pick up as far as new studio openings. And then when you look at the new member acquisition marketplace, it obviously varies by DMA. There are markets that have more restrictions. And we learned very quickly, back in 2020, how to provide the safest environment, how to pivot when restrictions change, and make sure that we're communicating really crisply, both to our existing members as well as folks that want to try us, so they know what to expect before they decide to walk through the doors and try Orange Theory for the first time.
Where are you right now compared to pre-pandemic levels? I mean, number one, if you're still behind, what do you think it's going to take to get there? And ultimately, in terms of recruitment, getting new customers through the door, is it about a better price point? Is it about safety? What are you hearing?
I think the right price point and making sure that the safety is there is really table stakes for us. It's really about building on the great experience that we already have and driving results and really showing incredible value for people that are only going to take 2 or 3 hours out of their week to make fitness a priority. And we have to deliver a great deal in those 2 or 3 hours. That's really been the cornerstone that's gotten us to this point. And when we look at recovery, some markets are very close to 100% recovery. Others are lagging because of longer term restrictions. But when we look in aggregate at our global business, we really expect to be back to 100% or plus recovery in 2022. And that's the way we're trending so far this year.
Emily, when we talk about Peloton, and a lot of people have been beating up on Peloton, they're going to report final, second quarter for them numbers February 8th. But they gave us a kind of preliminary advance of what they're expecting, revenue of approximately $1.14 billion versus what they had guided anywhere between 1.1 to 1.2 billion. Another thing they like to talk about is the subscriptions. I mean, in the previous quarter, they beat Wall Street expectations for revenue from subscriptions. So it's going to be interesting to see where they go with that. But it seems as if Peloton, which could do no wrong, the pandemic, lots of people were working out from home, and then lots of things started to misfire for them. And can they get back, forgive the pun, back up on the bike?
Well, that is the question, Adam. And I think just looking out over the past 6 months or so to really give a recap of the events, this timeline of events that has really led to and contributed to the share price decline that we've seen in shares of Peloton. Because recall, that stock is down about 17% for the year to date, down 81% over the past 52 weeks. And I think a lot of this most recent leg lower did start back in early November. That's when Peloton last reported its full quarterly earnings. And at the time, Peloton had slashed its full year fiscal 2022 guidance by up to $1 billion from $5.4 billion previously to only as much as $4.8 billion on the high end of that updated guidance. And at the time, the company had also cut profit and subscriber estimates. And then, of course, we had CNBC in its latest report last week really vindicating what the company had already suggested about potentially seeing some slowing demand here. CNBC reporting that the company was cutting production of its connected fitness products because of slowing demand. And then on the other side of this, of course, has been about whether Peloton has really lost its control of its narrative and lost the sort of shiny sheen that it had over the products. It had been compared to Apple, if we recall back earlier on during the pandemic, when that product placement that we saw with the character Mr. Big dying in the first episode of the Sex and the City spinoff series just a couple of months ago after riding a Peloton. So I do think there are a lot of questions here about this company's future growth prospects. That seems to be the main headwind that's weighing on this stock right now. And it is going to have to really report some strong numbers in order to turn this narrative around and potentially turn around what has been some really bearish sentiment out from the market, Adam.
In other words, no pain, no gain. Let's hope the gain is in their future. Emily, when we come back, we're going to take a look at what we think people should be paying attention to tomorrow.
After today's volatile day of trading, we have a quick overview of what you should be watching in markets tomorrow. And Adam, there are really two big things that I'm going to be keeping an eye on. And one of them is going to be on the economic data front. And that's going to be coming out from the Conference Board. That institution will be releasing its latest consumer confidence index for January. So it will be a pretty up-to-date look at the state of the consumer. And we are expecting to see a little bit of a reversal here from what we had in December. That index had been at 115.8 at the end of 2021. Expected expected to weaken slightly to 111.1, likely due to concerns over the Omicron variant and, of course, ongoing concerns over inflation. So that will be something to watch in the morning. Then also want to keep an eye on Microsoft. That's going to be one of the big tech companies reporting earnings after market close tomorrow. This will be coming on the heels of that massive $69 billion all-cash deal to buy Activision Blizzard, the video game maker. And of course, with Microsoft, always a lot of focus on growth in Azure, the cloud computing platform part of that business. So a couple things to watch on that front. But Adam, what are you watching?
Two quickies to pay attention to. We're going to get the Case-Shiller 20-City Composite Index. We're going to see how much housing has gone up month over month. So that's going to be a big headline that everyone's going to pay attention to. And of course, before the bell, Johnson & Johnson reporting. Want to see during the earnings call what kind of progress they're making to splitting the company. Emily?
Well, Adam, let's do one quick recap of what happened in markets today, because as I mentioned, it was quite a volatile session. The Nasdaq Composite had been off as much as 4.9%. We settled higher by about 0.6%. The Dow Jones Industrial Average had been down by more than 1,100 points at session lows and settled just slightly higher. But want to highlight one quick note here from Ryan Detrick, Chief Market Strategist at LPL Financial and friend of the show. He pointed out that the S&P 500 had been down 3.99% today at the lows of the session. Today was only the third time that stocks closed higher when the dust settled and had been down as much as that, so nearly 4%. And since 1950, there had only been 88 other days to be down this much at one point during the day. But that'll do it for Adam Shapiro and myself. We kick back off tomorrow at 9 a.m. Eastern on Yahoo Finance Live. Kick it off right then.